Thanks for having me here, Patrick. Always fun to talk with your subscribers and really anyone who wants to get better at trading, because this is where the game is won and
Whoa!
lost.
That dragon
what I
just
thought we'd
blasted
do
fire.
this week.
How do you plan to
is,
dodge its attacks?
Not what I thought I would do. This is a Rob put together episode, but I thought now would be a good time to talk about it since it's early in the year, and we spent so much time really drilling down deep and getting into the nitty gritty on things. Let's take a step back. Let's, kind of take a breath and do something that really is for everybody, because if you're new or newer, I think this will help a lot. But even if you're experienced, it's nice to kind of take a step back every once in a while and say, hey, why do I do this? Why do I love doing this? And just what are some of the real basic things that I have to watch out for in trading the Forex market? So we're just going to keep it to Forex for this episode. We may do other avenues later. But Rob, go ahead and get us started off here. And as I always do, I will jump in where I feel like it's appropriate.
Thanks, Patrick. I'm going to start out with the saying I've been saying for years. Trading is trading. Now, you might be thinking to yourself, wait a second. That literally doesn't make any sense. So let me explain what I mean by trading is trading. I don't care if you're trading stocks. I don't care if you're trading Forex. I don't care if you're trading bonds. I don't care if you're trading anything. It's really the same game, and I liken it to an analogy of a car. When you get into a car, we all know it's the basic things. You got your gas, you got your brake. Some cars have a clutch. You've got your gears. And really, driving is driving. No matter what car you get in, you can probably get to where you're going based on the basics that you know. So driving is driving. Whether you're driving a go-kart, whether you're driving a truck, whether you're driving a minivan or whatever. It's the same mechanics. So when we talk about trading is trading, really everything is the same dynamic, because in the end, everything is simply a symbol that is a current market price, and that current market price will go up and down based on supply and demand. So really trading is ubiquitous. It really carries across all the asset classes, Forex, stocks, bonds, futures, gold, whatever it is. With that being said, when we go out and we take a look at cars are different. So yes, we might know how to drive them all, but some cars are slow. Some cars are very, very fast. Some cars are used to go very slow so they can pull very large things. So we have all this variability in this world of driving, and we literally have the same thing in the world of trading, is that there are different vehicles that are going to go different speeds. And that's what it really comes down to when we get into trading. Whatever it is you're trading, you've really picked a vehicle, and that vehicle is going to have certain characteristics that come with it. And those are the characteristics that we want to talk about in this episode, and we're going to talk about the good and the bad. So if you have chosen Forex and you say, hey, Forex is what I'm going to go with, I'm going to trade it. These are the problems and some of the advantages that you're going to get along with it.
Yeah, and the way you have it written out here, I like it, because we'll go ahead and start with the advantages. And most of these really don't have a lot to do with trading psychology, but it's almost an advertisement as to say, hey, look, if you're not trading this now, you need to be. Or if you are currently trading it, you've chosen the right path, because there are so many advantages, and I've talked about this early on my own channel, to trading the Forex market, that you're just not going to get anywhere else. So, Rob, go ahead and start off the list here. I'll jump in, and then I have some of my own that I added towards the end.
I personally started trading Forex in 2007. I started trading in 1997, so this was 10 years after. And when I got into it, I remember making my first couple trades and not understanding position sizes, not really understanding much. There's so much better information out there about Forex trading. But I fell in love with it right away. And it was because of these advantages. They did so many great things for me and my personality that it just absolutely fit like a glove. Now, I'm going to jump into the advantages here, but I really want to talk about how where you are right now as a trader, and especially where you were in the first year of trading. There's lots of different ways to trade. You can scalp, you can day trade, you can swing trade, you can do longer term stuff, you can do any of these styles. Eventually, you're going to find the one that's right for you. I found the one that was right for me, That doesn't mean that you can come in and do the same thing, because just what we're talking about here, there are some trading products that my personality, my psychology, it fits like a glove. And there are some that really are very difficult. And if I went to go try to trade those, I would likely fail because of the psychological problems that come up in those products. So I really wish that before every trader got started as a trader, you literally could have a questionnaire and you could like have a list of all the advantages and disadvantages of Forex trading, all the advantages and disadvantages of stock trading. So you could actually go through, it's like a menu, and be like, which one do I want? Let's see, that one's a little bit too slow. That one's a little bit too fast. Oh, this one is just right. So again, Forex for a lot of you, it was a really good fit. I fell in love with it. And let me tell you my first thing I loved about it. 24-hour marketplace. Now, I told you that I am an extrovert. I love action. I love to trade. I love all of it. One of the saving graces for me as a beginning trader was that the stock market is only open 7.5 hours a day. I couldn't make any mistakes outside of those times. But when I got to be where I was consistent, all of a sudden Forex to where I can now trade pretty much 24 hours a day, it was really, really good for me, and it fit really, really well. What about you, Patrick?
Yeah, as somebody who's in the restaurant industry and likes to get up at 10 or 11 o'clock in the morning, I mean, it just makes perfect sense. I could have traded probably stocks too, but the fact that even if I had an off day, I could still come back in at night. Now, the markets don't move a whole lot at night during the Asian session, but at least I can get in there and trade if I wanted to. And then, because of my hours, I stay up pretty late as well. So late at night, if I wanted to, I could come home from work and get started. And that's often what I would do. It was a real nice luxury to have. I think really, though, and this kind of leads into some of your other points, though, Rob, is it's just a lot easier than the stock market. There's things, the only thing I knew at the time back in 2009 or 2010 that I could trade, that anybody could trade, was stocks and commodities. And there weren't any really great platforms for that back then. I always thought you had to go to school and you had to try to get on Wall Street or do something like that. Like, I didn't really understand the business too much, and it just seemed really overwhelming. And plus, it seems like you have so much less control over what these stocks do. I didn't understand technical analysis, so it was ignorance on my part. But when I got to learn and study the Forex market, I thought right away, man, this is just so much easier in so many ways.
Exactly. And let me give you a personal story here. My son, he graduated high school a few years ago and was getting into trading, and he's got a trading account. Here's the problem. He does not wake up easy in the morning. It's always taken him a long time. Since the day he was born, I'm telling you, this kid could never fall asleep at night. And then he would sleep until 1 or 2 p.m. if we let him. And he could just never go to sleep. One time when he was about 12, I went up. He was awake. I said, "Oh, you can't sleep?" "Yeah, I can't sleep." Went back up about 2 hours later. He had finally fallen asleep. And I looked through his search history on his little iPod there. And the last search he did was, "How can I fall asleep?" That is the saddest Google search a 12-year-old boy can do. So for him, he literally cannot. He now lives in the Pacific time zone. The stock market opens up at 6:30. For him to wake up at 6:30 and trade, it's not going to happen. It's just not who he is. So I love in Forex and other markets, it doesn't matter for him. It makes it to where he doesn't have to fight this battle of sleep. He can actually do it on his own time. So that's just the wonderful part about the 24-hour marketplace. And I know there's a lot of creative types that also do very, very well in the Forex market because that stock market opens up so early and it just doesn't vibe with them. Patrick, have you ever thought about that at all?
Not so much. I just know that even today that I don't work hospitality anymore, I still, usually get up right about 9:30, which is weird for a lot of people. But it's never been that way for me. I'm still on Vegas time, even today. And I get a lot of work done at night, and then that's just how it is. And so something like that, again, if I get up at 9 or 9:30, I could still trade most of the stock market if I wanted to. I'm on Central Time now, so that helps. But just not having those limitations, being able to sit down and do it whenever I wanted to was something that really appealed to me back then. Now, as most people know, I only need to be awake for 15 minutes out of the day to trade the way I trade now. But that's not most people. So for most people, just that flexibility, I think, is really, really key. And each session of the day has its own little idiosyncrasies, and you can learn those too. So it just seems like it's much more tailor-made for most people. And that's just the Western Hemisphere. Most people, if they trade stocks in other countries, they're going to trade the most liquid markets, and that's going to be in the United States. That's going to be really tough if you are in Pakistan or if you're in Singapore or Australia or someplace like that. So Forex is I always say, I compare it to soccer. It's the world's game. Everybody trades it, and it makes sense. The market itself just allows you to do that.
The U.S. trades stocks, the world trades Forex. You're exactly right, 100%. The next one I want to talk about, and this is one of my favorites, because we've spent a couple episodes talking about biases, familiarity bias, confirmation bias, all of these biases that are inherently built into how we look at things. Here's the thing I love about Forex. It automatically gets rid of a lot of biases. The first bias it gets rid of is what I call the long-short bias. Now, in the stock market, you have people that are perma bulls. Everything is always great, and you should always buy stocks, even if the economy is like in the pits. They're like, you should still buy stocks. Well, wait, you told me to buy stocks 6 weeks ago, and now the market's down 20%. And they're like, yeah, but now you should buy more stocks because they're cheaper. So you got the perma bulls, and then you got the perma bears. The perma bears where everything is always terrible, and it's no matter how well the market is done, the disaster is right around the corner. I just read an article today saying that 2024 is going to be down 60%, some guy said. And look, what happens is these guys, they have them on CNBC over and over and over again for years. And then when the market finally collapses, they're like, see, I'm right. It's the old adage, even a broken clock is right 2 times a day. So you get a lot of that bias, that just inherent long-short bias in the stock market. But in Forex, everyone understands that there is no long bias. Like, I don't want to be long the Australian dollar for the rest of my life. That's the silliest thing in the world. But people want to be long Tesla for the rest of their life. They want to be long Bitcoin for the rest of their life. But in Forex, everyone understands there is no long-term, long-short bias. And that gets rid of so many psychological problems. And you can't fall in love. Now, I say this, but I've seen it a couple times. You can't fall in love with a currency. Like, people are like, oh man, I just love the pound, and I think the pound is going to go up forever. Look, I have met people that have thought that, and especially when it's like their own currency. Like when I have Canadian traders, and they're like 75% of their trades are Canadian crosses. I'm like, hey, look. That's ridiculous. So look, you still have some issues, but the fact that there's no long-short bias, there's no CEO at the head of any company, it makes it to where when you can trade Forex, you are purely trading the charts. That's what I love the most about Forex.
Yeah, so a couple things on the bias end of it. I had a small bias. Not when it came to trading. I was able to put that bias away. But I was really pro USD, not just because it was my home currency and I wanted to travel, but at the time when I first started, the dollar was pretty weak and the euro was pretty strong, and a lot of other foreign currencies were pretty strong against the dollar. And so those people from those countries would come to Vegas and take advantage of that, the currency arbitrage. And those people would sit in my section in the restaurant I worked in and tip me poorly. And so I was like, man, we really need the dollar to get stronger so these people stop coming into my restaurant and making me work for $5. But apart from that, biased aside, sorry, people from other countries, but do better. I totally agree with you on this is something I've said on my channel so many times. Forex is the closest thing to a blank canvas in terms of trading you're ever going to find. And because of that, if you're good at charts, you can be good at Forex. It's literally that easy. Now, there are of course, landmines we have to dodge in terms of news. That's no fun. But if you can trade your system and you can stick to it, you can do well. There are so many less external factors that can come in and ruin your perfectly good trade. And I love that. I know Forex traders out there sitting there thinking, man, there's this, this, this. Okay, so there's this, this, this. There's 5 times that in the stock market. Which one would you rather have? So yes, it's as blank canvas as it gets. I said this at the very beginning of my trading psychology book. It's open to everybody. Some people might start a little further back, but at the end of the day, we're all rich or poor, educated or uneducated. We are all pretty much starting at the same place when this game starts. And that is really, really awesome.
I've never heard that before, but I love that. Forex is as close of a blank slate as you can get in the world of trading. So true. Like I said, if I take someone in who hasn't traded before and I'm showing them just currencies, there's no bias. There's no bias already built in. They don't know or care about anything in Australia. Like they didn't even know that the Reserve Bank of Australia met 2 weeks ago. So all of a sudden it's such a blank slate and they can purely react to the charts. It's beautiful. All right, let's get to the next one. No gaps. Now I know that gaps will still happen on weekends, but throughout the week, you're not going to get any gaps. Now, for those of you that don't know what a gap is, in the stock market closes at 4 p.m. Eastern time in the US. If there's any news that comes out on that company, when it opens up for trading the next day, the price is going to be wildly different. I mean, there are stocks that were $100 and they open up tomorrow at 50. There was no opportunity for you to get out of them between 100 and 50. So you can't ever really quantify for max risk because of gaps. So because of that, that always leads a lot of people to trade scared. And they're always like, when they get a little bit of a gain and they go into a weekend, they say, oh, the weekend's coming up. Why don't I just sell it now? Because it's just, I don't want to hold it over the weekend. There's too much risk. It causes them to deviate from their system because of these fears of gaps. And trust me, if you trade stocks, this is going to happen to you and you carry it with you, PTSD. I remember the very first time I had a stock, everything was going great. The next morning I woke up, the stock was down like 15%. And I'm like, what the hell's going on? An analyst over at Bernstein, whoever, a place I'd never heard, had downgraded it. So one dude decided, I don't like this very much anymore. And it ruined my entire trade. I carried PTSD, and every night I had some worry about my positions. And so if I was up on the positions, I would take them. Why? Because I didn't want to wake up to another gap. That is one of the best things about Forex as well. Look, you have very fast moving markets. You have slippages to worry about with Forex, but you don't have any gaps except for weekends.
Yeah, and back then they had after-hours trading too, which was such bullshit because only certain people and certain firms had access to it, and nobody else did. It's like, what the hell's that? In Forex, you don't have that. Not only don't you have things like that, I even said, and I don't know how true this is, but it's a lot less likely that, and he was more relevant back then when I said it, but it's not very likely that even Bill Gates could come in and ruin your euro-dollar trade. Like, he might move it a few pips, but it's so liquid that, people who have these special privileges can't just come in and screw things up the way they do in stocks. In Forex, nobody has special privileges unless you're the big banks. We talk about that too. But when it comes to retail trading, when it comes to spot trading, again, everybody is on the same playing field, which is really nice. And I think that liquidity plays a big part.
Well, that liquidity is a great benefit to Forex trading because that liquidity is going to allow you to do a lot of things that will get rid of psychological problems. So for a very, very liquid market, automation works very, very well in these kind of markets. Why? Because there are going to be tight spreads and there's going to be low amounts of slippage. Now look, when there is a news event, none of that stuff that I just said applies. But in normal trading, Forex is probably the best market for automation. If you're going to be setting up a system that enters and exits at predetermined points, it's probably the best market to do it in. And why do people automate? Well, we talked about it in our episode. Automation is a good way to get rid of some of the psychological traps and disadvantages that comes with trading Forex and really trading anything.
I agree. Yeah, that's always been a big one for me. And if I can transition into the next one, because this is the one I added, and we've touched on this a little bit before, but news affects Forex a lot less than it does stocks overall, in particular because you know when a lot of news events are coming, and you can easily avoid them and then just jump right back into the game. I've taught people how to do this on my channel, and again, it's not super fun. News can still get you anyway, but the likelihood of it happening is so far less than it happening in stocks. And it's really the only, I guess, fundamental factor you really need to consider when it comes to actual trading. If you're investing longer term, okay, some of these other things that are going on in the world geopolitically do matter, but on a day-to-day basis, they really don't. And like I said, you can shut it all down, wait for the news event to go by, wait for the after effects to occur, and then jump right back in and resume. And that's really nice. You don't have to worry about balance sheets and CEOs doing this and lawsuits and recalls and the price of oil and all this other stuff that goes into the price of an actual stock. And the way Wall Street interprets that on a day-to-day basis, that's just miserable. And I was still willing to do it anyway, but then I found Forex and I'm like, oh, I don't need to do any of this stuff. I just need to watch out for this small handful of things and go about my day and then use my charts for everything else. It's fantastic.
It absolutely is fantastic. So let's cover the advantages. 24-hour marketplace where it's available for everyone's schedule. Other markets are not available for everyone's schedule. I love that it comes without biases. A lot of biases are just gone. You no longer love Tesla stock because you love your Tesla car. Like, that's a real thing. Or I have people that worked in a certain field, like in engineering, and they only will buy like semiconductor stocks. Like in Forex, you can't have any of those biases. It's so great. You don't need to worry about gaps. You have a 24-hour market, and you've got this huge liquidity that allows you to do a lot of things. And Patrick, you mentioned you can jump out and jump back in. That almost costs you nothing in Forex. Like, the cost to jump out and then jump back in is so negligible in Forex. But in other markets, like an options market, if I had to liquidate a trade and then get back into it 5 minutes later, that's going to cost me a pretty big percentage of my investment. So there's so many great things. And in the end, we both agree, and I love what you said, it's a blank slate for perfect charting. You don't have any of the biases. You can just follow the chart. Love it, love it, love it. Now look, as you can tell, Patrick and I both love Forex trading, but there are definitely disadvantages that come for it. Now, one of the most controversial things I always tell people is well, when you look at Forex trading, it's actually quite low volatility relative to other products. And people always say, what the hell are you talking about? Forex is the riskiest game out there. It's the most volatile. When you look at volatility on a percentage change, a big 24-hour move in a currency is 1%. That's a big move in a 24-hour. Go look at the stock market. Go look and just see what did Google do today, or what did Tesla. They're up and down 4, 5, 6%. And then you go out and take a look at some of the other crazy ones. They can easily be up, 15, 20%. We had a big run in crypto today, and I think I saw MicroStrategy, which is a big holder of Bitcoin. I think they were up like 25% today. Oh, sorry, up 11% today. But these moves that you see in other markets are huge when you look at Forex. So Forex is actually one of the lowest volatility when compared to others. Here's the problem. When you open up a Forex brokerage, they give you the leverage to make it the most dangerous game in town. So the disadvantage of Forex is when you go in and trade it, and you're given that leverage, you start to see all these dollar signs in your eyes. And you think, oh, I've got the ability to trade a big account or a big amount. Why shouldn't I trade it? That is really negative for the newbie. Very negative for the new person. And I know that I'm guessing that 70-80% of the people listening to this, if you've traded Forex, you blew up your first account. Why? Not because Forex was so volatile. It's because the leverage that the Forex brokers were willing to give you made it to where if you lost 3 in a row, you were done. So the disadvantages is the leverage, in my opinion, is way too big. Way too big is what they allow you to do. So here's the irony about Forex trading. You've got all this leverage, but if you want to trade it correctly, you're not going to use it. What do you think, Patrick?
I will only push back on that very last point, that if you really want to make any kind of meaningful difference in your account year to year, leverage is necessary. Now, the way we look at it when we first start, no, you're right about all that. That is what kills everybody's account. Everybody knows I blew out my first 3 accounts, and this was a big reason why. I was really excited to see that for every dollar I put in, I could get up to 50 in the game in the United States. That was really, really exciting because I didn't feel like 1-to-1 was going to get me out of my situation anytime soon, but 50-to-1 certainly could. And I didn't understand the rest of that. Yes, 50-to-1 certainly could get you out of a bad situation, ... if you do literally everything right, which nobody does early on. So, and yeah, to what you said too, a 2% move on a Forex pair in a day, that's significant. Like, you really notice it, and you really hope you got a piece of that. If not, you're pissed off, because that's 2% is gigantic. 5% is a flash crash, for God's sakes. But yeah, not only that, I was even looking for more volatile pairs on top of the leverage I was already using. So I was doing some deep research on the dollar Swedish krona and the Canadian dollar versus Swedish krona. And I thought I found some really cool stuff there. I'm like, oh man, look how many pips this thing moves in a day. It's wild. I mean, if I can just figure this out, I'll really get out of this industry quick. So just the stupid crap we think of early on in this game. And leverage is really responsible for a lot of that. I shouldn't blame leverage. We should be blaming ourselves. But if leverage wasn't there, we wouldn't have these wild dreams when we first start this business. So I had to, I know on my channel, have a real come to Jesus moment on the podcast with a lot of people and say, hey, look, I know leverage is there, but if you're starting with a $200 account and you think you're going to turn that thing into $1,000 or anything meaningful to get you out of a bad situation, it's never going to happen. So just stop. And I got a lot of pushback from that. They were like, people are arguing with me saying, no, you can do it. I saw this guy do it over here. I'm like, yeah, he told you he did it, but did he really? Did he catch lightning in a bottle and then have the presence of mind to take all of his profit off the table? I really, really doubt that. This is not realistic. You're going to have to treat this like a long-term business, not like a short-term hustle. And I'll bet you I lost some subscribers that day. But you have to dash those people's dreams because there was nobody there to dash mine. And that's why I blew out 3 accounts. So, and I'm sure other people have had it even worse. So you're right. This is, I think, is the biggest disadvantage out there when it comes to Forex. It's not anything the Forex market did to deserve this reputation, but that leverage right there has taken so many people down and just completely knocked them out of the game before it even started.
Leverage is simply the volume knob. So as a new trader who's bound to make some mistakes, and again, all the psychological mistakes that we've talked about, you're going to make some or all of them. If you have the volume up louder, those mistakes are going to be more painful. If you have the volume down lower, they're not going to be as painful. You are going to make them. That's a guarantee. The question is, did you turn the volume up full blast right when you started trading? If so, it was very, very painful. So just like with music, the volume knob, you turn it up when you can handle it. And so when I said you never use Forex leverage, that's not true. You want to use the Forex leverage when you're ready to use it. My favorite strategy in Forex is pyramiding, or what I call legging in, where I'm trying to build the biggest position that I possibly can. Like, I'm trying to build huge positions. And what I'm trying to do is I'm trying to catch a major trend. And if I can catch a major trend and buy an appropriate amount here and then put in a stop, once it gets to a certain point, I want to buy more and then move my stop up to where I have an appropriate amount of risk. And then if it goes for me more, I want to get more. I want to get more. And look, I'm trying to build these positions and I'm using lots of the leverage that's afforded to me, but my stop is always moved up each time I take a new position to the original risk amount that I took. A lot of times these trades do what I call fizzle out, where I didn't get the big move I thought, and I built up a 6x position over like 2 or 3 weeks, and then they fizzled, and I ended up breaking even or having a loss. That's really frustrating. But look, I know the game I'm hunting for. I'm hunting for the big one. Nothing's better when you catch a big move like this. The biggest move I caught personally in Forex was in 1998 when the markets were crashing. I was short Aussie yen, and I had 40 lots that I'd built up over about 2 weeks as the markets were falling. And I built it up to a 40 lot position, and the Aussie yen pair dropped 400 pips. Well, that's what I ended up making on the profit. That was my biggest win in Forex. Really, that still is my biggest win in Forex. And I did it using leverage, but I did it correctly. So look, I'm not saying you can't use leverage ever. All I'm saying is it's a real negative until your psychological problems are fixed.
And I haven't ever come close to trading anything resembling 40 lots. So good on you for at least getting to that point.
Well, wait, Patrick, let me tell you the rest of the story, because that was the next trade was the last major trading mistake I've made in my career, at least what I consider to be a major trading mistake. That was so euphoric. It was just so awesome. I mean, fist pumping, and I rarely fist pump, but I was fist pumping. I'm a very mellow guy. The next trade I made was 100 lots. And the second I hit the button, my P&L showed negative $3,500. And I knew immediately, oh shit, I think I've made a problem. It went against me. I took the loss, luckily. But that to me, again, we've talked about my cycle is when I have a big gain, I want bigger gains, and I want bigger gains. It just encourages me to take more risk. That was the last major mistake I made, and it hurt. It hurt. I lost about 40K on that one button click.
So the other disadvantage that I can think of then, apart from the leverage, is an advantage we talked about earlier, because I think it cuts both ways. Forex being a 24-hour marketplace is a problem sometimes, because you can really do this wrong. And I'm speaking from somebody who did do this very wrong. There's a lot of different bad routes you can take here. Rob, go ahead and start us off, because I have some thoughts that aren't even on the sheet here.
As an extrovert, this was my Achilles heel. And I said earlier how when I started trading, and there wasn't really after hours trading, I could only be an idiot 7.5 hours a day, and then I had to wait for the next day for the markets to open up again. I've said this for years and years and years. I'm going to say this to everybody. If I started in Forex, I'm not sure if I would have made it or not. Just think about that. I don't know if my capital would have held out long enough for me to figure out not to be an idiot with a 24-hour-a-day marketplace. So for someone like me, an extrovert, it is such a negative for it to always be open. And look, I used to trade out of boredom a ton. Well, the good thing was when I started out, you had to go to an office. You didn't trade at home. You literally I had to drive 30 minutes to an office. And then once I left the office, there was nothing I could do. Now it's on your phones. It's at your house all the time. At any time, you can just click a button and you're not bored anymore. You get all the feelings, all the rush. It's a really, really negative thing for extroverts. And as I said earlier, I don't know if I would have made it had I started with Forex. I needed to learn the discipline and learn how to curb that.
Yeah, because the biggest psychological hurdle of having leverage mixed with a 24-hour marketplace is when you're first starting out, especially, it allows your mind to run completely wild with the possibilities of what you can make should you, one, leverage up as much as you can, two, trade as often as you possibly can. There's two really big sessions. You have London and New York. If I'm looking at this, I'm like, man, if I just grind it out and trade London and New York, ratchet up my leverage as high as it can go. What are the possibilities? And I'm sure this sounds absurd to a lot of people, but it doesn't sound absurd to a lot of first-time Forex traders. I'll tell you that. And that's where, I don't think YouTube and Twitter does them any favors, because you see these people with these big home setups with, 6, 8, 10 monitors, and you're just like, all right, this is the grind I need to be set up for. And that's so not the case. On top of that, it's a terrible lifestyle if you do it this way. You're not going to make any friends. God forbid you live with other people. They're not going to like you. And the sleep schedule has to be atrocious. I had a terrible sleep schedule. It was ruining me. It was ruining every relationship I had. It was ruining my body. It was ruining my state of mind. Everything. Because I thought I had to conform to this certain way of trading. And just so you know, if you didn't know this already, it doesn't have to be that way at all. Episode 3 of the Forex Q&A podcast. I just looked, over 158,000 views on an audio podcast. There's a reason for that, and that's because it was the big awakening moment where so many people who thought you had to do things one way said, oh wait, I can do things a different way in terms of how I approach this on a day-to-day basis, and it works better, and it gives me my life back. That can be really good. But I'm not going to sit there and say it's like BC and AD or anything like that, but before that video came out, most people hadn't even really thought of that. And they were grinding themselves down to the bone, doing something that should be somewhat enjoyable, or else why else would you do it?
I'm just going to sigh, and just after what you said, it's so true. I said for a few years, again, Forex for me has always been one of the things I trade. And so when Forex gets good, I always become very excited about it and say, hey, let's spend some time over here. I started trading Forex in the really right before and right during the crash of 2008, 2009. It was great. And then it really died down a bit. It really wasn't a great market for like 2009, 2010. But then in like 2011, 2012, the Eurozone started to look like it was going to break apart. And oh my gosh, Forex trading was awesome. I mean, I've never seen a market that good. I don't know if I'll ever see a market that good again. I'm hoping I do. But for a good 2 to 3 years, and then we got Brexit, it was amazing. My sleep schedule, and I'm not just talking about my sleep schedule. I was waking up multiple times a night, checking quotes, checking things. I remember one time I woke up and I was on my phone, and my wife looked over and looked at my phone to see what I was looking at, like she had caught me. And she said, why can't it just be porn? And then she fell back asleep. Can you imagine that? The wife's like, I wish she was just looking at porn, not the Forex market.
But it was porn. I mean, you had the Eurozone collapse, you had Draghi, you had Grexit, you had the taper tantrum, all of those things happening at the same time. Go look at the ATR day-to-day from back then. It was so different than what you see now. Volatility was everywhere, and you had these huge moves almost every day. You maybe had one day of consolidation a week, but that was it. Like, that sucker was moving. It was so exciting.
It really was. But I do remember telling people this multiple times during that period. I love Forex trading, but it's completely ruined my life. And look, it's a little bit of an exaggeration, ruin life, but really, I was tired all the time. It was a mess. My sleep schedule was screwed up. Again, relationships were strained. I really had to decide, hey, Forex needs to take a back seat for a while. I need to get back on track. And now there are times I will still check things during the night, but it's not very often. Not very often, because I've decided this isn't the life I want to live. So I'm going to do my trading a much different way than I was back then. And Patrick, you're right. It was a different market to where you could make a lot of money in just a few hours. It's just a different market today, and I'm so happy about that because now I can sleep.
Yeah, and I'll second that. It's calmer now, but you can make pretty much the same amount of money day to day if you wanted to, because with less volatility comes less spikes, less chance to lose money at the same time. So yeah, I agree. Now, in terms of solutions, there's really not going to be many this episode because we've touched on most of that. We've touched on a lot of solutions in this episode itself, or I've done it on my channel, or we've done it here on the podcast. So, Rob, is there anything you kind of like to say to wrap things up here?
Yes, I just want to say if you're fairly new to this, or even if you've been doing this for a long time, you don't know until you've tried other things out. So I highly recommend if you've only traded Forex, go dabble in the stock market a little bit. Go dabble in the options market. Go in the gold market, in the crypto market. And really, you can do this all through a demo account. You don't have to put real money on the line. You will find what fits you best, but you've got to be looking for it. So if you're really loving Forex now, but then you go and you try the metals market or you try something else, you might find that it fits you better. It fits both who you are personality-wise, and it fits your lifestyle better. And it also helps you overcome some of your failings that you're doing. So my advice to everyone is, if you've only traded Forex, go out and play around with other things. Go read some books on some other things. Go open up demo accounts and play around with it. See if you can develop a system that's profitable. It's going to be really good. And like I said, eventually you will find the thing that fits you like a glove. And that's where you're always going to get your best success.
And I want to hear from all of you too. So those of you who are on YouTube, or those of you who are on the podcast players, go to YouTube and go to the comments section. Let us know if there's something we haven't covered in terms of, let me just ask you this. What was the dumbest misconception you had about Forex before you actually started trading it? And how long did it take you to realize that you were completely off base with that misconception? I'm curious to hear. If it's something we haven't covered on this episode, I'd like to hear it from you. But on top of that, thank you for joining us here at the Trading Psychology Podcast. And Rob and I will see you next week.
Have a good week, everybody.
This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, it is the supreme leader of the Flat Earth Trading Society. It is Rob Reinhold.
Well, thank you, Patrick. You're going to need to cut back on these adjectives because there's never going to be enough room on my tombstone for all of them. And I don't know if that's a compliment of the supreme leader of the Flat Earth Trading Society or if that is an insult, but we'll just leave that up in the air.
I think being the Kim Jong-un of anything is likely good.
What if I was the King Jong-il of the King Jong-uns?
That's a little too meta for my brain
sure.
right now. I'm too focused on this episode, and it's going to be a good episode this week, traders, because if you've noticed what we do here, especially as time goes on and we're trying to find really good episode ideas, we will take a point we made in previous episodes, and this is a point we've made several times, Rob, and we will isolate it and make it its own episode. And they usually turn out really good because so many people have experienced exactly what we're going to talk about today. I would wager to say that almost everybody listening to this podcast has probably gone through this already, because if you began your trading career and then it just took nothing but losses right off the top, you would have probably quit. You'd have probably said, this is stupid, this is not what I thought it was, and moved on. But chances are that you had some measure of success, not only early on, but a bit later in your career too, when it was still too early to tell if you were actually a good trader or not. But that's not how you felt about it. You probably had this sense of euphoria. We could have called this episode Euphoria, honestly. But I guarantee you, it was probably the reason for future futility. It certainly was for me. It's the reason I blew out 3 accounts. And Rob, this is one of my episodes that I kind of crafted. But so before we get into my notes here, do you have anything to add before we start doing that?
Yes, and I think it's such an interesting concept is that when you are in your body, in your life, you have a very, very difficult time. And actually, I'm going to say it's completely impossible for you to have an objective view of what you're doing in life. But let me give you like an analogy of, let's say that you are a scientist and you're watching someone who is learning how to ski for the first time. And you've watched a lot of other people learn to ski. And, you're writing the notes like, oh yeah, okay, they're falling down at first, but then they get that 1 or 2 really good runs under their belt. And then they're like, I'm ready for that black diamond. Now the scientist is going to say, oh, this is going to get ugly. They already know what's going to happen, but you don't. You don't, because you don't have the ability to really step outside of yourself. And I remember when I very first started trading, about 2 years after I was started, I brought my brother in to trade with me. And on one of his first trades, I was, taught him about stops and all that things and controlling your risk. And he decided to pull his stop order out. And sure enough, the trade went down below where his stop was, but then it rebounded back up and he made money. And he was so proud. He's like, I made money on that. I'm good. And I said, oh, you just set yourself up for a lifetime of pain. And sure enough, I said, look, you now think that that's what you do because you got rewarded early on and you think, oh, they always come back. I promise you, there's going to be one that doesn't come back and it's going to get you. Sure enough, that's what happened. Even though I told him those words, he literally couldn't step back from himself to save himself because it's just very difficult to do that. So yes, I think this one, everyone has gone through this. And I think it's one of those things that I'm not sure that early on you even are self-aware enough to know what's going on.
And I would even argue that later on in your career, you might not be self-aware because I think, well, we'll get to this in a moment. Let me kind of take it back to where it all begins, in my opinion. And I've said this quite a few times on this channel. I just don't know how many people listen to everything we do compared to who just comes in every once in a while compared to who's new. I don't know. So I'm going to say it again. And when you first learn to trade, in particular, when you first learn how to read a chart, before you learn that, charts are so daunting. Like there's all this stuff there and people are reading it like they're, 4-year grads of this stuff. And then you sit down to learn it. And within a week, you can pretty much be caught up to where they are in terms of technical analysis and how to read a chart. At least that was the experience for me. Because I don't learn things very well, but I learned this so quickly. So for me, it was like, wow. All of this stuff got demystified right away. And the really cool part about it is I got excited along the way too because almost every example I saw of a tool you can put on your chart worked when they showed it to me. And they were using historical examples. They weren't making up price action. It was real price action. They used a real tool and it made a real profit almost every time. And so then I get into the real world and I start using these things. And early on, they were working most of the time for me. And I'm like, this is extraordinary. This is like a level of wizardry that I didn't like. Do Wall Street people know about this? Like, am I going to surpass them in month one? And I actually did. I was just killing it early on. And so in my dumb brain, I'm like, wow, good thing I didn't go to school for 4 years. Good thing I didn't toil away on Wall Street because I'm already ahead of these people 1 month out of learning technical analysis for the first time. So Rob, how absurd does this sound? And, I know it's been a while since you started, but can you relate to this at all?
I can absolutely relate. And, I've told the story about stochastics. Like when I first started stochastics, oh my gosh, like when these two lines cross, I just buy. And when they cross again, I just sell. Like, oh my gosh, like I am so smart to be able to tell when two lines cross. And then, you find out it's not that clean. It's not that easy. And sometimes they fail. And then you really come to terms with how difficult technical analysis is. It's not difficult, but just the failings of it. Technical analysis is just statistics. Yeah, it might be right 60% of the time, but 40% of the time, it's terrible. Now, Patrick, I would love for you to put a video at Maverick Trading down in the description below in this video on YouTube, tying it to a class I did, or a video I did called Technical Indicator Myths, the Myths, Legends, and Fairy Tales of Indicators. It's about it's a 27-minute video, and I go through all the reasons why we feel like we do it first, and then the reality hits, and pretty much the process people go through.
Yeah, even though you're asking me to put an anti-indicator video on my channel, I will watch it first, and then I will do that.
It's not anti-indicator. It's understanding what the indicators are doing and saying, and really understanding it. Because when I was learning about stochastics, what I learned was when the lines cross, do this. If you ask me, what do these lines mean? I don't know. I have no idea. And so stochastics can be very accurate in very specific situations. But in other situations, they're very inaccurate. And if you really can understand when and what situation you're in, you could pull out the correct tool for the job. And that's what we talk about at Maverick is indicators are tools, and there's certain tools for certain market conditions that work better than the others. So it's definitely not anti-indicator, but it's definitely anti just do this when they cross and you'll be fine.
I don't go into the mechanics of the indicator that much to where I know why these two lines are crossing. And it has still worked pretty well for me. So it just goes to show, if you dive deeper into it, it could help. But don't let it lead to analysis paralysis either. Just so everybody knows. Yeah, I have not gone super nerdy into these things like some people do. I know we have a lot of indicator nerds on this channel, and I say that in the best possible way. But just know, to me, it's not essential. But Rob might have a really good point here. It's worth looking at. And we'll go ahead and put that at the top of the show notes after the description. So check that out when you can. So moving forward from there, I think that's a pretty obvious point. I don't think we need to hammer too much on that anymore. But something else I want to hit on too. I would imagine also when you first started, you tried to immerse yourself into the Forex trading community in some way. Maybe not as deep as being like a part of trading groups and chat forums and things like that, but at least you followed some people on Twitter or on YouTube, or just subscribe to people's blogs, whatever route you took. This all depends on when you started too. You were influenced by influencers. And I've said this in the past too. The problem with these people is they typically do not like to show you when they lose. They lose just as much as everybody else does, but it's not in their best interest to show you that. A lot of times it gets even more egregious, and they will just simply cherry pick a time frame and a tool that worked really well and then just simply show it to you. They're not lying, but they're not being very forthright either. And when you first start out, all you really want to do is believe. So you'll look past anything I just said, because you want that feeling, you want that excitement, you want that to fuel you to learn something that's going to take you time and effort to learn. I get it. But that doesn't mean it's a good thing. That doesn't mean it's going to help you down the road. What it does mean is it's probably going to harm you. It harmed me. And I was looking at very reputable places like Daily FX and places like that. I wasn't really following any hype beast type traders. But still, again, almost every example I saw of technical analysis worked. And everything I saw in the future was either something working or a cherry-picked example of something working in the past. So that's all I had into my head. And again, really super motivating, made me really, really excited, but absolute death for my bank account.
Patrick, I'm really glad that I got started before this all came around. I started trading in 1997, and there just wasn't, CNBC was like brand new. CNBC had been like a thing for like 3 or 4 years. And, they did have cults of personality on the TV. And I remember the first time sorry, I got to tell this story. It's just a great story. It was in 1999. It was in 1998, and I had just shorted this stock called Wave4, WAVO is the ticker symbol, and I was down like 20%, and it was a pretty big position. And before the market opened the next day, the stock was gapping up another 3 or 4 points, and I was like, oh my gosh, this is terrible. And some guy came on TV that I'd never seen before, a really high, whiny voice, and his name was Jim Cramer. And he was a hedge fund manager at the time. And they asked him specifically about the stock I was in. And he's like, that's a piece of garbage. That's the worst stock ever. I actually just was on the phone with my broker trying to get 25,000 shares of short, but everyone's already got them short. And from that second, that stock turned down and went lower and lower and lower and lower. And I ended up being profitable. And look, it was going to go lower anyway, but Jim Cramer did it. And so for the next little bit, I really loved Jim Cramer. Whenever they had him on, I listened to him because that was the guy that saved my trade. After a while, I realized, I think I'm listening to the wrong person. Look, nothing against Cramer, love Cramer, but Just follow your own rules, your own system.
Yeah, and believe it or not, traders, there was a point in time where Jim Cramer was actually very influential and did move the market. But over time, he's got a little ahead of his skis, I would say. And, to be fair, too, he's forced to make predictions when he doesn't want to. But he does them with such confidence behind it that it really does get him in trouble when he's wrong, because people will cherry pick those too. I've done an entire blog on this. But confidence is the main thing here, traders. It all leads to overconfidence, which we've already talked about in a previous episode, is going to hurt you. So if you're really early in your trading career right now, just understand, you're not that good. Do not say, I made 30% this month and extrapolate that out throughout the entire year and extrapolate that out through 10 years. That is not ever going to be how it works. The best traders in the world could never even think of doing something like that, and it's certainly not going to happen to you. I'm sorry. But the thing is too, though, Rob, is it doesn't just happen early on. You can be maybe 1 or 2 years in and then have a really good year. And I've even told people, I'm like, look, your yearly performance is a much better barometer of how good of a trader you actually are. But I will say too, if you started your career in like 2013, 2012, like those years that you and I have talked about in the past, Rob, where the market was just so volatile and would trend for such a long time, then your actual worth as a trader was probably pretty inflated. And, we've had a couple of pretty decent years volatility-wise for trend traders in 2022, 2023. Not every year is like that. So what words of caution would you have to somebody who's put a bit of time in and just absolutely smoked 2023 and has all the confidence in the world going forward?
Well, first, let me give them a high five. I love to see traders just killing it. But let me also give you a cautionary tale. We have used the term delusions of grandeur in several episodes. And my first 10 years were a series of 20, maybe 30 periods of delusions of grandeur where I started to plan my family's future out. I learned a new strategy and I'm like, oh my gosh, this works every time. Like I learned the straddle strategy and options trading. I'm like, oh my gosh, this is all I have to do. And at first it did really well. And I'm like, this is it. I did it. I found the holy grail. And then of course markets change and it doesn't work anymore. Look, the market is huge. The market is like, look, I'm just going to use the term Godzilla. And I've heard the new Godzilla movie is fantastic. I haven't seen it yet, but I've seen a couple of Godzilla movies. You are the size of a human. The market is Godzilla. If you are not humble, it will absolutely crush you. The times that I've had my biggest losses are the times when I was not humble. So if you want to be in this game long term, stay humble. That's my advice to everybody.
Yeah, I think you and I have talked about humility in the past. And I normally don't see a real logical place for it. But in this particular situation, you're exactly right. Because anytime I used to go on a streak, I used to quote this line from The Wire. It says, even if I miss, I can't miss. And that's how I felt. And honestly, kind of tracking back a little bit to what we were saying before, with indicators, I wouldn't use the indicators in their base form. I would go out and find new ones that most people weren't using. Or I'd take common indicators and I would tweak the settings a little bit to make them better than they were before. And so that made me think, oh, this is all you really have to do. And I'm Christopher Columbus. I'm the first one to actually do something like this. And so there's a chance I probably have cracked the code. And I was actually putting a few strong months together after I blew out my first account. And I started to believe this too. So at any point in time in your career, you can really think that you have put together the perfect combination of whatever to really slingshot yourself to the front for the rest of your career. I'm going to tell you now, this is also not going to be the case because markets are different year to year. On top of that, you can have a system that really plays well in the market that's going on right now, but 2025 could be completely different. But the biggest point I want to make, Rob, and you and I have touched on this too, is there really is no substitute for experience. And in year 2 and even year 3, in my opinion, you just don't have enough.
I will totally agree, but it's probably when your confidence is the highest. We've talked about the Dunning-Kruger effect. And look, there's part of the Dunning-Kruger effect, like before you've read like one trading book and you think, well, hell, I can do this. This is going to be easy. That's one part of the Dunning-Kruger. And then of course you find out how hard it is. But then after you've been trading and you've gotten past like the first stuff and you start to get some good track record and some good results, you start to get a little bit over your skis again. It just happens. It just happens because you've done it. You've put in the work. It wasn't, you're not getting lucky. At this point, you're into year 2 and 3, grinding it out. And you now say, hey, I'm not getting lucky here. This is from me. That's when it gets dangerous. The delusions of grandeur, hey, I figured this out. I don't need to be as cautious anymore. I don't need to be as controlled as I was because I got a little bit more money. I got a little bit more this. I can throw a little money on this trade. You start to get really reckless because of that overconfidence. I think that 2 to 3 years is a really dangerous point because in the world of trading, you're like a teenager. You're like a teenage boy. At 18, the height of their confidence, the height of their ability, the height of everything, but dumb as can be.
Yeah, and speaking of the Dunning-Kruger effect, a really good illustration for me is a movie I saw a long time ago. I think it was called With Honors. It was Joe Pesci, and he was a homeless guy who ended up getting into Harvard. And the one thing I really remember from that movie was towards the end, he had this really pompous professor. The guy's like a total stereotype. I think he had glasses and a bow tie and spoke in a very posh accent, even though he was American, and would just try to browbeat Joe Pesci and the rest of the class with all of his points. And towards the end, and I remember I was younger too, so like these things have a more profound impact on me back then than it probably would now. But he said, and I never heard anything like this, but I took it with me. He said, the reason why I'm so smart, and Joe Pesci said this, not the professor, and he said, the reason why I'm so smart is because I realize I don't know anything at all. And I took that with me forever. Now, in trading Forex, I forgot about it because I got so overconfident and I thought I cracked the code 100 different times. But to that point, I really, really agree. And that was always a very easy way for me to remember it too.
Well, that reminds me of one of my favorite quotes of all time from Albert Einstein. The true sign of intelligence is an open mind. That one just always gives me, like, you've got to be open. You got to be open to, hey, maybe there is more. Maybe there's a closed mind is never going to get you anywhere. Yeah, and once you start to get those delusions of grandeur, it's like you've closed the door. Like, hey, I've done it. I don't need to do anymore. I'm on the top of the hill. Oh, that's so dangerous.
Yep, I can speak to that many, many times over. Now, as far as solutions go, though, Rob, there's 2 that I can think of. If you can think of any more, please add 1 on or 2. But there are things we've already talked about in the past. The first one is just understand from when you get in. I hope there are some newer traders out there that hear this and take this with them forever. But this is going to be a very long game. This can last the rest of your life. As long as your mind is sharp and cognizant, you can do this literally as long as there's a market to trade. So, and you're probably going to need a lot of that time too to not actually get good, but to make this sustainable. So, play the long game. Understand that it's not going to come quick at all. Honestly, if I would have been told this before I started, I might not have even started. But now that you're in it, now that the bug has bitten you, just understand you're not going to want to hear it, but this is going to be a very long play. And so the other piece of advice I would give too is something we've done an entire episode dedicated towards, and that is to have other streams of income for as long as you possibly can. It might be a very long time before trading actually becomes sustainable. I know that wasn't the dream. I know when you have these runs, especially early on, you think that I'm full of it, and it's not going to be that way. But I promise you, that is just how this game is. You know, Rob, do you disagree with any of these? Do you have any you want to add yourself?
No, I don't disagree with him. And I'm going to go fairly nihilistic here because I was really thinking about, okay, what advice could I give? And then I really realized that, well, guess what? All of these stumbling blocks, all of these things are part of the process. And I guess the biggest advice I could give you is to be self-aware enough to understand that when you just stubbed your toe, what it meant and how you got there and how you can avoid it. Because we did a whole first episode. I think our first episode, I talked about brain chemistry. I talked about how you literally are a program. You're a machine running programs. And until you get out of that, you can't be self-aware. And so, yes, there's so many things that can trip you up. Overconfidence. The biggest thing that I could say to you is like, try as much as you can to be self-aware. And I know trading beat this into me to where when I got overconfident, and Patrick, I know you've done the same thing. Now we're like, oh shit, we are paranoid. And I'm like, okay, no trading. Oh shit, I don't need to do that anymore. But I was finally self-aware enough to realize when I, to that point, I was the worst person as far as a trader goes. And I needed to just rein it in because in the past, I'd use those times to get myself in trouble. So my advice is be aware you are going to make these mistakes. And if you're aware of it, when you make the mistake, I want you to then be like, oh yeah, this is a mistake that Rob and Patrick said that I would make. And these are the ways they talked about getting over it. If you can do that, then life is like a stock chart. It just, there's pullbacks, and there's corrections. But it just keeps getting better because you are constantly getting to be a better human being. And the great thing, and I tell everyone this, learning how to be a good trader, and again, the psychological part of this, helped me make money, and that's been great. But I truly believe it's helped me be a better father, a better husband, a better son, better communicator, because I'm much more self-aware of what I do. And now, like, my wife and I used to get in fights when we were newly married. And now, and I'll be mad. I'll be like, how dare she? And then I sit and think about it. And I'm like, oh, you did this again. And sure enough, I was at least half of the problem. And then I could go in and talk about it. And we have a great talk about it. And then, like, we've been married now for 27 years. And we've both gone through this process. There's nothing left to fight about anymore. It's going to be the same thing with trading. You're going to go through these fights, be self-aware, fix the situation. In the end, there's no fights to have, and it's really, really peaceful.
It's such a great point, too, because you're so right. I have no regrets for starting this whole journey into trading. There have been so many residual benefits along the way, and I didn't even really realize them until I started talking to you, Rob. And then I look back, I'm like, man, yeah, I can... This is why I don't act this way anymore, and this is why I think of this thing over here completely different. And the same came with waiting tables. I feel like I waited tables way too long. I feel like anybody who's been in that industry probably feels the same way. But the things that I took away from it that have helped me so much now in terms of just everyday communication with people to the way I broadcast on my channel. It's no regrets at all for not only starting something, but really taking it seriously and moving forward with it and paying attention along the way too, to the things I was doing wrong and trying to hone that craft into something that was just completely streamlined the way it is now.
Let me add one last thing, and it's going to be very in your face. And this will be something that you can do in your life that will always help. Whenever something goes wrong, or whenever you don't get the results you want, or whenever you lose, it was 100% your fault. Now, look, I know that's not true. I know that there's lots of circumstances out there. But if you look at it, be like, okay, it's my fault. And I'm not talking about beat yourself up. It's your fault. It's, okay, I didn't do something. I didn't have something. I contributed to this somehow. If you go into every part of your life when you fail at something, when you don't get that job or you get fired by a job, if you always have the attitude that it was your fault, there was something you didn't do right, and next time you're going to do it right, you will do so well in life. If you If you have a victim mentality, it's going to be really tough for you to ever be self-aware enough to fix any of your problems.
I'll counter with this at the very end and say that 70% of my losses are, in fact, Jerome Powell's fault. But on that note, traders, thank you for joining us this episode, and we hope you join us on the next episode of the Trading Psychology Podcast. This is VP. Thank you for joining us.
Have a good day, everybody.
This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, it is the head of trading in Maverick Currencies. It is the resilient Rob Reinhold.
Thank you, Patrick. And you've said a lot of adjectives about me, and not many of them have been true, but resilient. Yes, I will own that one. I have been resilient. And look, anyone who gets into their later years, life is tough sometimes, and life, you get scars, you get wounds. So I think anyone who gets into their 40s or 50s, they have to be resilient just to survive.
I personally think effervescent was spot on, but we'll move on. So as everybody knows, what we're doing right now is it's actually going to be a 3-part series of psychological advantages and disadvantages of trading, but which markets? So last week, we went over Forex. And you guys have heard me say all the time, I think you should absolutely be trading, all of you should be trading Forex and metals and crypto. Now, whether you want to make the move to something like stocks, that's a big question. This is probably the number one question I used to get on my channel in the YouTube comments section is, can I use this for stocks? So there's a lot of stock traders out there. There's a lot of potential future stock traders out there now. As you know, since we have Rob on the show, as somebody who has not only traded stocks for a long time, but also dealt with so many stock traders over the years, we thought this would be a really good episode to go over the differences between the two and some of the unexpected psychological hurdles that you might encounter while trading stocks. And then also some of the advantages, some of the things where trading stocks is actually superior to trading those other markets, if this is even possible. We're going to find out. So Rob, as we often do here, go ahead and kick us off, and I'll jump in where I can. I don't know how often I'm going to be doing that this time. So just take it away.
I want to start this off like I started off the episode about Forex. Trading is trading. And I use an analogy of a car. Driving is driving. And when you know how to drive, you can drive like a small car, a large car, a race car. The mechanics are the same, but it carries a whole bunch of risk, and you got to learn different things. Like if you were going to drive a dump truck, yes, there's some buttons and some things you need to learn how to do. If you want to drive a stick shift, then yes, there are certain things you need to do, but pretty much the mechanics are the same. So when we get into these episodes, we're going to be talking about some of the differences psychologically that these products will bring. We talked about Forex, how great it was. We talked about all the advantages, and then we went over the disadvantages. And these disadvantages were very specific to Forex. One of these things like leverage. You just didn't get a chance to lever up 100 to 1 in stocks. No one has ever allowed you to do that. So leverage was a big one in Forex. I'm going to start out with the advantages of stock trading. Now, for me, the number one advantage to stock trading is there is an overall bullish bias. One of the things I love about Forex is there is no bullish bearish bias. So you can't be a long-term bull. You can't be a long-term bear. It just doesn't make any sense in Forex. Forex is pure trading. You are purely trading, hey, is this going up or down? In the stock market, there absolutely is a bullish bias. Now, I've really thought about this, and I thought about, okay, why do we have this bullish bias, and what could possibly change it to where we had like 50 years of stocks going down? Well, the two things that really guarantee that the stock market is going to go up in value over time is inflation, prices going up. So look, it's not true gains. But look, if money is inflating by 3% a year and the stock market is inflating by 3% a year, that's a zero, but the value is still going up. So as long as we have inflation, that prices are being pushed up, that is going to make an overall bullish price in stocks. And number two is population growth. Population growth, for the most part, will ensure that as we grow the population, there's going to be more and more consumers. The Federal Reserves around the world, they're going to be printing more money to keep up with this population growth. And because of that, earnings are going to go up over time, which means stock prices are going to go up over time. Let's talk about some of the benefits of this overall bullish bias. This makes it to where you really don't even have to be good at stock trading. And this is where dollar cost averaging pretty much will take away a lot of the bad investments that people make or the wrong timing that they get into, because over time things will go up. And especially if you are investing in things like ETFs, if you're trading, ETFs or mutual funds or things that are already diversified, it's pretty much a guarantee that if you get in at the wrong time and you hold, it's likely going to come back for you. Look, I'm not saying that's a good thing to do. That's a terrible thing to do as a trader. But people then get into dollar cost averaging, where when things go against them, they buy more, they buy more, they buy more. And over time, this dollar cost averaging ends up saving lots and lots of bad decisions in investing and trading.
Yeah, we've had, it's got to be so nice for the people in the financial world, whether you're a trader or an investment advisor or an institutional banker, to have pretty much the last 40 years be almost nothing but unbridled growth. Whether the stock market reflects that, it doesn't always. We have recessions and things like that. But man, you've had people who have had entire 40-year, 50-year careers and they're retired now, who've retired rich just because they were playing the market on easy mode the entire time because it did nothing but go up. That is crazy. And the reasons you said there, Rob, do make a lot of sense. Now, I will push back a little bit on one thing, and that is going forward. I think we have hit peak population. The narratives now are how like nobody's having kids because they can either not afford it or they just don't want to. It's a generational thing. I'm not sure what it is. But that and the demographic issues we're having now of a very aging population in a lot of countries, because people just stopped having kids at the same rate they were in the past. We got saved by the millennial generation in the United States, but a lot of countries didn't have a big millennial generation. That was something that was kind of unique to us. So let's say this whole thing kind of turns over. Do you think, put your prediction hat on, do you think this would be overall bullish for the economy or overall bearish? And would it stay that way? Would it still make it easy for traders to trade either on the way up or the way down?
A decline in population growth is absolutely bearish. And here's the cool thing. We have a case study of a country that literally has done this over the past 30 years. Japan. Japan is the case study for what happens when you have a declining population and an aging population that stops spending money. Because look, when you get into your 60s and 70s, you're not spending money like you were in your 20s or 30s. Japan, they had a huge bubble in the 80s, and it popped in 1990. And their stock market barely made new highs just this last year. So we're talking about 33 years of stagnation. And the economy was really bad. They could not get GDP growth up above like 1%. Most of the time it was negative. They had to go in and do things to try to stimulate people to have more kids, to have babies. Japan has been very, very tight on immigration. They've actually opened up on immigration a little bit. They looked and saw the problem that these declining demographics had, and they didn't do anything for years. They finally started to figure this out. Now, if you want to look at another country that is headed into an absolute disaster, it's China. Look at the demographics in China. They are terrible, and look what's happening to the Chinese economy over the last year or two. We're starting to see this happen as well in China. So I think it's a very fascinating concept to talk about. We got way off the subject on this, but you could tell I could talk about this forever.
Yeah, so that then begs the question. I know I can do this through the use of CFDs, but let's say I'm a stock trader for Maverick. Can I go short as easily as I can go long? Because I'm probably going to want to do that if this is going to be my future.
It's just the button next to the buy button. It's the sell button. You just hit the sell button. If you don't own it, you go short. It's very, very simple. So yeah, understanding both sides of the market is very, very important as a trader. But in stocks, again, there is a bullish bias. And so in Forex, you can be truly unbiased. In stock trading, you have to have this bias. It will help you, and it will actually make your job a little easier. But we know recessions happen. We got to be ready for bear markets. But for the most part, it's kind of like swimming with the current when you're on the long side in the market.
Okay. So sounds easy enough. If the market is going one way, I can just follow that and chase the trend. Sometimes for years, that's great. So let's take it from a psychological standpoint then. And when we talk about advantages, what are some advantages that will help somebody or at least ease the burden psychologically for a trader?
Another positive thing about the stock market is it is a game that's open for everybody. Little old grandmas, they can come into the stock market. Now, look, I'm not saying little old grandmas should be high frequency traders. But what I'm saying is they can go into the stock market and they can buy Boeing, they can buy Philip Morris, they can buy the most boring businesses, the slowest businesses they could possibly find, and be very, very safe. Here's the cool thing about the stock market. You can go find the craziest, dumbest stuff that's out there. And actually in just this last week, in the Flat Earth Trading series that I'm doing on YouTube, where we're buying stuff randomly, on the last Friday of 2023, I said, let's trade both the best performing stock of the whole year, and it was up like hundreds of %, and let's trade the worst performing stock of the year. And the worst performing stock was a stock called Mullen Automotive. They did 3 reverse splits in 2023 because if your stock is under $1, the NASDAQ kicks you off. So they did reverse splits. Their stock went down 99.6%. That's how bad it was. But because of the reverse stock splits, it came up on our radar, and that was the one we traded. That thing trades 20% a day. That was the average through range, Patrick. 20% a day. Have you ever heard about that?
Outside of crypto, no, and outside of bankrupt companies, no, I have not.
Yeah, it's absolutely insane. So here's a great thing. In Forex, yes, we know that there are some currencies that have a little bit more volatility than others. We understand that. But you don't really get to pick like super, super, super low volatility and super, super high volatility in Forex. In the stock market, you literally get to decide how much risk you want to take on. Do you want to trade the penny stocks, the crackhead stocks, I call them, to where you're trying to get that rush? Or are you going to go down the other end of the risk curve and play something really boring? And here's the cool thing that you can do with stocks is vary those. I do this all the time. When the stock market is running, I go look for high volatility. Then when the stock market stops running and starts to get a little choppy, I'll go all the way down to very low volatile stocks and play those while I'm waiting for another run to happen. So the great thing about the stock market is it gives you the opportunity to really dial up and down risk that you just don't get in Forex.
So, okay, that's nice too, but I can also make the case for that being not specific to stocks so much because I can, in a way, do that in Forex as well. Are there any particular psychological advantages that are specific to the stock market itself, in your opinion?
One of the ones that really helped me out in the beginning were the limited hours the stock market is open. I have this as both an advantage and a disadvantage on stocks. So we're going to talk about the disadvantages in a little bit. But the advantages was the stock market was open 7.5 hours a day. I could only be an idiot for 7.5 hours a day. I couldn't trade because I was bored. I couldn't do anything. I had to wait. Now, since I started trading in the 90s, after hours trading has become more of a thing. And now you can really trade from 8 a.m. to 8 p.m. Eastern time. And, the biggest stocks, maybe the biggest 200 or 300 stocks are going to have enough volume to where you still can trade them. So now you got 12 hours. They did just open up overnight trading on things like the SPY and the Qs. Those now do have overnight trading, and the volume is actually fairly decent. So one of the things that helped me out was that I didn't have access to it all the time. And when I was young and impulsive and I didn't have my discipline down, this was a real benefit to me, to where it was closed most of the time.
Yeah, I can see how that would be the case, especially for an intraday trader, because, I've told the story a million times before. I used to be this too, and I would have to start my trading session at midnight, and that's no way to live. So as people who are on the Western Hemisphere, for sure, this would be really nice to have. Even if you're just, maybe you're not a daily trader, maybe you're not intraday, but you're a swing trader. It would be just as conducive to a good lifestyle too. I do like that quite a bit. Now, how's the liquidity over on stocks compared to Forex? And is there an advantage or a disadvantage there to you?
I'm going to have to say that there is both. Just like we talked about the scale of low volatility to high volatility, every single stock is going to have different amounts of volume. Now, if you go check on Apple is going to have ridiculous volume. There's tons of volume, and so bid-ask spreads are very, very tight. Orders are really, really easy to do, and it actually works pretty well when you've automated your orders to get triggered at certain points, or you have stop orders. It works really, really well on the most heavily traded stocks. However, when you go down the line and you go down to stocks that don't have a lot of volume, all of a sudden now you've got bigger spreads, and now you've got slippage on orders. So it really depends. If you're trading high volatility, if you're trading high volume stocks, it's going to be very, very similar to Forex. And look, if you're trading Apple or if you're trading euro dollar, look, unless you have like $20 billion that you're trying to move, you're going to be able to move each one easily. Each one's going to take your order easily. Once you get down to the lower volume stocks, all of a sudden it starts to become this little game where you have to hide your orders. Now, we have some software that if I wanted to buy 40,000 shares, I can't just put that out there on a low volume stock. I go out and I do what's called a hide the order, where I show that I want to buy 500, but I will keep buying the stock endlessly until I get to my full basket that I wanted. So yes, high volume stocks, it's going to be just as easy in Forex to get a fill. Lower volume stocks, definitely a little bit more difficult. And those stocks are dangerous to automate your orders, to where, when you have stop orders or you have other kind of orders, you do get a lot more slippage on those.
Yeah, I can kind of co-sign on that too, because I don't do it often, but I will play into some of the really lower cap mining stocks, or I have before, and then you have to maintain them as well. And especially during the maintenance part, usually when you buy them, you can buy them close to when you want them, because if the spread's out of control, you can just kind of wait and it'll get back to normal. But then when you want to take some kind of profit, or if you want to bail and you don't want to sit around and wait for price to get worse, sometimes there is nobody there to take your order, which is really, really frustrating and nerve-wracking at the same time. So I guess, the moral of the story is, if you're really going to trade, you're probably not going to trade those too often, because who really wants to deal with that? That's such a luxury we have in Forex, to where we get our orders filled immediately almost all the time. But yeah, that seems like something that's pretty easy to avoid. Now there's one that I added on as far as the advantages go. And this is for anybody out there who is considering maybe selling your trades or selling yourself as somebody who's good at this. There is a really big and robust market out there for you. Now, if you're doing the same thing with Forex trades, there is also a big market, but you're dealing with the entire globe. And most of the globe probably cannot afford your product. To where, let's be honest, in the stock picking world, it's very Western-centric, especially United States and Canada. And chances are most of the people you market to, if they wanted to, would be able to afford your product. So there is a really nice little, I want to say, opportunity zone here for somebody who has gotten good at stock trading and can actually prove it. You can go to a place like Maverick and do it on a prop firm level, or you can go independent, or you can do both. Rob, I've spoken to Rob on this before. Rob is always fine with, people being entrepreneurial and going out and staking their own claim too. So there's some real opportunity that I don't think many Forex and crypto traders really consider, that is a real untapped resource. If you are good at technical analysis, you will probably be very good at stock trading, especially if there is a daily bias like Rob just said, that just works in your favor even more. And I think there's some real missed opportunity out there for some no-nonsense Forex traders, especially, who have gotten really good at trading, but who ignore stocks.
As I said earlier, trading is trading. It's really the same mechanics. If you haven't ever traded stocks before, there's going to be some new buttons that you have to learn in the car. There's going to be maybe another lever you have to figure out. But if you can chart well and you can build a system and you can follow that system, trading is trading. It doesn't matter what you're doing. And I would really recommend to do all of them. And we've recommended that in this podcast before. What I love, I tell people, I'm like a moth to flame. I've got all these markets I trade, and sometimes the Forex market isn't that good. And I say, fine, I'll go play over here. I'll go play over here where the volatility and the trends are better. And I'll play over there, and then all of a sudden that doesn't get as good. And then I say, oh, Forex has picked back up again. Let me jump back in over here. It allows you to find the market condition that matches up with your trading system. Remember, we've talked about your trading system is going to do better in one kind of market than another. If you've built a trend following system, then you want to be trading in the market that is currently experiencing the biggest trend. If you have all these markets to pick from, you can probably match up your strategy better with that market and have more consistent returns.
So it all sounds good. Sounds like a really great opportunity, but I will bet there are disadvantages to this as well, and people should be aware of them before going this route. So what disadvantages do you have after we've already covered all the advantages?
There is one disadvantage that is so absolutely terrible. Most people, when they find out about this, they say, no thanks. And that is what's called a gap. Because the stock market is closed for the majority of the day, there are news events that are happening all the time. Let's say there's a company that was at $50 a share, and it closed at $50 a share, and you said, oh, my stock that I own is $50 a share. When it opens up tomorrow, it's going to be at $50 a share. No, it's not. No, it's not. If that company comes out and there's any bad news on it, like they are being investigated by the SEC, I've seen stocks gap 80 to 90%. I've seen stocks gap to virtually zero. When you are trading stock, there is absolutely no way to protect yourself from that. There's no way to moderate that. Look, if you know how to trade options, you can buy some options to create some hedges. But if you're purely stock trading, there is a chance that sometime in your life, you will open up and the trade that you're making or the investment you made has gapped against you significantly, and you have lost all the money that you had in that. So if you had too big of a position size, you could theoretically lose all your money overnight. That's terrifying. From someone who's really serious about risk management, the thought of that even being a possibility, that keeps me up at night. So that's the biggest reason, psychological reason. And so what this does, I know that like going into weekends, I know that there are stock traders that will sell their positions that are doing really well, but they can't hack the thought of 2.5 days of worrying about news coming out, especially when you're in a period of time where there is lots of news. I remember back in, I want to say 2007, maybe 2009. I can't remember what it was, but there was a big tsunami in Japan. There was a big earthquake that caused a big tsunami that basically hit one of their nuclear reactors. And over the weekend, there was a chance that there would be a full-blown meltdown. Can you imagine holding your positions over the weekend with that? I mean, Patrick, do you have a rule for holding positions over the weekend in Forex?
So you're talking about Fukushima, which, yeah, if you were a uranium mining stockholder, that was a pretty harrowing time for you, because you're right, that did happen on a weekend, didn't it? Yeah, that would be something. Now with Forex, I used to get this question a lot. Now, I'm sure I was getting it from stock traders. And I probably got this at least once a week before I addressed it on a podcast episode. Then I got it a lot less. But they're like, well, what about gapping? Is this something you ever worry about? I'm like, in Forex, no, I really don't worry about it because, okay, it can happen on the weekend. But one, it's very rare. And two, when it does happen, there's a much better than average chance that it's not going to happen to a currency that you're involved with. And then three, gaps can also happen in your favor just as easily as they can happen against you. So if you factor all those things in, I really don't worry about gaps in Forex. And so I can imagine, yeah, quite really something you would want to avoid in stock trading, especially because if I did it, I wouldn't be trading intraday. I would be definitely holding over the weekend.
Well, let me tell you what happened with Fukushima. And again, I just want to paint this picture of psychologically. Imagine you've got your money on the line and we're going into the weekend. On Friday, you have to decide, am I going to hold over the weekend where we might have a nuclear meltdown? And guess what happened? Over the weekend, they figured it out. And by Monday, the stock market was gapping up higher. That kind of fear causes you to take actions that are outside of your trading plan because they're such incredible events. They're such incredible events. The right answer, as Patrick said, is to just hold through them. Know that some will go for you, some will go against you. Make sure you have your position sizing right. You can hold through these events if you're trading it the right way. And actually, we did a study at Maverick. I want to say this was back in, I think we took from 1990 to 2010. My premise was, if you're trading with the trend, you get more gaps for you than against you. So that was my premise. And so I wanted to see, okay, what are the odds? So I was thinking about a predictable, measurable thing we could do, and it was earnings. So in this exercise, we did not exercise, but we did some back testing, and we did it over all 500 S&P stocks for the last 20 years. And we simulated if you bought the stock that was in an uptrend, and the way we calculated uptrend was it above the 50-day moving average, or was the price of the stock below the 50-day moving average? So that was our premise. We would long at 3:59 and 59 seconds p.m. Eastern Standard Time. So basically the last trade of the day. And then the earnings would come out either that night or in the next morning, and then we'd sell it at like 9:31, so 1 minute after the market opened. So we went back and ran all the data for all 500 S&P stocks, and what we found out that there was a 59% win-loss ratio in the favor of being long an uptrending stock into earnings or being short a downtrending stock into earnings. Here was the interesting thing. The bullish side had a profit factor of about 1.3. So it was right more than wrong, and it had a profit factor of 1.3. The bearish side had a profit factor of 1.9, meaning it was better to be short downtrending stocks going into an earnings report. You actually got the bigger moves in your favor. So if you were looking at trading not as a singular event, but as a thing you're going to do for the rest of your life, understand that these gaps are going to go for you and against you. If you're using correct position size, they're going to sting sometimes, but guess what? There's been plenty of times where I woke up in my trade that I thought that was going to go from 30 to 31. The company was bought out for $55. That's really nice to wake up to in the morning. So look, they can go for you and against you. Position sizing is so important.
Okay, so it is a disadvantage psychologically, probably, but overall, if you do it right, doesn't have to be. Okay, so that's good. Now I'm looking at our outline here, Rob, and for the next disadvantage, it looks like you hit the copy paste button on one of the actual advantages. Can you please explain?
Yes, we talked about the 7.5 hour marketplace. And this is also a disadvantage. It's a disadvantage because one of the things we pointed out that was great about stock trading, it fits in very well with the 9 to 5 part of life. Fits in very, very well. Forex does not fit within that parameter. And based on your lifestyle, Forex trading might be very, very difficult for you to do. Whereas let's say you've got like a family and you've got other things, and your kids are gone from 8 a.m. till 3:30 in the afternoon. And again, everything is more normal in stock trading, but it's a very limited amount of time. So it doesn't always give you the ability to work it into your schedule. If, let's say, you have a 9-to-5 job where you're not allowed to look on your phone and make trades, stock trading is going to be absolutely impossible. You can't do it. You just can't do it. It's also bad for extroverts. Now, again, I've told you I'm a very big extrovert, and my first couple years of trading, I hated the weekends. Absolutely hated it. The second those blinky lights went off at 4 p.m. Eastern time on Friday, I was depressed. Couldn't wait. And I was that guy. And again, I now, whenever I see this from one of my Forex traders, I send them an email. The Forex market opens up at 5:15 Eastern time at Interactive Brokers, which is who we trade through. Whenever I see a trader that gets into a trade at 5:16, I know they've been waiting all weekend. As soon as it wakes up, as soon as the market opens up, they're in it. Why? Not because it was a good trade, because the spreads are awful. It's because they couldn't handle it. In the stock market, it makes it even worse for extroverts. So if that's going to be an issue for you, this is not the market. You want to go to some other markets.
And if you're unsure if you're an extrovert or an introvert as it pertains to life or trading itself, if you go back to episode 2, down below in the show notes, we have a test for you to take that will tell you just that. I think most of you probably know already, but if you're unsure, if you're on the fence, that is a place you can go. Now, I will say, too, I almost thought a disadvantage, too, would have been that this is a very Western Hemisphere-centric thing. But no, I mean, there's robust markets you can trade in Europe. There's very robust markets you can trade in Asia and Australia. So this pretty much can go for just about anybody in the world, regardless of where you are. Just one disadvantage I added kind of towards the end is when I always see people trading stocks, they usually have a news feed on in the background, like a Bloomberg or a CNBC or something like that going. To me, Rob, I can see the advantage, so you can kind of stay on top of like rogue news that might come out of nowhere. But I have always thought it's just better to shut that thing off and just, trade your system and kind of ignore everything else and don't let these external factors affect you so much. What is your take on that?
I've got a great story for this take. I used to be a news hound. I love news. And it was always like, here's the news. And I'd have to think about what it meant. And then I would go see if I could take some action on it. And I really love to trade the non-farm payrolls report, which is the first Friday of every month. I've been trading for a few years, and I ended up in Canada one time for the first Friday of the month. And I was going to trade the payrolls report. And usually I would have CNBC on, and they would tell me the numbers. I would look at the chart, and I would take in the data, the numbers, into my brain, and then I'd take a look at the first price action, and then I'd somehow try to figure out what was the most likely to happen, and then try to make a trade off that. Here was the problem. Up in Canada, sorry, Canada, but you already know this. Your TV is terrible. It's gotten better. I go to Canada quite a bit. I've got some friends up there. Your TV has gotten better. But 20 years ago, your TV was terrible. And I couldn't find any channel that had this news. And I realized, oh my gosh, I have to trade without the news. And so all I did was just trade the price action. So I traded the price action, I ended up making a decent trade, made some money, and I turned my computer off and I left for the day. At the end of the day, I realized I didn't even know if the employment report was good or bad. I didn't know what the numbers were. And I realized having the news on was hurting me. So for the next couple years, I would always turn off the TV before the employment report came out because I didn't want that stimulus. I wanted to purely trade price action. So I'm a huge believer with you that news feeds are terrible. They're going to get you to think. They're going to get you to feel. And again, it's thoughts lead to feelings. Feelings lead to actions. TLA. If that news gets you to think, you're going to start to feel fear. You're going to start to feel something. And that is what caused you to take action, which is not what your plan was all set up for, was for you to take action off of a thought. So, yeah, news is a huge thing in the stock market. It's not a huge thing in Forex, except around, little events. But it's a huge thing in the stock market. I highly recommend you cancel all of that. Just trade the price action on the chart. Again, just trade your system. Just trade your system. Whatever you decided, this is your entry points. Nothing on a TV, nothing on a newspaper should make you change that whatsoever.
Yeah, I would have to second that. Just from my experience with news in the Forex world too, I'm sure it's way worse in stocks. But a lot of times, I'm sure this happens there too. You'll have news that's very positive, and then the stock goes down, and then the same news people will come back and try to explain it away, like, oh, it was already priced in, or oh, we have these other headwinds over here. And it's like, well, why didn't you say that before the news event came out? Why are you saying it after the fact? That always really frustrated me, and that just made me just hit the quit button on news altogether. So I'm glad to hear you say that. Yeah, this just goes for anything, guys. Take all that external stuff out and just trade your system. It's going to be 100 times better. So
one last thing I see is that certain stocks get this cult of personality. And look, I'm going to say stuff like Tesla, Nvidia. And what happens is people get attached to these stocks like they're friends. Well, I made a lot of money on Nvidia, so I'm going to trade Nvidia next time. Like, that's the dumbest thing in the world. And they get to know about, the CEO. I really like the CEO, or I don't like the CEO. When I first started trading, I could never go long a company that had slighted me in any way, or if I didn't like their product. If I didn't like their product, they were only short candidates. If I liked their product, I could only go long. I could never go short. And the first time I broke this was when TiVo, now I'm really dating myself, those of you that are older will know, TiVo was the first chance to never watch a commercial when you're watching TV. It was awesome. You didn't need a VCR or anything. It was awesome. And we loved our TiVo. And TiVo stock came up as a short. And before then, I couldn't short a stock that I loved, the company. And this time I say, yeah, but this is such a good short. So I shorted TiVo. It went down. I made some money. And when I got out of it, I still liked TiVo. And I realized, I don't have to connect the two. Just because I love Elon Musk, I can still be short Tesla. Or guess what? If I hate Elon Musk, I can be long Tesla. But with stocks, we attach all these strings to these stocks, and they don't mean anything. The price is either going to go up or down based on supply and demand. But you think, I've done research on this company, I drive a Tesla, or I use this kind of device. All that stuff leads you to be biased, and it's really, really negative in the market of trading. So this, again, one of the biggest disadvantages of stocks is people get married, people get attached to these things, people think they know this or this. Look, it's just as simple. That's all it is. So those are the disadvantages of stocks. As I said, it should be something you do, probably not the only thing you do.
Yeah, and something you said too, never let anybody you know who also trades stocks influence you. Your average home trader is usually way, way, way in the hole, but they did really well on one stock, and that's always the story you're going to hear, how they did really well on Tesla or something like that. They will always omit all the futility they had and all the times they lost their ass and how actually in the red their overall account is, because most people you talk to who, quote, dabble in the stock market, that's typically where they are. So just don't let those people get you all excited about trading. That's one thing I've learned over time too. Now, kind of starting to wrap things up here, I should say. What are the things that just people need to consider overall when they ask themselves the question, is this a route I should take? Because I feel like it's a big investment in time and effort and money and psychology as well. This is not a step that everybody wants to take. But the question is, should they? And if that answer is yes, what are some things they have to really take into consideration before making that step?
Great question. And I'm definitely going to ruffle some feathers here, which I love to do because I push and I'm kind of a jerk about certain things that I want people to change. And this is going to be one of them. Look, a stock is just as simple. Everything is just as simple. And sometimes symbols go up and sometimes symbols go down. So yeah, there's no reason to not trade stocks. Once you fully understand the vehicle and you understand how to handle gaps and stuff like that, it's just like a car. But the last disadvantage I talked about is very real. And whenever I see people with watch lists, oh my gosh, I go bananas. A watch list, and look, 20, 25 years ago, you had to have a watch list, which meant, I had a watch list. I had 30 stocks on this watch list. And every so often, I'd add a new one. Ooh, this is my new one I'm going to put on my watch list. And then every so often, I'd kick one out. I don't like this one anymore. And these 30 stocks, I would watch. And that's all I would trade. Because it's all I could see. It's all that was in front of me. Now they have scanning and screener programs. We use FinViz. FinViz is free. It's awesome. You basically say, I want a stock that's trading 10% above its 20-day moving average with an RSI going up of 60, and that is greater than 2 million shares a day in volume, and this or this. You click a button and it gives you 7. That's how you need to trade stocks. If you have a watch list, throw it away. And like I said, I know that I'm ruffling some feathers here. I know some of you got your watch lists. You got your stocks, and I know there's Microsoft on there. I know there's Tesla. I know there's NVIDIA. I know it. Having that watch list is biasing you so much you don't even realize it. Ditch your stock watch list. Figure out what you're going to trade. Go to a screener. If Microsoft pops up on the screener, trade it. But you don't start there. So that's my biggest thing I really want to get to people who are looking to trade stocks. Do not have a watch list, because you will get somehow connected to those and think they're special when they're just as simple. Never have a watch list. Use screeners. There's my rant and rave, Patrick.
I did not expect that answer at all. I thought you were going to go way down a psychological rabbit hole that I would probably expect you to go down, but that was completely unexpected. But great advice nonetheless. Yeah, I think one of the biggest themes in this episode is how people just get married to stocks because of the story or because it's how it's treated them in the past. And that's one of the really big things that just takes them out from the start. So good. No, I'm actually glad you brought that up. Now, my last question before we completely close down here is, do you have no-nonsense Forex traders in your stock division over at Maverick?
We absolutely do. But let me just tell you this. We don't trade a lot of stocks. We use stocks as a way to hedge out our options positions. Look, we have some pure stock traders. I'd say less than 5% of Maverick traders are pure stock traders. We use stocks as hedges to options positions.
Interesting, and a bit of a foreshadowing to our next episode. But until then, thank you everybody for joining us here at the Trading Psychology Podcast. Rob and I will both see you next week.
Goodbye, everybody.
This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex, and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, it is the well-traveled Rob Reinhold.
Hey, everybody. Nice to be here. And speaking of well-traveled, I'm about to be even more well-traveled after this episode.
Yeah, if you guys don't know, we're shooting a bunch together because Rob is going on vacation. And part of that vacation involves being off the grid. So we won't be able to contact him or shoot podcast episodes. So we're doing a lot of these in advance, but that's okay. None of these are really time sensitive, especially this one. This was actually a suggestion from a user. We ask for those from time to time. And at any point in time, traders, if you want to get into the comments section on YouTube and suggest an episode that we haven't done yet, feel free to do so. We're always welcoming ideas from you. Because I like the ideas that we come up with, but it's even more special and more organic if it comes from the actual audience. So this one is on perfectionism, which I thought, Rob, was a really, really great suggestion because I have suffered from this myself. You told me off camera you think you know why, so we'll get to that as well. But is this something, is ever something that has bothered you at any point in time, or does your own personality type just not really fall into this?
My personality type does not fall into this. And, growing up as a kid, I was never really concerned about perfection. I just wasn't concerned about it. I was more concerned about getting stuff done than ever was about perfection. Obviously, other kids did better than me in certain things, and I didn't seem to have much of an issue with it at that age.
I certainly did, and maybe it stems from what you and I had talked about in the past, how I was kind of ordained the smart kid in school, and so everything I did from intellectual and academic standpoint, I always felt needed to be like just the absolute best because I wasn't good at anything else. This is the one thing that really defined me. It was my identity. So I always, just really, really tried to make everything perfect, and no, it did not serve me very well. And then, later in life, it really started to get in my way.
Well, Patrick, I want to jump in and just point out that, yes, perfectionism can be driven by your internal monologue, meaning who you are. There are some people that are born that are just meant to, really strive. However, this is something I see from external sources, probably even more than internal sources. Imagine that you grew up in a family where perfectionism was demanded. It was expected. It was demanded. And all of a sudden, you are now in a situation where you are forced to be perfect at a young age, and you're forced to be this way. Then it's very tough to go out in life and kind of unwind that stuff as you're, in the teenage years. And so you're going to keep repeating that as well. So I see this either at someone who has a very, very demanding childhood with demanding parents that say you must be perfect, you must get an A, you must be at the top of the class. And I also see it on the exact opposite. Maybe a kid who grows up in a family that's not so great. And they've got a chip on their shoulder and they got something to prove. They're going to prove they're not like their environment. They're not like their parents. They're not like their family. And that fire drives them through their whole life. So I think this is really, it could be internal, but I think externally it's probably more common.
All right, well, we'll dive into that a little bit here. Before we do, let me go ahead and define kind of the two sections I want to get into here when it comes to actual trading. We can talk about other things and how it might tie into trading, but as far as trading goes, the two areas that I see this come into play the most is when you're first building a system and putting it together, and the second part is when you're actually trading the system. So let's get into the first one first. When you're building a system, and again, I've been affected by this a lot. I had to get over it because I just wasn't moving forward. And I noticed that. And I always felt like I was up against the clock a little bit in terms of, I really got to get good at this fast. I can't just sit there and needle pick everything. But it still affected me. And what I would often say to myself when I was putting this together, keep in mind I was using indicators and I was discovering this whole world of untapped treasure that really there wasn't any reference on. So I would find something good that would work, but in my mind, I'm like, Rob, why should I even get started with this when I know that there's probably better tools out there? I mean, I'm going to be committing, a year or so just to testing this out with fake money and real money, back testing, forward testing, all that. It makes perfect sense to me, at the time at least, to just go ahead and keep searching for better and better indicators and make this thing as perfect as I possibly can. What are there any flaws you see with that logic?
I wouldn't say flaws. Well, okay, yes, I'll say flaws. Once a month, I meet with my recruiters and we talk about potential people we are going to bring on board. And we talk about some of the, I'll just say funny interviews that they have. And there's been several times over the last 15 years where they will have someone who's been working on their system for 17 years, has never made a real trade, but they've been working on their system for 17 years. And that's just mind-blowing. I can't even fathom that. So look, there's nothing wrong with back testing. There's nothing wrong with, making sure everything's right and crossing the T's and dotting the I's. But at some point, you got to get it over the finish line. So if you're not over the finish line, it's time to get it over the finish line.
Yeah, that kind of leads me into my second point here, but I want to close on the first one because I do find a really big flaw in the logic that I presented earlier. And it is this: if you keep trying to search for something better and better all the time before even starting, you're never going to start. Like you said, that might be what this guy was doing. That might have been his inner monologue, because you're just going to keep chasing that rabbit further and further, and there is no end game. Where's the end game? If you always think there's something better out there, It's only going to lead you to, I guess, analysis paralysis and never start, which is horrifying. I would hate to see wasted talent because of this one reason. So if this is happening to you, mark my words, we're going to go over solutions at the bottom of the show. But if this is something that you have even said to yourself one time, make sure you keep listening to the rest of this episode. But the other reason is something I think you touched on too, Rob. I think there's an inner monologue with people as well, to where the real reason why they're doing this is because they're too in love with the process and they're actually afraid to start trading. Because testing everything takes no money. It just takes time. Trading actually has the threat of losing money, and that's just crippling to them. Do you think that's a possibility? Because I always figured that really could be a reason why people never get off the ground.
I don't think it's just the possibility. I think that is the exact reason. That right there, the exact reason. They're scared to fail. And look, and I get it. Scared to fail. And especially, I actually think the longer you spend putting together a system, the more invested you are in this thing never being tested so it doesn't possibly fail. I actually think if you put 10 years of your life into a system and then you finally decided you're going to test it out, and then find out it failed and you look back at all of your work as meaningless. No, look, you shouldn't look at it as meaningless. You learned a lot of stuff, but there's that binary thinking that, hey, it's either got to work or it doesn't. I think the main reason, pretty much the only reason people wouldn't start was fear.
Yeah, and then on to the next part, because I think fear carries over here. When you're actually trading your system, let's say you're trading it for a firm, trading it with real money, or you're trading it on demo and trying to present it to somebody to get hired or to sell signals, whatever you're doing, when it actually means something. And you end up taking a series of losses, or you have a couple bad months strung together. And now doubt is creeping in. Maybe this to you is the right time to go back to the drawing board and tweak things. I don't think it is, Rob. Can you make the case either way?
Oh, I can definitely make the case either way. Unless there's some real flaw that you just blew it. Like if you just blew something, I didn't think of that. But if you take it offline, that is the biggest mistake you could do. Now look, you could do stuff like leave it online, but at 1/10 of a position size. I get that. Okay. But you can't just take it offline. I mean, that's how systems work. You have to have all the data so you can actually, if in the end you want to make some changes, you have this really robust data. If you go for 2 months and then something happens and you take it offline, you are just killing yourself. That is a bad idea.
Yeah, and Rob made a really good point there. And I want to express this to everybody else too in different words. Even when you are trading real time for real money, you are still collecting data. The data collection part of your career right now, especially early on when you're doing this, is probably more important than anything you did before or after. So you need to keep going. I say this all the time too. When you back tested your system, it had a lot of losses strung together at some point. It put together bad months at some point. You just didn't see it happen. And the computer doesn't care. So the reason it was able to do so well is it withstood those, and instead of saying, okay, I'm going to take a break or go back to the drawing board or tweak this system, it just kept going. And when it did that, it ended up giving you the results that you sit there and are trying to achieve from this point forward. It was obviously good enough for you then. So yeah, exactly. We've talked about this before on the show. There's no real reason to take a break unless there's external things happening in your life. If you're just flat out losing, you just have to keep going forward. I don't think that's the right way. Now, the other thing that I put, this is kind of a side note, really, when you're trading a system is, I have something called the Indicator Profile series on my show where we're showing some really great indicators. We test them out. Some of them give you really great results. You might be tempted to introduce one of those into your system on the fly because it did really well, right? Probably not the move either. Again, I don't want to get too far ahead in the solutions here, Rob, but do you have anything to add to this?
A/B testing is the only way to know if it's good or not. So keep testing your system and then build an identical system next to it, run it right next to it, and you can just run it in demo if you want, and then collect the data after 2-3 months, whatever you want. Look at the data, and then maybe you could enter it. A/B testing is what every trader should be doing. Anytime you say, I wonder if A/B tested.
Rob likes to jump ahead of the solutions early, but that's fine.
I didn't even read that. Sorry.
Yeah, we have some other takes on that too, but part of what you said is part of the solution, so I will save it for then. But before we I want to rehash the problems and then go ahead and get into the solutions. But before I do that, Rob, you were telling me something very interesting. Back in episode, I think it was 2 of the Trading Psychology podcast, we all took personality tests. And you're saying there are certain personalities that are very, very susceptible to falling into this perfectionism trap, and there's certain ones that aren't. Do you care to kind of go over that real quick before we move forward?
Yes, I would love to go over it, because when we look at the reasons why you do what you do and why I do what I do, we think it's because of the things that we're thinking, or like our willpower or our ability to learn from mistakes. No, it's none of that. It is so much more core to us than that, and that's our personality. Now, in your Myers-Briggs personality style test, you've got the first letter is for extrovert or introvert. This doesn't really apply to that. This could be universal to those two. If you are an N, so like I am an ENTP. N means intuitive, meaning I don't need to know all the nuts and bolts of how it works. I just need to know how it works. An N is very unlikely to be a perfectionist. Very unlikely. If you are an S, a sensor, meaning you need to know how the wheels turn on the car before you can really get in the car, because you got to know how it works, that is going to be a precursor to you obsessing over things, saying, I got to know it all before I can move on. The next letter is you're either a thinker or a feeler. If you're a feeler, don't worry, this isn't going to affect you. If you're a thinker, then yeah, your brain works very linear. And so, everything is in a line, and if things are out of line, you have a hard time moving forward on those. And then the last one, you either have a P, perceptive, which is, hey, I see shades of gray, that's me. Or you get the J's that are very rigid in their thinking. And for a J, it either works or it doesn't. It's good or it's bad. It's good or it's evil. And so it's very difficult if you are either an ESTJ or an ISTJ, you probably know exactly what I'm talking about. You will definitely fall into this, again, paralysis by analysis, need for perfectionism, need for all the answers. So if you know that, if you've taken the personality test and you know that, and let's say you're young. Now, if you're old, you already know this, but let's say you're 19 and you're like, oh my gosh, all of a sudden you realize that's why I do what I do. And in that episode, we said, don't try to change it. Embrace it. It's who you are. You have so many strengths with that combination of personality. But there's negatives behind every personality trait. Learn those negatives. Learn what they are. Be on the lookout for them. Put in guardrails, so when you start to go too far one way, those guardrails put you back in place. It's going to be really, really powerful for you to know that as a younger person. Look, those of you that are like me and they're almost 50s or 60s or 70s, we've already come to terms with it.
Yeah, I think that's one of the most important episodes we have done. So if you don't remember that one, or if you never took the test, go back to episode 2. If your podcast player doesn't go that far, just know we put all these on YouTube, and it's certainly on YouTube, and you can just click on the playlist and scroll back. And the link for the test is in the show notes of that episode, and you can find out where you fall too. But regardless of what type of personality you are and whether you are susceptible to this, even if you are, it doesn't make it okay. The biggest problems are, kind of the obvious. Perfect is always the enemy of great. Rob and I were talking a bit about off camera. Unless you're like a high-level professional athlete or a musical virtuoso, there's just no real need for anything like that, and you're probably going to end up doing more harm than good. And then the worst thing, like what Rob talked about with that guy who's been testing for 17 years is you may never end up actually trading if you always think there's something better out there. You're right, there could be something better out there, but you can crack that 0.1% simply by just being great and not being perfect. We've said before, it's all how you follow your system more than the actual system itself. It's much, much more the latter than it is the former. So just remember that going forward. Rob, do you have anything to add to that before we get to the solutions? Any other problems you can see with somebody like this in terms of how they're going to end up waylaying their own career, or anything that I haven't mentioned yet?
I just want to bring up something we talked about in earlier episodes called the Yerkes-Dodson law. And it's basically you put in too little effort, it doesn't matter as much, or it doesn't matter enough for you to be in the optimal state. If you put in too much time and effort and worry about it too much, all of a sudden you have stress and all the negatives and you end up underperforming. There's a book called, I want to say it's called Get in the Flow, or I don't know what it is. It's a great book. Sorry, I don't have a better answer here for it, but look it up. It's about basically getting in the flow of life and like finding your flow and finding your spot. That's the best place you can be in because it's kind of effortless. You're in the current, you're in the flow. So just let it take you. Find that homeostasis where you're working hard enough to, you have to put in the work to be successful at this, but you're not doing damage. And I think you said that earlier, Patrick, is sometimes you go too far and you actually do damage.
Yeah, I'm always trying to improve my system, but I'm not dedicating a ton of time to it. And when I trade, I legit don't care about the results. I just enter the trades and I come back the next day and I see what I have to do. And I just treat it like a job, like a very bland data entry type job. And my trading's never been better. But as far as the solutions to perfectionism, actually go, I'm going to give mine, Rob, and then I want you to add yours if you have one, or two or more. But the first one is to just dance with the girl that brought you. All right. You put together a system. It performs really well in backtesting. Now, what you really have to see at this point is how well can you follow it? And if you can follow a system that performs well, really well, you're probably going to do really great. And if you're journaling, and if you're doing it the right way, you'll actually know this answer. If you're not, then you're probably not going to know this answer. You're going to have to guess, which is terrible. But dance with the girl that brought you and see how far it goes. Then, if you find better ways to do things, then on a separate demo account, that can be your little laboratory while you do things in the background.
So sort of like a side chick, Patrick? Like you got your main girl and then you get a side chick?
Yeah, and the great thing is they'll never know about each other. So you get the best of both worlds. So you get to find out two things. One, can this system actually be better? And two, how well can I follow the system? And you don't have to do this in alternate years. You can do it at the same time. This is the best time saver I can even think of. Rob, do you have any other solutions that I haven't come up with yet?
I do. And we're talking about, someone who's built a system and they're just worried that it's just not there yet. It's not perfect. They haven't tested it in every situation. They haven't done this and this. That's a really common way for Jays to think. It's kind of like all or nothing. Like, oh my gosh, this pool, it looks so deep. The water looks so cold. Like, I don't know if I want to jump in it. Do I not want to jump in it? Put a toe in. Put a toe in. It's going to be okay. Put a toe in. So if you're like hesitating and holding back, then in your mind, you're thinking, oh my gosh, I put this money in. I put it on the line. I lose it all. What's going to happen to me? That's all or nothing. And that causes paralysis because then you think about all the negative things that might happen. And so then you actually don't end up taking action. Scale. It's all scale. If you made a trade and your risk was, $1, okay. Now look, you're not going to make any money, but you can at least get in the water. You can put that toe in. So if you are feeling that fear that, should I get in? Should I get out? You don't have to jump in the deep end of the pool. Dip a toe in, run your system, then put your foot in, keep running it, and then put your whole leg in, and eventually you'll be in the water.
So I'm going to kind of end with this question to you, Rob. And it's an interesting question because let's say I'm doing what VP just said to do. I'm running this system that I tested a while back. I'm trading real money. And I'm also testing other things in the background. And in the background, I came up with a system that really outperforms the one I'm running. And so now in the back of my mind, I know that my results could be even better. What should I do now? Because this is going to eat at me if I don't at least try this other system. But I may end up having to scrap the one I'm using, and I've already put in so much time and effort and testing to this system. And I'm like, I'm almost there, but over here on the other side, I have this other thing that could work even better. And I know my perfectionism is eating at me again, but I mean, I'm kind of making a case here, aren't I?
Not really. And I say that as, when you look at things in a binary nature, oh my gosh, do I throw my old system away and trade this new system, or do I stay with my old system? That binary way of thinking causes paralysis. It just causes paralysis because, yeah, you're making a huge decision. So the question I always have is, hey, is there something you can do in the middle? Is there something you can do to phase this in over time where maybe you take 10% of your money out of your main account, put it in this account, and then you determine every month I'm going to take 10% out of that one, put into this one, and then at 6 months you've got 50-50 of your money, and then you can really see which one's best. And then at some point you may say, hey, let me put the rest of my money over the new system. Binary thinking it causes lots and lots of psychological issues because when you go from black to white, it's such a difference. And there's real serious consequences when you go from absolute black to absolute white. The consequences are really big. When you go from white to beige, it's not that big of a deal. And then you can just keep working your way up, and eventually you can get over to black. And it was a very comfortable way to do it. So my advice is stop the binary thinking, figure out some way to mix them all together, and it's going to be much more comfortable.
Yeah, that was pretty much going to be my advice too. It's not like our side chick analogy to where if you're going to get married, you kind of have to pick one of them. Unless you're from Rob's neck of the woods, then you can have two. But most people aren't. So what you would have to do in this situation instead, because you don't have to pick just one. You can trade both systems. Like Rob said, kind of migrate some funds or some time or whatever over to the other one and then run them simultaneously. It is going to take a little more time, but if you really do think you have something that is going to perform even better, then you probably owe it to yourself to give it a try. You want to have some kind of closure there. So I definitely support that. So anything else, Rob, before we wrap it up here?
No, I think we covered this one really nicely here.
I think so too. And I want to thank you all for joining us here at the Trading Psychology Podcast. Rob and I will see you next episode.
Goodbye, everybody.
This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, it is the king of Northern Utah. It's Rob Reinhold.
Thank you very much. And yes, I'm about to build my moat. So get ready for some travel issues in that area. No, it's good to be here. Again, absolutely loving talking about psychology. I have spent the last 15 years just diving into every single thing I can about learning about the human brain, how we work, all the hormones that go around in our system, and how we make decisions. It is absolutely fascinating. And I never thought that this was the part about trading that I would need to master. I always thought it was the charts. I always thought, I just need to master the charts. Problem is, I couldn't do it all the time. Learning psychology is where you will become a pro at this.
And speaking of pro, always remember, we don't bring it up too much anymore because we figure most of you already know, but every episode is brought to us by Maverick Trading. All links are down below. If you just want to go check out Rob's Flat Earth Trading YouTube channel, very cool, a really good place to learn a lot of things we're talking about right now and actually see it in action. And if you actually want to go pro with the greatest prop firm, all the links are down there as well. Now, moving on to this episode, and it's going to be a branch off of the ego episode we just did. If you haven't figured out by now, we're kind of taking slivers of things we spoke about in the past and taking those topics and isolating them and then drilling down even further. Because at the very least, I feel like we're going to be talking about encounters that you have probably had in your trading at some point, so you can definitely relate to it. But then there's a whole new set of solutions that proliferate from this as well. So with the validation episode, we're not even going to really get to the crux, to the problem at hand until later in the episode. What I really want to do early on here, Rob, is talk about the importance of validation, especially for males. I know we have some females who listen to this show too. Maybe this does apply to you, but I do know for the most part, if you were to ask somebody to be completely honest and say, hey, what would you rather have? If there are only two choices, would you rather have a lot of money and not a lot of respect? Or would you rather have respect and not a lot of money? I think the majority of people would choose the latter. I know for myself, growing up, I would have absolutely chose the latter. I mean, people know me pretty well here, and they also don't know, well, they also know that I'm pretty private and I don't like to overshare. So I even feel weird like talking about things like this. But when I was younger, you guys know I approach things differently than most people do, and I strongly feel because of my ego that my way is the right way. And I would always be around people that had problems that they would talk about or ask me my opinion on. And it was just like the silliest, easily to solve problem to me. And so I would give my opinion on it. And it would make sense to them, but they would never actually take my advice. And then their problems just got worse and worse. Every once in a while, they would take my advice, and lo and behold, it was exactly what they needed to hear and exactly what they needed to do. I'm like, yes, yeah, I know, right? That's how you should approach this. But then I would give that same person advice later, and they wouldn't take it. It was just so frustrating. And everywhere I worked, I always felt like I knew the way things should run and the way things should go, but I always felt like I was on an island. And so I do know that it was so validating to me. There's two moments of validation I'm going to talk about today, but the first one was starting this YouTube channel, you know, feeling like I'm on an island again with the way I trade, but knowing that it works and knowing that if I just put it out there, other people will be able to see this too. And it did. And honestly, I felt like, man, after it was all said and done, and I was a few years in and people have seen it and it's worked and they're turning pro and it's exactly what they needed to hear and exactly what they needed to do, I'm like, you know what? If I die tomorrow, I will not die unfulfilled because I got the validation for myself that I have been looking for pretty much my entire life. That's how powerful it was for me. Rob, do you have any input on that? Or do you have, I'm sure you were validated in a lot of ways too, over time. Can you relate to this at all? Like, am I on an island again here? Or is this actually triggering a lot of memories for you too?
Well, look, Patrick, I'm a human being, and I've definitely gone through this just like you. And so I really want to take your example that you just gave and really talk about what validation means. So you had an idea. You had a way you looked at yourself, and that was an ego. And we talked about that in the ego episode. Your ego is what you think about yourself and the way you want other people to think about you as well. And so you had this plan, and you went out and you put in time, you put in effort, you put in money, you put in blood, sweat, and tears. And we use validation as a way to check and see whether or not our actions and our efforts are being rewarded. And that's really what this validation is. And you said that, you went out there, you took a risk that not many other people would want to take. And all the things that have happened have been this validation for you, that all of your time and effort and blood, sweat, and tears were worth it. That's how validation works, is it simply cements our ego. It tells us, hey, what you did, the time and effort you did was worthwhile. And that's what it's all about with validation.
Yeah, I just think it's supremely important and extremely powerful for a lot of people, especially if you just never had it for most of your life, even though you felt like you should have at some point. I feel like it's a big void in a lot of people's lives. And it was a really big moment for me when that void got closed. And so, don't get me wrong. The point of this episode is not for me to sit here and pat myself on the head, the entire time. It's to mention my moments and what this one I'm about to talk about actually did to me. Because this can be really dangerous too, depending on when it happens to you. So that's the whole point. So the other validation I was going to talk about is what you were just saying, Rob, is when I put this system together. At some point, I got really frustrated with the way the entire world was trading, and I decided to break off on my own, which is ridiculous if you think about it. Because if everybody, even really smart people, are doing this a certain way, well, then it's just a matter of doing things that way and then just doing it better than everybody else. If the answer was somewhere else, somebody by now would have already come up with it. All right. And so it was a little bit of an anti-ego moment for me. And it's like, well, am I really, there's no way I can be this much of a pioneer in 2012 or 2013 whenever I started doing this. I'm like, that. It really, I was doubting myself a lot when this thing first happened. And I also knew too that it was going to take a long time. So I'm like, if you're going to take a chance like this, I mean, it's going to take a while to research and discover and put together. This is a big move. Why don't you just stay with what you know and get better at this? It was a big, push and pull for me, but I went my own way and I put it together and it worked. The problem is it started working kind of right away and it worked too early. That's the big, I guess, takeaway from this episode really is I think for a lot of people, no matter when you started this game, you first learned how to trade. And for some reason, when you first learned technical analysis, lo and behold, every example they showed you worked like a freaking charm. And they showed you a trend line. Every time it broke, it went one way. Every time it rebounded, it went the other way. And you're like, wow, that's all I got to do? And in truth, trading is different. But once you start applying these things, I will bet most people listening to this right now started applying these techniques they used into real trading, demo trading, whatever it was when you actually started doing this yourself. And did it fail miserably, or did it actually work pretty well? Or did it work kind of well and you were so euphoric you just want to remember those really good times? I'll bet you it was B. I'll bet you it was actually working for you pretty well. And when that happened, it gave you this validation that you may have never had your entire life. And that void we just talked about finally closed. And the crazy cocaine-induced euphoria that something like that can produce is going to lead to nothing but a blown out account. And that's exactly what it did for me 3 times. Is this making any sense to you, Rob? Can you relate to this at all?
Probably the most common story amongst traders is that people did really, really well in a demo account, got all that confidence, all that validation, and then went out into the live market and found out it's a lot tougher in the live market than it is in a demo account. Why? Because psychology. In a demo account, there's no psychological problems to deal with, there's no fear, there's no anything. But once you get into it, it actually is tough. So again, either that is a very common story, or the other common story is that people got into trading and they went live right away and they had a lot of success early on, and then they ended up giving up all their gains because they didn't have all the skills they needed to succeed. Those are the 2 most common things I see. And yes, that absolutely sets people up for some real problems in trading to get that validation of you got it, you're a genius, you can make a profit, and go out there, because then you don't have all the skills to back it up.
And yeah, the only frame of reference I can use is my own system. But, people are learning somebody else's system, but they're using different variations of it that they created themselves. So that validation, I think, is even more magnified because you're not just copying somebody else's system. You're actually making it yours. And I'm telling you, Rob, I see so many comments, especially in the earlier videos, even now, of people who act like they just discovered religion. They're like, well, for the first time, I'm actually killing it. Now I've gotten 200%, 300% returns, all thanks to you. Thank you so much. And I get this like dagger feeling in my stomach to where I'm like, oh man, I really hope I still see you 12 months from now because I don't think I'm going to. I think the letdown and reality hitting you is going to be so severe. And that validation that you feel like you have right now is going to be shattered later on. And how are you going to handle that? I don't know the answers to these questions, but I'm dreading them every time I see this. I want to congratulate them, but I'm not going to congratulate them because I know this isn't going to last. And I know the come down is going to be freaking brutal.
Whenever someone tells me they made 200% in a short period of time, I want to take the other side of all their trades going forward, because what that tells me is that they were, number one, over position size. They were trading way too large to make. If you could make 200% in a month, you were wildly over position sizing. And I know that once you get a statistical guarantee of 4 or 5 losers in a row, your account's at zero. That's how it works if you do too much in every single trade. Look, it's just like rolling dice. There is a period of time where you will roll the same number 3 times in a row. That is a statistical guarantee. It's not very likely, but it is going to happen. When that happens, you're guaranteed to lose. So yeah, whenever I hear someone that had all the success and they give me really high returns, I know that they are a flash in the pan and they don't have the skills to make it long term.
Yeah, so for those of you listening at home, you've probably heard us talk about these types of things before. But the reason I put this episode together is because I really feel like validation is at the core of a lot of it. And it's something we haven't really touched on that much because for me, it was such a powerful thing and such a life-changing event for me once I finally got it for real. Because I just know for me, there was life before it was one way and life after it was a completely different way. So I know how important that middle part is, especially transitioning people from a world where they don't feel like they ever get validated for their thoughts and opinions and beliefs to a world where they do. Such a big difference. And you can achieve that through trading. And if you have it too early, you think you have it, but you actually don't. I don't want to see people out there get completely crushed and not want to jump back into trading. Because like you said, Rob, most people listening to this show right now had early success. I think if people had early failure, they might immediately think, oh, well, this is a crock of shit. Everything this person taught me isn't even real. Why did I waste my time? And then they move on. It's usually the people that had that success early that got this false validation turned into the lifers that we see in front of us right now, for better or for worse. So the big question is, and this is where I want you to come in, Rob, because you're so good with stuff like this. What are the solutions? If we got validated too early and we're still chasing that high, what are some things we can do to prevent ourselves from doing that? Because there's all that direction only leads one way, and it's not good.
Well, the solution to this is actually fairly simple. It's not easy, but it's simple. We are really bad as human beings to tying our, quote, success to monetary results. And that's where you really need to just change that. We have no control over the monetary results of any trade you take or any series of trades you take. There's so many things that are out of your control, market conditions, volatility, so many things are outside of your control. When you start to tie validation to your financial numbers, you're setting yourself up for some real failures down the line. So when we first get into trading, we say, oh, my ego, and again, how I look at myself and how I want other people to look at me, especially if like your family isn't completely behind what you're doing. I told the story of how my dad wasn't on board with what I was doing. He's like, yeah, you got to go to college. So when this trading thing doesn't work out, you'll have something to fall back on. So when you're putting yourself out there, when people are watching you to see if you have success, boy, that is a lot riding on that ego of yours. And if you use monetary gain as your validation, and remember, validation is the confirmation that what you're doing, the time and effort, blood, sweat, and tears that you're putting into this is worth doing. When you tie it to money, you're just asking for trouble. Yes, you might have some good periods. What are you going to do in the bad periods? So you need to completely change your reward mechanism for validation. Change those to non-monetary events. Change it to things like, I'm trying to achieve a certain win-loss percentage this month. I'm trying to achieve a certain profit factor this month. I'm trying to do certain things. My goal is this month, I'm not going to deviate from my plan once, because last month I did it once. This month, I'm not going to do it at all. Do you see when you start to tie the payoff, the validation, to things you actually have control over, then you can get the validation you're looking for, and it can be a constant stream of validation, because validation is a very positive thing. If you don't get validation, you're not going to work as hard going forward because you didn't get the validation. So the secret is tie quote unquote success to things you actually have control over.
And I would just push back a little and say that, you don't really have a lot of control over what you do month to month. But I know exactly what you're saying. And it kind of ties into the other solution that we have written down here. And this is something we've talked about a lot. If you can tie your own validation, not to your end result on your P&L sheet, but to how well you actually followed your system. And you're like, well, VP, that's really boring. Yeah, but I think by now, you also know just how hard it is to do and how it would vault you into this rarefied air stratosphere if you are somebody who can actually follow a system despite all of the obstacles that we have just spent 55 episodes on a podcast talking about, and we haven't even hit them all yet. Like, despite all of those things coming at you, you can still follow your system to the letter. That is an extraordinary goal. And being able to do that in anything in life is going to take you really far, because like I said, you become not everybody else by being able to do something like this. That to me is a goal really worth chasing. And what's kind of cool and kind of not cool about it is it's one of those things that just takes almost a lifetime to master. I'm not completely there yet myself. I'm certainly closer than most. Rob, I don't know about you, the king of flat earth trading over here, but it's something that can give you validation, yet the game is still not over. You can play this game your entire life just trying to stick to your own created system, as simple and as absurd as that even sounds. I think that's the game we should be playing.
I agree with you 100%. I've always said, when trading gets boring, you're finally doing it right. And I got to share with everybody one of the comments I got after one of the videos of Flat Earth Trading Society. So we are on like video number or trade number 45 in Flat Earth Trading Society. And again, we're flipping coins, we're throwing darts, we're choosing random positions in random methods. We're putting no effort into the entry whatsoever. Whatever trade it is, we just buy it at the market that second. We don't even look at a chart. And then we do a trailing stop, where if it goes against us, we sell it. And if it goes for us, we hold it as long as we possibly can. And somewhere around trade 40, I got a comment on one of the videos I love. And it said, "Hey, Rob, this is getting really boring. Is there any way you could spice it up a little bit?" And I just laughed. And I answered, that's the point of this entire experiment, is to show how boring it can be. Now, here is some good news. I have been trading now for 26 years, 27 years. I'm still excited every single Sunday. It used to be Monday, but now that I've traded Forex since 2007, I'm excited every week, because the market is dynamic. The market is always changing. Now look, it's weird because it's always the same. The market's always the same. Things go up and down and sideways, and volatility goes up sometimes and down sometimes. But oh, it's so interesting. I am still excited and fascinated for every week that I get to do this career. But I do the same damn thing every single week that I've done for years. So yes, it is boring, but it's also very exciting as well. So to wrap this episode up, validation is really important. You need it. In order for you to justify the time and effort you are putting into this business, you must receive validation. Now, this validation can be from your trading results, the numbers. It could be from people that are watching you do this. They see, oh, he's still doing this after 4 or 5 months. Oh, there must be something to it. Validation is going to come in all forms. But tie the validation to things you can actually control. That's really the key to this, because then if you screw up something that you could have controlled, you're going to get pain. You're going to get not validation. You're going to get a slap on the wrist. And hopefully next month or next week, that encourages you to actually control it. Then once you do control it, you're going to get the validation, and it's going to get you to be motivated to go after the next hurdle. And once you knock down these hurdles one by one, all of a sudden, there's no more hurdles to knock down. Yes, trading gets a little bit boring, but it becomes a lot easier at that point. So validation is very key. Just tie it to things you can actually control.
And on that note, everybody, we would like to thank you for joining us here at the Trading Psychology Podcast. Rob and I will both be back with you next week.
Goodbye, everybody.
This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, it's the jaunty, Rob Reinhold.
The jaunty. I like that. I'm going to have to change a lot of my behaviors in life to be jaunty. No one has ever called me jaunty before. But I appreciate being here. It's always fun talking about trading psychology. And look, this one is near and dear to my heart. So let's get going on this. I love this one.
Yeah, so what we've been doing, if you haven't been with us the last couple of weeks, is going over the psychological advantages and disadvantages of certain markets. So we covered Forex and to a lesser degree crypto. We talked about stocks last week. And at the very end, Rob kind of teased that, at least over at Maverick, they trade stocks and options both in this type of weird synergy. So maybe we'll get a little more insight into that. And then talk about the psychological advantages and disadvantages here, and to really discover for ourselves, if you don't do this now, might there be a really good and reasonable opportunity for you to do something like this going forward? Would it make sense? Is the juice worth the squeeze? Whether that answer is yes or no for you, we will certainly have all those questions answered by the end of this episode. So, Rob, this is probably going to be 95% you. I am okay with that for this episode because I just don't know a whole lot about this, so I'll be learning along with everybody else.
Well, thanks, Patrick. And I need to start off this episode with just coming out and disclosing. This episode is going to sound like I've been hired by the Options Clearing Corporation to be a paid shill for options trading. Now, again, I don't get a dime if you options trade it. I don't care if you options trade. But I'm going to share with you how this one change I made in my trading early on fixed most of my psychological problems that I was having as a stock trader. So options are near and dear to me. But in the end, just like we talked about in the last couple episodes, trading is trading. Driving cars, driving a car. Yes, options are a little bit more complex. They've got a little bit more rules. But in the end, guess what they are? They're a symbol. Now, I've been saying they're a symbol and they go up and down based on the supply and demand. Options are a derivative. Whenever you hear the word derivative, it means that their value is derived by something else. So the option price does not go up and down based on the supply and demand of the option. It goes up and down based on the supply demand of the stock. And the option is a derivative of that price. So if the stock goes up in value, calls go up in value and puts go down in value. If the stock goes down in value, calls go down in value, puts go up in value. So it's just like kind of long and short with calls and puts. But in the end, it's a simple. The stock will go up and down based on supply and demand. You can learn how to trade it. Now, when I was a young trader, I've always had some things I did very well. One of my biggest strengths as a young trader, I was really good at holding winners. I was really good at it. And when everyone else got out, I was squeezing more and more out of winners, and it really made a difference on my profit factor. So those are some of the things I did really well. I was really good on some timing. I was really good on seeing changes and trends. There were some things I did really well. But the things I did not do very well was position sizing. I would have too much of my capital in any one trade. Why? Because I wanted to make $1,000. If I did proper position size, I would have made $100. So I wanted to make that money. And then the other thing was I was pretty good at risk management, meaning getting out of losers. When I started out, there were no automated stop orders. You had to have a mental stop. A mental stop. Think about that. Where, hey, I bought the stock at 100, but if it goes below 98, I'm going to get out. I would say that 9 out of 10 times I could click that button at 98. Here's the problem. 1 out of 10 times I couldn't. 1 out of 10 times I would blow it. And then when we got automated stops in like 99 is when, automated stops are here, great. I would find myself canceling those automated stops. Patrick, have you ever done that before in your early years? Had a stop out there and cancel it because I don't think I want to get stopped out of this one.
No, of course. Yeah, like especially if you've already taken a couple losses, you're like, man, I don't want to take another full loss. That's going to hurt. So let me just chicken out and back out now.
Or the market does the thing that happens to everybody. You have stop orders in, and it runs down through your stop. You get stopped out, and then it runs back up, and you would have been fine. You would have been profitable. Once that happens to you 3 times in a row, it's really hard to leave your stop out there on the 4th time because you've just been programmed that you don't need that stop. That stop hurts you, and it's going to come back up. So look, all these psychological problems got it to where I could follow my rules 9 out of 10 times. 1 out of 10 times I couldn't. And that 1 out of 10 times usually created a loss that wiped out my big gain that I could get. And so in the end, I was treading water, making a little, losing a little, but I would have these big spikes in my account. I'd have big runs and then big spikes down, big runs and then big spikes down. And it wasn't a smooth equity curve. One of the things we talk about at Maverick is your equity curve. What that means is your account value over a 1-year period. So I love to look at traders' journals that have some data in it because I want to look and see how big were the drawdowns? How big and how deep were they? That determines how much capital I want to allow them to trade. Because I know they're going to take, if this trader's taking 40% drawdowns, I'm going to have a hard time giving that trader $250,000 and having a 6-figure drawdown. That's going to be really tough for me to do. And that's what my equity curve looked like because 1 out of 10 times I blew it. Once I learned and got into options trading, this fixed it. And the biggest advantage number 1 to options trading is absolutely guaranteed risk management. Let me give you a quick example. I know that some of you aren't going to know a ton about options. Some of you are going to know quite a bit. I'm just going to give you an example. You can buy a call option. A call option is the right to buy the stock. So let's say there's a stock at $100. I can buy the option to buy it at $100. And that option is going to cost me $2 a share. So, and every option has an expiration date. So let's say this option expires in 2 weeks. So 2 weeks. Anytime during those 2 weeks, I can buy the stock at 100. If the stock runs up to $110, I can buy the stock at 100, sell it at 110 immediately. Or I can sell my option for $10. It doesn't matter which one. But here's the great thing. Let's say this company comes out and their product has been killing people. And that stock drops all the way from $100 down to $10 a share. The most I can lose is $2. I don't have to have a stop. Again, those stop orders. And I know like a lot of your traders are Forex traders and you have to use stops in Forex. Trust me, I've played around with all different strategies and stops are the most effective way to do it in Forex. In options, you can completely quantify your risk on any trade. So if you bought 2 contracts of that trade, you had $400 at risk. That is worst case scenario. And here's the cool thing about options. Let's say this company comes out with a bad earnings report. And let's say the company drops from $100 down to $85. But then people have had a change of heart and they buy that stock back up. And 2 weeks later, that stock's at $105. That happens all the time in the market. You were profitable on that trade. If you had a stop, you would have been a loser on it. So what this allowed me to do is basically to not have any position management. I would buy that option for $2. I would let that stock go against me $100. It didn't matter. It didn't matter how much it went against me. If by the end of the options period, it was above 100, I would have some money in it. If it was above 102, that would be my break-even point. 102, that would be a profitable trade. So for the first time, I didn't have to make a decision on when to get out of a trade. I didn't have to decide, should I pull that stop out of the way? I've just taken a couple losses. I don't even have the ability to do that. I'm looking back at my trading career. And again, I was working on my psychology. I was doing better about not blowing it, but I wasn't there yet. When I found this really allowed me to really have to not fight that psychological battle. So any of you that are having a really hard time following your position management rules, I'm telling you, options are beautiful because it's just a guarantee. It's just you price it for max risk and you let it go. You let it go.
So probably the main reason why I never really explored options or was never really interested in them is I never wanted to be constricted by a set amount of time. But I also never really considered the advantages of that. So what you're saying is if I put in a call option at $100 and I set it for, my losses if it goes down to 95, even if we have a flash crash of some sort, and if I would have had a regular stop order there, like it went so far beyond it didn't even get triggered. You just had a massive amount of slippage, and it took that price all the way down to $70. Not only do I only stand to lose $5 no matter what, but if for some miracle over time, in that period of time that I need to wait, price would come back up and maybe even put me in the black, that once that time period ended, I would actually make money?
That is correct.
Okay. Well, that changes things a little bit because that's a really great thing because so many people, for one, worry about gaps, but you're saying in this situation, gaps don't matter at all.
They will matter, but it will be a very small mattering. As long as your position sizing is correct. Like in your example, if you did one contract at $5, that's $500 at risk. That's your risk. The stock could go to zero, and that's your risk. Let me tell you another positive about options. So that was an example of a long call where you bought the call. Let me give you an example of a short call. Now look, I am not advocating anyone go out and sell a naked option. There are much, much better ways to do it, but I'm going to show you this example of the option. So Patrick, let's say that you wanted to buy that $100 call for $5, but I wanted to sell it to you for $5. So let's look and see on opposite ends of this transaction. Neither one of us own the stock. We're just betting on the direction. If your stock goes up to 110, you're going to exercise the stock, buy it at 110. I don't have the stock, so I have to go buy it at the market at 110 and sell it to you. You gave me $5, so I'm going to have a $5 loss. Do you see that? Because Yeah, you have the right to buy it for 100 from me. I had to buy it at the market at 110. However, let's say the stock didn't go up. Let's say the stock went down. Let's say the stock closed at $99.50 on that expiration date. Do you want to buy the stock from me at 100?
Well, at this point, no.
So you lose your $5 and I made your $5. That's selling an option. So as you can see here, selling an option is what we call like bidirectional trades. If the stock went down, I made money. If it went sideways, I made money. As long as the stock didn't go more than $105, I made money. That's a great way to make money in the options world. And most professional options traders, they do more options selling than options buying. Now, the reason I say I would never advocate anyone to sell what that's called sell a naked call, because Patrick, what if that stock gets bought out for $200 a share during our transaction? Are you pretty happy about that?
I would be, but did I already kind of cannibalize my earnings by setting a certain take profit point when I made this call, or how does that work?
Well, it was a gap. No, it was a gap. So it gapped right over whatever your limit price was, it gapped right over it because the market was closed. So your option would be worth $100. The one you bought for $5 would be worth $100. Here's my problem. I'm screwed because I'm on the hook to sell it to you for $100. I have to go to the open market and buy it for $200. My risk is theoretically unlimited. If that stock goes to 4,000, I'm on the hook. So that's why selling a naked option is not a good idea. You cannot quantify your risk. And the reason we love options is you can quantify your risk. So here's what we do. Could I go and buy a $110 call from the market to protect myself?
You're asking me? I'd imagine you could. You want to hedge, right?
Yeah. So now, if it costs me $1 to do that, I'm now on the hook for $6. Because again, I'm only going to have $4 in my pocket. You gave me $5, but I paid out $1. So my break even is now 104. But over 110, I can't lose any more money. It allows me to completely quantify my risk. And I'm not even betting the stock's going up. I'm just betting the stock's not going up. It could go sideways and I'm going to make all that money. It could go down, I'm going to make all that money. So one of the big, huge advantages of options trading is that in all other styles of trading, Forex trading and stock trading, futures trading, you have to get a move in the direction that you bet on. That's called directional trading. And directional trading, you've got to have good timing. You've got to have all these things. Doing this with options, being an options seller, do I even need good timing on this trade, Patrick?
Not really. I mean, maybe maybe a little bit, but less so than you would elsewhere.
I need to just make sure that by the expiration date, that stock's under $100. If it is, I'm happy. I don't have to have good timing. I didn't have to get into the right time and out at the right time. I'm just saying, I don't think this stock goes above 100 for the next 2 weeks or whatever the time frame was. That's my bet. So this is what's called positive theta. You're making money off of time decay, not direction. This is where, again, options are great. In sideways markets, you can make good money in options. In sideways markets, Forex, stock, they become difficult to make money in. Very difficult, especially if you're doing a trend trading strategy where you're trying to get these things to move. When the move is choppy or when the move is non-existent, options trading gives you a great way to actually make money in those markets.
Well, that's a nice little choice to have. I'll say that because if there's any enemy to what we do, it is sideways markets, either just because we're sitting around doing nothing or it's a choppy sideways market and we're getting stopped out. So okay.
Well, Patrick, let me tell you a cool thing. Again, there are options on currency futures. So you can trade options on currencies. Now it's going to be on the currency futures. I don't know how much you talk to your listeners about currency futures. I'm not a huge fan of currency futures, but if you understand Forex, you can actually trade options on Forex. There is also some stock ETFs that follow Forex. So for example, the FXA is the symbol that follows the Aussie dollar. you can trade options on the FXA. So you could do options trading on your Forex trades. It's not going to be in the spot Forex market, but it's going to, again, be a derivative of that. There's lots of cool things you can do here.
Yeah, there are people who actually trade FX options quite a bit because I get questions from them a lot. So I know they exist, and so I know that market exists too. But in the United States, yeah, that's how I always get around things like that. UUP is the one for the dollar, so you can it's really not very volatile, but you can play with that one too. Now, okay, so before we get too deep in the weeds here in terms of just explaining how this works, I think you gave a pretty good primer, at least about the major advantages to how the overall mechanics of it work. But let's proceed on from here, because I see you got quite a bit here, and I don't want to make this into an options course. So are there any other advantages, clear advantages, that you can think of before we get into the disadvantages? Because I like what I'm hearing so far on the advantage side.
There are so many cool things you can do. One of the things that scares a stock trader, and rightfully so, and a Forex trader, is news events. News events, because you know there's going to be volatility. And if you have a stop anywhere near market price, you're most likely going to get stopped out. Even if you were correct on the eventual destination of the currency, you got stopped out because of the chop of the volatility. Options give you the ability to really just sit through that because, in your example, you bought the $100 call for $5. You bought one contract, you got $500 of risk. Patrick, would you be scared to stay in that stock over an earnings report when the stock's at 100?
Yeah, I would just bail. I wouldn't even bother.
Well, you would bail because the future is uncertain. The future is uncertain, so you say, you know what, since it's so uncertain. In other things, you have equal risk and equal reward. So in currencies, let's say you're trading a currency that's at, let's say $1.20. And in that event, it's either going to go up to 125 or 115. Your risk is equal. And I would absolutely say, get the hell out of there. If you don't have an edge going into that news event, get out of there. Here's the crazy thing about this option, though. What is your downside? If the worst case scenario, what's going to be your loss on your option?
I don't know. Well, I guess whatever I set it to be, right?
Yeah, $500. $500. If you bought a $100 call for $5, one contract of that is going to be $500. What's your upside potential?
Well, the way you put it, like I thought it was limited, but apparently it's not.
No, if that stock goes up to $120, your $100 call is worth $20. So we're putting ourselves in situations of asymmetric risk, which is very, very beneficial. Like if someone came to you and said, hey, Patrick, I got this game. We're going to flip a coin. Heads, you win $20. Tails, you lose $5. Would you ever stop playing that game?
Never. I would sell body parts until I just started winning, which over time I eventually would.
All right. Now, before anyone gets excited, that is not how the options market works. You do not get a 50-50 chance to make 3-1. That's
okay, I was going to say, because I'm like, okay, why didn't I start doing this 20 years ago? There's got to be clear disadvantages to this market. So let's weigh them out here.
The best way to really understand options trading, again, a long call or a long put, is in sports betting. And I know, Patrick, you've done a lot of sports betting. Buying an option is the over-under bet in sports betting. So a lot of people think, okay, well, if I'm buying a call option on Microsoft, if it goes up, I make money. If it goes down, I lose money. No, that's not true. You're not trading the line. You're not trading, win or lose. You're trading the over-under. They know, again, in a sports event, so let's say the Cowboys are playing the Eagles. I'm going to upset some Cowboys fans here, but let's say the Eagles, actually, no, this isn't, the Eagles are going to win, but they have to win by 3 for you to cover the spread. That's the spread, it's 3. So in options trading, sorry, I shouldn't say over-under, it's the spread. You're not betting that Microsoft is going to go up. You're betting that Microsoft is going to go up more than the spread thinks it's going to go up. Does that make sense?
It does now. You said over-under. I'm like, what? Every trade is an over-under. But yeah, okay. Now that you're saying the spread, so it has to go up by a certain amount, or else a particular amount, or else I don't make money, right?
Correct. And if it doesn't go up by that amount, the option seller made money. So for the example we're doing, I sold you the option. If it doesn't go up more than $5, I made money. It had to cover that spread. So every option has a spread in it. So going into that news event, there is a spread. Like the stock will have to go up more than higher than like $108 for you to break even on the trade. Here's the cool thing about options. There's lots of cool options software that literally tells you these things. Hey, your stock has to go above $108 at earnings for you to become profitable. And then you get to like make a decision on whether you want to make that trade. It's very, very cool. But here's the great thing. Again, you can really trade through news events. You can do anything you want because you've quantified your risk. Your risk is guaranteed.
Okay, so I knew there was a catch somewhere. So that's one of them. Are there any others that I need to be aware about before making a decision? Because again, it's a big decision. It's a big time decision. You know, I got to relearn things all over again. You know, I want to know everything I can. So be honest. What else, on a disadvantage standpoint, do I need to really keep an eye out for?
All right, that was my paid shill part of the of the options here. Let's get real, because it's not an easy game. It's not any easier than anything else. It's just a game. Now, all options are priced to zero expected value over 1,000 trades. Now, I'm going to go back into the sports betting arena. Patrick, if you just bet on the spread, if you just took the spread number, or you took half the trades you took under the spread, half the trades you took over the spread, what would your expected profit be at the end of 100 bets?
Minus juice, it would be break even.
Exactly. Minus juice. It would be break even. That's how it works in the stock market. The stock market runs off of the exact same math that runs off of. So there is no edge in options trading. And so some of the examples that I gave you earlier, if you got all excited, I'm going to dash those because there is no edge. It's just like sports betting. There is no edge. You have to be able to beat that spread. Now, everyone gets into options buying options. And I gave you that great example of buying that call at $100. If it goes to zero, you lose $5. If it goes to 200, you make 200. The problem is those options come with time decay. So if you are a 50-50 trader, 50-50 win-loss, and you get into options, you're probably going to be at 35-65. Why? Because your options premium is always expiring. It's always decaying. And as you get closer and closer to the end, they decay very rapidly. When most people get into options, they look at this stock and they say, oh, here's a stock. It's on Tuesday. The stock's at $50. I think it's going to be at $55 by Friday. So they'll buy the option that expires on Friday, and they'll buy it for $3. If that stock is to $53 on Friday, they've broken even. So do you see how difficult of a trade that is? You have 4 days. You got to be perfectly right. And it has to go up by at least $3 just so you can break even. Would you ever take that trade?
Well, no, but I don't have to take trades like that, do I?
In options, you do. And that is the options trading market. So again, you're not betting on the win or loss. You're betting on the spread. Every single trade has a spread built into it. And people that don't understand that, they're always getting this drag. And so, again, their win-loss is terrible. It's terrible, and it causes them to, get into the downward spiral and do all these dumb things. And we also know that people are really bad at holding winners. So the reason you would do a trade like this is because you want these outsized winners, and you want to keep all your losers very small. The problem is people are terrible at holding their winners, especially in long calls. So look, there's always a drag. There's always a drag. There's always that spread that you have to beat when you're in long calls and puts. Now, as you said, I don't have time for this to become an options class. We do mostly spreads at Maverick, where you're long one option, short another, and that really gets rid of a lot of that negative theta that goes against you. So we're just trying to isolate certain things. The second disadvantage is liquidity. Now, this is where options are really crazy because an option price can change even if there's not a trade. Now, in Forex, that really can't happen. The only time Forex can go up is when people buy more shares, more amount that's available out there on the ask, and it goes up to the next ask. So there has to be people buying those stocks, currencies, for them to go up and down in price. Remember, options are a derivative. So if the stock goes up, the price of the option goes up. If the stock goes down, the price of the option goes down. Here's the problem. When people go out and put stops, the default is last trade. So think about that. When you put a stop in on Forex, so if you're in a currency and you put a stop in at 120, it is triggered as soon as a trade goes off at 120 or lower, your order automatically goes out. Could your price of your option go below your stop and never have a trade? The answer is yes. The answer is yes. So stop orders are pretty lousy on options. The bid-ask spreads, when you're looking to buy an option, the spread will be like $1.50 by $1.90. 40 cents, that's like 20%. That's insane. You're just losing 20% on a bid-ask spread. If your spread is 80 cents by $1, that's a 20% spread. You can't overcome those numbers. You have to have a crazy win-loss and crazy profit factor just to overcome those numbers. So again, the bid-ask spread is no joke. There are ways that you can handle these, but you really have to know them. But there is not good liquidity in options. Now, obviously, the most highly traded stocks will have the most highly traded options, but it's bad liquidity in options.
Okay, so that's not great, but it does sound like something you can overcome or at least mitigate to a degree. So, all right, so before I weigh both of these out completely, are there any other disadvantages that we need to know about?
Yes, and I'm trying to think of how I can explain this without going deep into options. There are things called options Greeks, and Greeks are the things that affect the price. Delta, and again, a real quick crash course on Delta. If you buy an option that has a delta of 50.50, what that means is for the next dollar your stock goes up, the price of your option will go up by 50 cents. That's delta. So when a stock goes up $1, very rarely does your option go up $1. It goes up by 50 cents. And when it goes down $1, your option goes down by 50 cents. So delta is basically the percentage move of the option in comparison to the move of the stock. There's all these other Greeks. Theta, we talked about. Theta is time decay. And theta is just a mathematical formula that every day you hold an option, it loses more and more and more of its value and it accelerates at the end. So you have to know about that. There is one Greek that is the absolute wild card. And everything else in the stock market, look, nothing is predictable, but you know that if a stock goes up from $100 to $101, you know that moved $1. And like you know, there's some things you just know. Like when your delta is 50 and the stock goes up $1, your option is going to go up 50 cents. You know that. Implied volatility is the market's measure of people's emotions. It's their behavior. When markets freak out, we see big moves in price, but what you don't see is the absolute insanity that happens in implied volatility. And of all the things in trading, this is the absolute most difficult, impossible thing to get right, and it's going to do things that completely blow your mind. And I'm going to give you one example. In May of 2020, we had the price of oil was negative $37. Do you remember that, Patrick?
I do, and I wanted to buy, but I just didn't know if I was able to because I've never seen anything like that before.
Nobody had ever seen anything like that before. That was implied volatility. I'm going to explain exactly what happened. But everyone's theoretical models did not go negative. So there were like really high level traders who had all these theoretical models. They've had to reprogram those models to even understand that negative $37 oil is even possible. Before then, it wasn't even possible. That happened because implied volatility. And what happened was, this is something called contango. So if you took a look at the options, sorry, not the options, but this was the futures market, the oil's futures market. Every single month has a different futures attached to it. It was only the May futures. The May futures were negative $37. The June futures were positive $25. And then the July futures were positive like $28. This is what implied volatility can do. So when you're in options trading, one of the values to the option is implied volatility. And it's crazy. It's really crazy. And there are times where if you are in more complex option spreads, your theoretical what should have happened does the exact opposite. So again, like I said, it's to someone who's really experienced with options trading, you'll get this. But I really wanted to balance this out because I was an absolute shill about options trading in the first half of this. I want to definitely make it clear that options are definitely more complex when it comes to trading. So there's a lot to think about. But for me, it solved my psychological problems. And I got away from stop orders, which I couldn't quite keep all the time. And then it allowed me to get the discipline to when I went back into a market like Forex in 2007 to trade stocks, I had built the discipline to not pull orders, to not screw it up. And I'm really, really happy about that I didn't get started in Forex right away, that I could build this discipline through using options to basically get myself out of having to fight my battles that I was constantly losing to where I could then understand more of the process.
So then overall, and I'm glad you tied it back to psychology because sometimes we get too in the weeds here and we get away from that sometimes. But given all of those things, to the average trader who listens to this podcast, would you recommend this to them and why?
Let's take this the same way we've done the other episodes on the disadvantages and advantages of different trading products. It's all dependent on the person. We talk about your lifestyle. We talk about your personality. Some people won't enjoy options trading. It just won't be interesting. It won't be fun. It'll be too complex or it'll be too messy. Some people, their lifestyle is more suited to other markets. Look, this is where it's simply a way to trade. It's not the best way. There is no best way. What there is a best way for you. So I always recommend to everyone, I love knowledge, and I think learning new things is only positive. It's only positive. Learn it, see if you like it, and if you don't like it, throw it away. There's been a lot of things I learned. Heck, I studied Elliott wave theory for well over a year, and I pretty much threw it all away. But I'm glad I did it. I'm really glad I did it because it did help other parts of my trading. I just don't use it at all. So my advice is learn about it, see if it works for you, and if it doesn't, throw it away.
Yeah, I'm really glad you said that too, because I've told this story before as well. I spent a year learning ICT's method of price action. And while I never really picked it up and I didn't like it because I couldn't test it, I'm super glad I spent that year learning it because portions of it carried over and became pivotal features and factors in the way I trade now. So I might, just without knowing this as much as you do, Rob, I might recommend this to my traders as well because my traders typically, if you're going to spend as much time as you did to learn my system, you're probably set up to learn something like this pretty well too because you're very detail oriented. I still get questions from people who are just maybe, like 20, 30% into this. And it's a really nerdy, deep question and it's kind of annoying, but I always try to answer it because all they're really trying to do is follow this system to the letter, and I really appreciate that. So I have a feeling a lot of you are that way too, so you would probably be pretty well equipped for something like this. This does not seem like a trading method for people who want to take shortcuts. Is that fair to say?
Yeah, that is absolutely fair to say. Um, when you're learning to trade forex or stocks, it's directional trading. You literally are just worried about doing direction. In options, you've got delta, gamma, vega, theta, and the rho. You've got 5 things to learn. They all affect where your trade's going to go. So yeah, I would definitely put this on the back end of what you should be learning.
Good. Well, good to know. I mean, I know this is an episode that not a lot of people probably expected, but I really do think now that I've kind of listened to all of it, it can be really helpful to people, especially if you're maybe looking for another challenge, and a challenge that, like you said, Rob, overall can cascade over and benefit you in other ways of trading. So anything else you want to say, Rob, before we wrap it up?
Yes, I want to bring it back to forex because, like you said, this episode probably for some of you is like, okay, that's nice to know, but that doesn't really apply to me. If you know things, imagine you are in an Australian dollar, US dollar position. You're long Aussie dollar, and you're coming into a Fed. You really like the position. You've got a nice profit on it, but you're not going to risk holding it over the position. Could you sell out your forex position, go in and buy the call option on the FXA, and totally quantify your risk to where, again, you bought one call option for $1.50? That's $150. So let's say you've already got a $500 profit. You wanted to hold it, but it's just too much risk. You're willing to risk $150 of that. Go buy the long call on the FXA. It gives you a lot of things you can do with your trading. You can just use this in your forex trading every now and then. Again, if you know it, you know how to use it, you can decide when it's applicable to use. So I'm a big fan of just learning as much as you possibly can in your life. And if you're going to be in the world of trading for your life, learn it all. Learn it all. You got time.
I'm with you on that. If it's useful and it's something you can carry with you in a positive way for the rest of your life, absolutely learn it for sure. That goes for cooking, sewing, like any useful life skill like that. For sure, I'm with you. So I guess on that note, traders, thank you for joining us here.
Have a good day, everybody.
This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every episode, it is the globetrotting Rob Reinhold.
Well, hey, Patrick, it is nice to be back, and it's nice to be back talking with everyone. And yes, I've been to some very cool places, down to New Zealand, met some of our Maverick Forex traders down there, and then I met a new Forex trader that just ran into him and started talking to him. So very cool. Good to be back.
Nice. Yeah, that's the benefits of being visible. I think I just walk by most of my traders and we don't know who each other are, and that is the way I prefer it. But yeah, let's go ahead and move into something different that we're going to do this week. And what I'm doing is, if you guys know, I started my channel in 2018. And it got really popular really quick, which you're like, wow, that's great. And that is great. But you get a lot of people that, A, you don't want, and just B, are just wrong for the channel overall. However, I think there are two, this is a 2-part series as far as I've created it so far. Maybe we'll have a third, but a 2-part series where there's 2 specific traits that I think, even though these initial haters had and how most of these people just left the channel immediately, I still think that a lot of us tend to have these particular tendencies lingering around in our heads. And sometimes they come out a little more when trading is stagnant or when trading is bad or when the market is slow or something like that. And so I wanted to identify this particular trait of no-nonsense Forex hater and kind of see what Rob thought about it and see if there's anything we can do about it, because I wouldn't bring this up if this was just one of those traits that we just kind of laugh at and blow off, because there are some of those. But Rob, let me, you have a couple YouTube channels as well. Maybe you can relate to a little bit of this, but I'll give you a quick list of the people I had to deal with in the comments section who like really tried to give me a hard time early on. Now, the first one, and this is something I don't think applies to anybody who listens to this podcast right now. If you made it this far, this doesn't apply to you, but the super emotional guy. And I've made fun of this person in the past on future videos to where I said, look, these are lines on a screen, because it's always on the technical analysis stuff for some reason. People, I guess because they just spent so much time and effort and I would say emotion too, because they used some of these tools and they worked in the past sometimes. And that makes you feel really good. It makes you feel really smart. And so when somebody finally comes in out of left field and starts bad-mouthing them, that's going to trigger a response. And I get it, but people like that, to me, just have really no chance to make it in this industry. To become that 0.1% margin of error it takes to be good at this, if you have those type of emotions, you're not for my channel and you're not for this market. You need to go find something else to do. The next one was the bad reading comprehension guy. I feel like I talk very clearly and explain things really well, but sometimes people just still don't understand it. And so they don't ask for clarification. They get really angry. So I guess it goes to the super emotional guy too. So that's another person that kind of comes and goes. I don't really spend too much time trying to explain things to them, because I think they're a lost cause, and you can't spend your time that way. The third person is, I got this so much early on, and then I just never ever got it again, was the language police. So I do curse sometimes in my videos, and this would make people very angry. And I guess these people are on a crusade to go to every single YouTube channel they visit. And if they curse, to scold them and try to get them to change their ways. And this is so delusional that, again, you can't spend time responding to everybody. So this is just another group of people I would ignore, because I don't live in their world and I can't comprehend their world. So I just didn't even try.
They're improving the world one swear at a time. If they could just take one swear out of the world a day, it's gonna be paradise at one point.
Right. No, it justifies their existence for being here. And that's great, I think, right?
It's effing great is what it is.
It is so fucking amazing. Anyway, but yeah, before we get to the real meat of what we're talking about here, I just kind of want to go over some of the really silly ones to me, and see if you had any experience with these type of people, Rob, and if there's any you want to add to this list.
We're pretty new to YouTube, so I don't have a ton of experience with this, and frankly, I don't spend a lot of time even looking at comments. But my favorite, and this has happened just a few times, where we'll put out like a 45-minute video, and the comment will be like, "You're wrong," or like, "No, it isn't." And it's like, wait, like there's 45 minutes of content in here. If you're going to want to fight, can you be a little bit more specific? So the comment guy that I think is funny is the fighter. And I say the guy because it's inevitably going to be a guy 99% of the time, but they just want to fight. They just want to fight. And they're not even concerned about anything other than just getting in an argument. So it's just not even worth anyone's time.
And it's more than just they want to fight. They want your attention. They want to take your time away. I call these people time vampires. They want you to stop everything you're doing, a busy man like yourself, and give a random person 30 to 60 minutes of your time arguing back and forth over something that's never going to get resolved in the first place. Yeah, so all of you budding or early YouTubers out there, if you ever see these people, they're tough to ignore because their arguments are so silly or lazy or whatever the case is, but just do everything you can to ignore them, because it is a one-way road down. Anything else you have to say to that, Rob, before we move forward?
Yeah, I would just say, the internet is full of good and full of bad. And there's so many wonderful things that happens every day on YouTube, on Reddit about, I'm in several Reddit threads of traders. I never go in there, comment, but I get some emails and I jump in there just to look at what people are talking about. And all I see is this wonderful, loving community of traders wanting either to help other people out or to get help from other traders. It's awesome. And then you got the dicks. You know what? You just have to ignore that. There is so much more positive and more beauty out there, but these little things can get under your skin. And my advice is, and as you said, if you give them your time and energy, they've won.
Yeah, we do not let the terrorist win here on YouTube channels. And I agree with you, Rob. That's why I never was on Reddit, because before Reddit, there were forums. And exactly as you said, if it's 5%, super insecure people or trolls or whatever the case is, it takes down everything. That's all it takes. So it just wasn't where I wanted to spend my time either. Now, but the one type of person that they weren't even haters. Well, sometimes they were haters to where they didn't like the fact that my videos were 30 minutes long. They didn't like the fact that my first maybe 5 or 6 technical analysis videos was kind of breaking people down and getting them away from what they'd been told their entire trading lives. That this is what you need to use, and you need to go overbought, oversold, blah, blah, blah. These are the only indicators out there. All these things we were told for as long as the internet's been around, they were just completely wrong. I felt like I had to get them away from that first in order to introduce something new. Now, I have probably closing in on 300 videos on my channel now. I haven't looked in a while, but I still get people today that comment on one of those videos. They're like, "Are you ever going to tell us what to do? You just keep telling us what not to do." I'm like, bro, there's 300 videos. Maybe, just maybe, you're going to get there. Probably sooner than later. So it's just really impatient people that at the end of the day aren't looking for the service I was providing. They're not looking to sit down and learn something new with a lot of moving parts. It's actually pretty easy once you figure it out, but takes a little bit of time to learn. What they want above anything, and this is what most Forex traders want at the end of the day, is a shortcut. That's it. And I think when a lot of people realized that my channel wasn't going to give them that, I think people found that I was going to be an indicator channel and like, oh, cool, shortcut. And it wasn't it, and that made them mad. Because, Rob, one of the best/worst things I ever did was allow people to go to my contact form and ask me a question. Because I get much better questions now, but back then, I would get nothing but the laziest, most horrible questions. And I would actually have to sit there and answer them. And then at that point, they thought I was their personal help desk, and they would start asking more, even though I specifically told them not to. It's just the bane of my existence. If you remember the Forex Q&A podcast, that was the one thing I couldn't get over. I would spend the first 3 minutes just complaining and trying to get these people to ask good questions, and they just never did, because all they really want is the quick route there. What are your top indicators? Here's my system. What do you think about it? That's all they ever wanted. They didn't really want to learn at the end of the day. Now, I guess you're not going to experience this too much in what you do, Rob, but before we get to the reasons why we think this occurs, how much experience have you had with people like this, just being in the business overall?
Well, Patrick, I'm going to say something that is going to hit very close to you and sting a bit. It's going to sting on me because I'm also talking about me, and I'm talking about all the other aspiring traders or people that are now professional traders out there. You got into this business to find a shortcut. So we're all the shortcut people. We're all the shortcut people. That's who we are as people. We could have gone to college, got a degree, worked in a company for 45 years, and got a small retirement at the end of it. But we're all the shortcut people. Every single one of us is the shortcut taker. The first thing that you need to do, that I need to do, that everyone needs to do, is fully recognize that's who we are. Now, there's a great quote, I can't remember who said it, but he said, once we finally admit who we are, we're finally free to change. I love that quote. I love it. Once you finally accept who you are, now you can actually change. So we're all the get rich people. We're all the shortcut takers. That's who we are. That's why we got into this world of trading, and is why we got into Forex trading specifically.
And you are 100% right, 100.00% right. I don't know anybody, I don't even know if it's possible to come into Forex trading, or what has really turned into crypto trading, as far as kind of like the quote, get rich quick type of trading, and say, you know what, I want to learn this, but I want to go really slow, and I want to do it right, and I want to take my time, and I want to fail a lot. We don't enter the market with that mindset. You know, I said it before, I wanted to leave the restaurant industry in 2 years, not 15. So when this Forex thing came along, and when they dangled that whole leverage carrot in front of me, I took to it right away. But of course, like everybody who does that, it doesn't work. It only puts you in a bigger hole. It only makes you more frustrated. And that's why, Rob, I tried to be patient with these people. You know, I didn't yell at them. I did say, hey, look, you know, here's the answer to your question, but this is not the way. I know this goes against everything you thought, but I thought maybe, just maybe, you know, if they just kept going with it, they would see the light. And I don't know if they did or not, but you're absolutely right. We didn't get here because we wanted to go slow. So I do take shots at the people who took shots at me because, like, I suppose that's just how I am. But the people on the contact forum who made my life miserable for a good 2 years, and instead of just, you know, telling them that they were going to fail, I kind of tried to steer them in the right direction. I just don't know if it worked.
Well, what happened, Patrick, was that we all tried the get rich quick, and we all quickly learned that, oh, it's a little bit tougher than that. And so then you had people at your stage, at your first stage, saying, hey, how do I make it quick? And you're like, hey, dude, you can't. And they're like, no, I don't want to hear that. And I've said many times in this podcast that if today Rob were to go back in time to 22-year-old Rob and literally talk to myself face to face and tell me, chill out, slow down, this is going to take time, I would say, get the F out of here, old man, I'll do it myself. I wouldn't believe it myself. So this is just who we are, and that's what we have to admit. This is who we are as people, and most of us has already gone out there and found out, oh, it's harder than I thought, it's harder than I thought it was going to be, and it's not going to be a get-rich-quick thing, it's going to take some work. I think we've all gone through that part, and I think you just talked to the people that hadn't gone through that yet.
Yeah, and I just looked this up, Rob, as you were talking. I have a tool that can show me how many people are looking for something on Google, and they're pretty liberal. You know, you don't have to get it exactly right. I just looked up, even today, for a Forex course, 3,600 searches per month. There's something with 5 times that volume out there, 18,100 searches per month. Can you guess what that phrase might be, Rob?
How to get rich quick in Forex?
Forex signals.
Oh.
They don't want to do the work themselves. They just want somebody else to tell them what to do. So it's even a thing today. And like I said, the reason why we bring this up is not that this is something that, you know, our listeners probably feel often, but I think it's still there. Because it was for me. Every time my trading would suffer, or any time I would make some money, but then I would take it all the way back down to break even, and I felt like I just wasted 5-6 months of my life. You know, I would say, man, is there maybe, you know, maybe not a substitution, but a supplement to my trading now that I can add on from maybe somebody who else is really good at this? You know, you start grasping at straws. You start searching for all these directions, and as we just said, Rob, it's not the way. It's not the way ever. But let's maybe break down why this is happening for a lot of people, and then, as we always do at the end, what we can do about it.
I think it's a great way to take this on, because in the end, we all react to things we need or find that are necessary. And whenever someone is in a situation of desperation, this is where they start to look for shortcuts. So if you were, you know, let's say you've got, you don't have enough money for rent by the end of the month. Oh my gosh, I heard about this Forex thing. that's going to force you to take shortcuts. Like you aren't even consciously choosing that you're going to take a shortcut. You're just thinking, oh, well, let me take a shortcut. And I've even had traders, it's crazy. They'll trade really well. And then all of a sudden, one month they go crazy. And they're like, oh, I had a big balloon payment on a real estate deal that I needed to make. And I'm like, and you thought you were going to make that in a week? But it's just because they are in that point of desperation. So just a comment and a caution to anyone out there, when you feel that desperation, your Forex account is not the answer. I guarantee you, I will bet a lot of money against you that if you are in a desperate time and you are trying to get money quick and you think your Forex account is going to produce it for you, I'll take the other side of that bet every single time because I know there's no way you can trade correctly with that mindset.
And even though we've spoken about desperation before, that's a perfect link to something I actually forgot to mention. And it's also the fact, too, that people, especially back then, and probably even now, they're so conditioned to just assume blindly that somebody out there creating content is out there to scam or out there to charge them a lot of money. I forgot one of the things that a lot of people would say, too, is like, you're just doing this so you can charge us money later, whether that's for indicators or a course or a trading room or something like that. And that was never my intent. But how do you... There's no way to prove that. You just have to keep making content for free until those people go away. And that's what I finally did. But I understand it. And the reason ties into that whole desperation thing you just talked about. So, for example, you have heavy Forex trading populations in places like Nigeria and South Africa. Two areas that, they have their rich people, but they have a lot of poor people too. And because of that, enter into the chat hordes and hordes of Forex scammers. That is almost a culture out there, to where it's not much of a culture anywhere else, but that's really something they had to deal with. So it's hard to trust anybody out there. But the whole reason why that culture existed in the first place is because so many people were looking for a way out. So that desperation leads to people probably falling for a scammer or two, or falling for a paid course that's just going to tell you stuff that's already on the internet for free, or something like that. I think that, you said before, you're going to tell me something that stings a little bit, and it did. But I have a feeling what I just said is going to sting with a lot of people too, because I think before you found the route you ended up taking, you went a lot of misguided directions, let's just say at first.
Let me add on to this. And again, hopefully if you've listened to all the podcasts, you know that I don't pull punches and I will say things that will make you sting inside. This is one of them. Whenever you look outside of yourself for answers, that's wrong. I shouldn't say it's wrong, but it's the wrong way to handle life. Because if you're in a situation, you say, oh my gosh, like I need $1,000 for rent by the end of the month. And then you say, oh my gosh, what about my neighbor? Or, oh my gosh, I think I saw my friend had some money underneath his bed, and if I took it and then I replace it back before he can see it's gone. Don't ever look outside of yourself. Always look inside. Look inside. What can I do to help make $1,000? So I really think when you get into this thing of desperation, it's very easy to channel it outwards to where you need help from others. And what I'm saying is try to channel it inwards to where then all of a sudden you say, I need to get more serious. I need to make a plan. I need to spend more time doing this. I need to do you see how much more powerful that is? But when you go first to look at external sources, that's desperation. And that's all shortcuts. That's all shortcuts because you aren't willing to do all the steps to get to that eventual goal.
That's true. That's why petty crime and violent crime goes up in down economies, because people get desperate and they start doing things that aren't inside themselves. They start doing things they normally wouldn't do. And so you have, unfortunately, normally good people resorting to, scamming or stealing or, something even worse sometimes. So yeah, I fully agree with that.
If you just channel it inward, always think, and this is something I've done in my life, and I think it's a really good thing to do. Whenever I'm to a point where I don't like where I am, I always say, the reason you are where you are is from you, not other places. I don't ever try to play the victim game where, oh, this person did this to me. Well, even if someone did something really terrible to me, I still made some choices off of that. Now, we've all had people do terrible things to us in our entire life. No one gets through this life unscathed. No one doesn't have scars by the end of their life. How did you handle those scars? How did you handle those moments? So again, always look internally. Don't look externally, because externally, this is when you're vulnerable to people being like, hey, here's this. If you just do this, you can make it easy. That's where you're very vulnerable. Always look inside yourself.
And there's another route. I don't want to say it's the opposite route, but I think it's certainly different than desperation. And I think this is very real, especially in Western societies, especially in American society, to where, okay, I went to school for 4 years. I got this entry-level job. I've worked my way up a little bit, but I also bought a house and I got a car and, I got a bunch of debt and things like that. And I'm seeing these people online, or maybe I'm even seeing people I know who are just out there killing it. And they have all these things and this lifestyle that I really wish I had. And I don't think I'm ever going to get there at the rate I'm going. I need to hit that gas pedal. I need something else. I need to catch up to these people. And it's that, we've talked about desperation before on the podcast. We've also talked about greed. But I don't know if we've ever talked about how it also ties in to taking shortcuts. Rob, I'm not sure if there's anything really more to elaborate on this, but I'll bet it's not always desperation that makes people really want to hit that throttle up button and start taking shortcuts.
There's absolutely a greed component here, and I want to share a story with everyone that just happened to me about a year or two ago. I have a friend who works with lots of NFL players, and she works with them in their health and their wellness and their injuries and everything like that. And she had a new rookie who just signed a really big contract, and he just got his signing bonus of a couple $1 million, and he was like, I don't know what to do. He didn't really have anyone in his own personal life that he could go to. So she said, hey, I want you to talk to my friend Rob. And so here is a kid who is new into the NFL. His life's going to dramatically change. And he didn't need to make his rent payment, is what I'm saying. He was fine. But he's like, hey, how can I take this money and make it bigger to where if something happens to me in my career where it only lasts 2 or 3 years, how can I make it to where it doubles, triples, quadruples? And the advice I gave him was, don't ever give your money to other people. Always have it in your own name, in your own accounts. You can have other people help you, but don't ever give it to other people. And the reason I say this is because we just talked about how in desperation, you look outward. Who can help me? Who can possibly make this pain go away? It's the same way with greed. It's the same thing. Hey, I've got this guy that tells me that he can triple my money in a year. Here you go. Here's my money. Greed does the same thing. It causes you to look for shortcuts. Look for, hey, you know what? Everyone knows that if you invest in the stock market over time, in the past, it's paid a decent return. Everyone knows if you buy real estate and you hold on to it for a long time, it pays a decent return. Even stuff like gold, silver pays a return. But people want it faster. And that's when they get really, really susceptible to scams. And that's the only time you hear about people getting their money taken, is when they were either desperate or they were too greedy. So really be on watch for that in your whole life. Always look internally.
Yeah, because the downside is the thing you don't see. I don't want to get too far off course here, but it reminded me of when I worked the most lucrative restaurant job I ever had in Vegas. It was tax season, and we were all talking about, if we were getting returns or what the case was. And everybody, because it's all based on your hours, you do claim tips and stuff like that, but we're all kind of making the same thing pretty much. We were all trying to figure out what our tax returns were going to be. And some people went early and they were like, yeah, you're probably going to get about $1,000 back. And, a few other people went like, yep, I got right about 1,000, little over that, little under that, whatever the case was. There were a couple people who went to this accountant in Las Vegas called the Money Man, and they were getting $4,000 back. And they're like, oh, is this guy a registered CPA? And they're like, yeah, he is. I'm like, wow, what am I doing with my account? I need to go see that guy. So this is not something I ever did. Just, I guess the whole idea of him being called the money man turned me off. But some people did, and then that guy went to jail 2 years later, and they all got audited. And they probably still get audited, because once you're flagged for an audit, it happens quite a bit.
That is a great story of greed where, again, people didn't need it, but, there's a guy I know, he can help you out.
We were all doing fine. We didn't even, there was not even desperation. That was just pure, unadulterated greed. And some people fell for it. And I'm not going to lie, it sounded like a pretty good idea, but I thankfully I never went that route. So moving on down from the two obvious ones, other things that might be going on psychologically, Rob. I know we touched on the two main ones. Do you have any other ones to add before we get into the solutions?
Well, there's one more, and it really just goes together. Just think about, and I'm not standing here like, oh, I never did this as a young trader. This was literally me as a young trader. Number one, I don't want to go get a dumb desk job. Number two, I don't really want to go get a college degree. Number three, this trading thing was really cool. It looks like you can make a lot of money. So I was every one of these things we're talking about. It wasn't quite desperation, but there was greed and impatience. Impatience, and this was my biggest one, was impatience. That I looked at all these other ways, and there's, as a 20-year-old, all the doors are open. You can oh my gosh, I could go do this, I could do this. And those were all, 5, 10, 15, 20-year kind of plans, and I picked the shortcut. I wanted the shortcut because that's who I am. And so it comes with desperation, it comes with greed, and by default, it comes with impatience. I'm sure there was 1 out of 100 people that got into Forex and they understood that this was going to take 5, 10, 15, 20, 30 years before it really started to pay off for them. I'm sure there's 1 out of 100, but there's 99 of us that lied to ourselves, or we didn't even know enough to lie to ourselves because we didn't even know enough about how trading actually works. So impatience is absolutely one of them. And I love the Malcolm Gladwell book, The Outliers. I know there's a lot of people that say, the whole 10,000 hours thing is BS, and it is BS. Some skills take 10 hours. Some skills take 50,000 hours. Some people learn something in 1,000 hours where another set of people learn it in 2,000 hours. Look, it's a nice round number. It's not really a thing, but it basically says until you spend enough time, effort, and energy at something, you will not be proficient at it. And we've all seen the Dunning-Kruger effect. And if you haven't, jump online, look at Dunning-Kruger, how in the beginning, we all think we're better than we are. And then we get a little bit down the pathway and we get slapped and finally understand, oh, this is really, really hard. And then we have to go through the valley. And the valley is tough. The valley is losing money. It's thinking you have a system that falls apart in the end. It's all of these things that test you. There's no way to become a trader without going through the valley. We have a saying at Maverick, traders aren't born, traders are forged. Forged through fire and pressure and heat and pain. That's how you get out of it. And I thought I was choosing the easy way. I was probably choosing the hardest way to make money in this world. Look, I don't regret it, but I'm telling you, there was an easy pathway, and my son, who's now 22, I'm steering him away from trading because I understand how difficult the pathway is. Let me correct that. He's still trading, but he's not going to be trading for his lifestyle. Trading is going to be something he does along with all the other things he does. Because I thought I was only going to trader, that's all I was ever going to be, and that's it. So I wanted to put him on a much easier path than the path I put myself on.
Well, it's those valleys you talk about too, where I think this desire to take shortcuts starts to pop up. And that really was the whole reason I put this episode together. Because I don't know about you, Rob, but you talked about being impatient, but in the actual realm of trading, did you ever go seek out any other shortcuts? Because I know I did. I did it a couple times, especially my first couple years before I really discovered the way I trade now. I was looking for any way out, especially when things were bad. I've bought signals before. I have bought courses before that I paid money for so they could just tell me something I've already read on a blog for free. I've gone that route before I moved forward. Did it ever come to that for you?
So I'm going to say no. And at first, I don't want anyone to react like, oh, he's saying no, like, oh, he's great. No, that's how egotistical I was. It's ridiculous that I didn't go look for other people because I was so convinced that I was the only person that really knew anything, that I wasn't really willing to go to anyone else for help and assistance. That's me. That's one of my really negative qualities. Look, it's been a very good quality in a lot of things and a very bad quality is that, again, I always look inside. If something's not working, I'm only looking inside, and it's very egotistical to do that when there actually are people around you that can help you. And if you ask my wife, I mean, she'll tell you all the time that I do not allow her to help just because it's not who I am. So I'm not saying it to like pat myself on the back. I'm saying like this is a major problem in my life that came up in trading where I probably hurt myself by not asking people for some help.
So again, we've touched on the main two, desperation and greed. I think impatience is a really good one. I think that ties in really well. Are there any other things, you're the deep psychological guy, Rob, things that are going on in people's brain. Is there anything else that might be happening when people seek out these shortcuts that we haven't touched on yet? Because I want to get to the solutions, but if there's any more of these aspects that could be floating around, I want to hit them first.
I want to just talk about one concept here, that if you grew up playing sports, I grew up playing sports, I love sports, and there were people that loved the game, but they didn't love practice. They loved the games, but they didn't like practice. Now, the game in Forex is when you are actually clicking the buttons and actually have money on the line. And the games are the best part. I loved games when I was playing football and rugby and all these other sports. I loved the games. But you know what? I understood the practice is where you improve. So a lot of people love the game. You got to love the practice. If you want to succeed in the game, you better put in the work in the practice. The people that put their work in practice over and over and over and over and over again, when they get in the games, they do well. The people that don't practice, they don't do well. So going back to desperation, greed, impatience, talked about the 10,000 hours. In this podcast, we've talked a lot about the effort it takes to become a trader, and it's the practice aspect. It's when you're not on the field. It's when you're backtesting something. It's when you're building strategies. It's when you're journaling and doing all the unsexy things in trading. That is how you don't take shortcuts. That's the opposite of taking shortcuts. We all want to take shortcuts. Just understand, you got to put the work in the practice before you can succeed in the game. That's really what I wanted to talk about and just get that into people's minds, that it's the practice that makes you good in the game.
But Rob, I've always been the type of person who has believed that you should work smarter and not harder. And I've always been pretty smart as a kid growing up. I didn't need to study as hard as the other kids do. And now I'm a little bit older and reality's hitting me. And you're preaching all this work and stuff like that. Why do I need to work when I have the Forex baboon over here and he says he can get me 20,000 pips a year guaranteed? One seems like a pretty smart route compared to the other one.
One you have no control over. What if the Forex baboon dies? What are you going to do?
My trading will probably get better by default. would be the real answer there. Yeah, there too. Well, I'll move on to the Forex orangutan. There's always somebody out there who probably does this better than me. Why don't I just take from him? They're offering it.
I'm as an egotistical SOB. First of all, I don't even understand that concept. But I love to have control. One of the things I've loved so much about being a trader and building my book and building my bank accounts is that I have had the control. And I cannot get the rug pulled out from under me. And Patrick, I'm going to say something crazy on this podcast. And I told my wife this. I said, I want to go get my neck and face tattooed. And she just stared at me and said, what? I said, yeah, because if I tattoo my neck and my face, I could never get a job again. And I want to make sure I never have to. I know that's crazy. So, and I'm not going to tattoo my neck and face. Actually, I might, who knows? But that's who I am, is that I always wanted to have that kind of control. So look, everyone's built differently. And like I said, there are people out there that help. I mean, look, you're listening to a podcast of two guys that are literally giving you their knowledge. Don't be like me. Accept it, be open to it, look and see if it's valuable to you. If it's not valuable, throw it away and say, okay, guys, you're thrown away and I'll go look for something else that has value in my life. That's fine. Do yourself a favor, put in the work, have the control. It'll be much more meaningful to you. There are people on the route that are going to help you. And look, I didn't get to where I got all alone. I definitely had help. But look inside, put in the work. That's how you become successful. Successful enough to where maybe you can tattoo your neck and face one day.
I still think you should do it. It'd be like on The Office where you had Steve and then you had Prison Steve. You know, we could have Prison Rob.
Nice.
And he can be a guest. He can be a guest on the show, yeah. But the answer that I would give to the question I was asking you, because you probably didn't pay a whole lot of attention to things like this, to where there was a point in time where I did, and I noticed that as far as all of those paid services go, very few of them actually lasted more than a year or two. And usually it was just really good marketing that took them a couple years further. So they're not sustainable. You know, if you really want to do this, this can be, if you want, a lifetime skill. If you're 25 years old and you plan on living to 80, you can do this for 55 years until your brain just completely goes. Tell me that's not worth something. You know, would you really risk it for 1 year of a signal service when you can actually have something that's forever? I know that's not going to get you out of this situation that you're in right now, but nothing else is either. I hate to break it to you. So listen to what Rob said. You know, that really is the actual solution to this entire podcast. And, you know, that's my solution. You've pretty much said your solution, Rob. Do you have anything else before we go?
Look, we could have saved this whole 45-minute conversation with, you think there's shortcuts. There's not. Deal with it. There we go. We should have said that right in the beginning.
We could have, yes. But I think people enjoy our longer form content. And it won't be 45 minutes because you and I talked a lot of bullshit back and forth in between some of these things. So expect a 35 to 40-minute podcast coming up soon. And thank you once again for tuning into the Trading Psychology Podcast. Rob and I will see you in the next episode.
Goodbye, everybody.
This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he always is, he is the Sultan of Maverick Currencies and the Flat Earth Trading Society. He is Rob Reinhold.
Well, hey, Patrick, how's it going? Sultan, that's a good one. I like that one quite a bit. Good to be here. Always love to talk trading psychology. Let's jump into it.
So a bit of an unusual episode, I would say, compared to what we normally do here. But something that, again, I would imagine that this has affected the lot of you at some point. Because we all love trading. And we all get really excited about it, or at least, you know, depending on how many years you've put in, you're probably still in that new car smell stage. And you want to share this excitement and this happiness and this hope of a better life with other people. And you know, even better if it's somebody who you already know and who's somebody who's close to you and in your inner circle. And what I would say is just understand it's not always that easy. I would even go as far to say, Rob, that it's probably pretty darn difficult, and especially because maybe they inquire about it, they show a little bit of interest, and that just perks up all of your sensors, and you're like, wow, I'm going to get this person on board, and it's going to be awesome, and I can't wait. And we have all these ridiculous expectations. And rarely do they ever manifest themselves the way we would like. Fair to say, and can we go ahead and make an entire episode out of this? I think we can.
Oh, we can definitely make an entire episode out of this. But I want to be very clear about what this episode is about. In this episode, we're going to be talking about when you want to share this with someone and you sit down and you say, hey, let's go over trading. Let's talk about it. Let's help you get an account set up. I was so excited. After about a year and a half of trading, I was so excited. I grabbed some of my friends. I grabbed my brother and I'm like, you guys got to come do this. This is awesome. You've got to come and do it. And I was just so excited. I want to do this episode not for the people that you're going to be talking to. This isn't a how to get them, to be successful. This is not about them at all. This episode is about you. When you dive into this process, you are going to do some things to possibly sabotage it and to possibly do some things that are going to cause you some pain in the future. This episode is all about you in this process of sharing trading with other people and helping people out with their finances, whatever it is you're going to do. We want to make sure that you are doing it the right way.
So yeah, I've wanted to do it. You've wanted to do it. You've actually done it. I've actually done it. I have not been very successful at all. And I think really what it comes down to is choosing the right person. I think my mistake in the past is finding somebody that might have exhibited maybe one or two traits that you need to become, successful in this endeavor. But it takes a lot more than that at the end of the day. Would you agree?
Would I agree? Patrick, this is literally the story of my first couple of years. And I think I've told this story before in one of the podcast episodes, but I'm going to tell it again because it's perfect here. When I got started trading, I really wanted my wife to do it with me. I really wanted her to do it with me. And I kept trying to talk to her about it, and she showed no interest. It's actually one of the reasons I really fell in love with her is that she didn't care about money. She didn't care about money at all. It didn't matter to her. It just wasn't a thing. And for me, that was, of course, my whole thing. So I was trying to get her to be interested in trading and try to do it with me, and she wasn't showing much interest. And then I thought, okay, well, what about if I get her interested in shopping? And so I came up with this plan, this idea that I was going to set up an account for her, and we were going to trade together, and she could take all the money she made and go shopping with it. And I thought, okay, so that was a plan. I set up an account in her name, put $5,000 in it. I told her about it. I'm like, hey, I already set up this account, and we're going to do it together. And over the next month, I kept trying to bring it up, and she's like, oh, I'm busy. I'll do it tomorrow, or we'll do it next week, or whatever. And finally, one day we were walking in the mall, and I said, oh, do you want to go into the Gap? Now again, remember, this is back in the 90s, so don't judge me on that comment, because again, this was back in the 90s. And she said, oh no, the Gap is terrible. Their clothes have gone terrible. No one likes them anymore. So I said, great, let's go home and short the Gap. And she looked at me like, what? What does that mean? So, I explained to her what shorting was. And so we got home after going to the mall, and we got her account, and we sold some shares of the Gap short. And then she said, well, I really like Target. I love Target. Every time I go in there, I end up spending $200. And what about Target? We looked at the chart. The chart looked good, so we bought Target. So over the next couple of weeks, Target went up, the Gap went down, and she ended up cashing out. I think she had about a $1,300 gain, if I remember correctly. And I got a withdrawal for her, put it in a bank account, and she went shopping. And I thought to myself, oh man, I got her. She's going to be so excited. We're going to be that husband-wife trading team. And not a word after that. And finally I said, didn't you love that? Don't you want to do that again? She's like, no. I said, don't you want to learn how to trade? She's like, no, that's what you're for. I just want to be a mom. And I'm like, yeah, okay. So yes, I have very, very firsthand experience about taking someone who really has no interest in this and try to force them to do it, all because of my ego of what I wanted and what my expectations were. Yeah, I definitely have experience with this. And this is one of the reasons for this episode, is to make sure you guys don't fall into some of these pitfalls like I did.
Yeah, so my story is a bit different. I at least realized from the start that nobody within my friend group or my family was really anything like me. I've always been the weirdo and the oddball in those groups. And so I pretty much knew not to pitch this to them. But when I go out, I'm often very social. I have no problem talking to people. And usually at some point in time, whether it's a bartender or just a friend of a friend or somebody you meet out, they'll ask you what you do. And then, I was waiting tables, which is unexciting, but I was also a Forex trader, which is exciting. So guess which one I led with? I would always talk about Forex trading. They're like, oh, what's that? Because Americans don't know what Forex is. And so that would take a bit of explanation. But some people would really perk up and be really interested in it. Now, these are strangers. I don't know what their qualities are, but at least they have the interest. That's way more than I would ever say for my family or my friend groups. And so that was something to really go on. And so, sometimes we would exchange numbers or emails or something like that. And then I would tell them where to go. The same place I tell everybody to go to babypips.com and learn. And I said, once you're done, come back to me and I'll tell you what to do from there. Honestly, Rob, if I told 50 people, I only had one person out of the 50 come back. And I actually helped them a little bit up front because this is before I had my channel. And that was kind of right when I was starting my channel. So I kind of took them over there and they watched some videos there. And that's really the last I heard from them. So out of 50 people, it was one person. And to my knowledge, that is as far as they ever got. Maybe they're still trading right now. I don't know. But that's a really bad ratio. That's a lot of wasted time and energy that I spent trying to get people onto something that at the end of the day, they might have shown interest, but they just don't have what it takes to even complete baby pips and then send me a response email. Like, to me, that's nothing. That's sure to most of our listeners, that's a drop in the ocean of what it really takes to do this. So I guess my question to you is, and I'm going to put you on the spot here because I don't see this on our notes. Despite the obvious, if you're talking to somebody for the first time, or if it's somebody maybe you work with or kind of know, what would you say are 2 green light qualities somebody should probably have before starting something like this? And what are 2 red light qualities that if you are aware that they have these particular qualities, trading is almost certainly not for them? And again, try to avoid the obvious.
All right. So for green lights, I'm going to give 2. Passion. Someone with passion. The second green light, someone with, I'm going to say work ethic. Now, I coached my kids' soccer teams, and I love doing it. I love coaching my kids' soccer teams. And I remember my daughter's soccer team, we were playing some games and we had some good players, but the other teams were just so much more physical than us. And whenever there was a 50-50 ball, our players didn't go in there as hard. And so we're losing all the 50-50 balls, and my girls are always constantly getting like knocked to the ground, and they just weren't tough enough and they didn't want the ball enough. So I decided, as a brilliant head coach of a 9-year-old girls soccer team, that I needed to toughen them up. And so for one whole week in practice, all we did was a drill where I had one girl on one side, one girl on the other side. The ball was in the middle. I'd say go, and they had to fight for the ball. And whatever girl won the ball, the other girl had to take a lap in running. So I had some incentive for them to try hard. And you know what? That week of practice was the worst week of practice. Everyone cried. And you know what? We showed up to the game on Saturday, and guess what happened? No one wanted to get the ball, and everyone got pushed down. And I right then I realized you can't coach someone to want the ball. I can show you all the skills. I can do everything else. But if you don't want the ball, there's nothing I can do for you. So the green light, Patrick, are someone who wants the ball, someone who has passion, and someone who has work ethic.
Okay, and it kind of reminds me of this maybe 10, 15 years ago. It was the Oklahoma State college basketball team was playing soft, and so the coach actually had them practice in football pads, and it actually worked. It was a mind shift, saying that, look, if you go up for that rebound, you're gonna be fine. It's not going to kill you, and it actually worked. I don't know how long it worked, but it's a bit antithetical to what you were talking about. But again, we're talking about college age athletes compared to 9-year-old girls. The passion was probably there. Maybe they were just not playing as aggressively as they should, and they just needed a little bit of a tweak right there. But I know exactly what you're saying. And I think with most people, If you can tell what they're really into, like, is this person really into music? Is this person really into video games? And is this person really into gardening? Whatever it is, if they have a passion for something and they're willing to not only go all the way with it, but almost make it part of their identity to a degree, you might actually have a real candidate on your hands. That's something. But if you actually know somebody and you can't think of anything they really do or what they're really into, I think that's a good way to maybe just go somewhere else with this. So I like those two a lot. Now, do you have any red light qualities that aren't just the opposite of what you just said?
Yes, I definitely have some red lights. So the first one is going to be someone who is a compulsive gambler. And again, maybe they're not a compulsive gambler, but they just have that mentality. But this next one, I've been so thoughtful about this because I've thought deeply about what does it take for someone like off the street to be a great trader. And this is what I've come up with, Patrick. And I don't know if this is right or wrong, but this is what, after 25, 27 years of experience doing this, I need a risk taker, but they can't take too much risk. So if you take a look on a spectrum from like someone who is not a risk taker, taking no risk whatsoever, to someone who is an all-out risk taker, I need someone who's at least in the risk-taking half. So if you can think of like a little meter from like to the left, like all the way no risk, to the right all the way total risk, I need someone that's at least past the midpoint, that they are willing to take risks, but at a certain point, that risk-taking becomes a negative, and it's really difficult to get that one to succeed because part of trading is not taking too much risk. And when you take a full-on risk taker and you tell them don't take too much risk, it's really against their personality. So I don't know how to quantify that, but I've thought very deeply about this question. I need someone in that area that's willing to take risks, but not willing to risk at all. So outside of those areas, that's my red light.
Gotcha. And I'm smiling when you're saying this because I think that fits me to a T. Like, for example, I invest in crypto and not just Bitcoin. And that seems absurd to a lot of people. It makes them think I'm a lunatic. When in truth, I'm risk tolerant for sure. But I typically only stick to large cap tokens at the same time. So I'm not all the way there, but you could say probably most of the way there. So if you know anybody that fits that criteria as well, I would agree. Probably a good candidate. Now we're getting a bit off track here, and I'm okay with that personally. But just a kind of an off-topic question, would you say, now think about this one, would you say that a recovering drug addict or a recovering alcoholic might actually make a good trader because they can refocus that energy or that addictive personality into something like this? Or do you think it's too risky for them to do something like that given all the emotional ups and downs of this market? I'll give you time on this one.
This is a fantastic question. And I wish you and I were at a bar somewhere with some drinks in our hand because this would go on all night. It would be amazing. I see both some positives and negatives with this. I think initially I was like, this is an absolute positive because behavior change is the most difficult thing a human being can do. It really is. A true behavior change. And someone who has gone through that process has literally done everything we've talked about in the Trading Psychology podcast. Now, look, it's with money, it's with trading, but I'm telling you what, it's the same. It's taking your natural inclinations and how do you get your natural inclination? How do you not follow that and go and do something else, even though you didn't feel like doing it, it wasn't natural? So that process is very similar. So I think somebody that has gone through that process, a very difficult process, much more difficult to get off of substances than to learn how to trade. I can tell you that much. Absolutely. I think it's a real positive. But on the other hand, I do hear stories of people that do go through the programs and they do behavior change about not being addicted to drugs and alcohol. But it's very common that I hear them just switch their addiction to something else. It's shopping, it's exercise, it's something else. It's part of their personality, so maybe they can't get rid of it all the way. So I think if that's what they're using trading for, is just to replace an addiction, I think we've got a whole bunch of new problems with that.
Yeah, it's interesting too because I've seen a lot of people who like later in life became super duper fitness experts, or or they find religion and get really really deep into it, and so they're the addictive personality never went away. They just replaced it with something else, and they were able to go full force into it for the positive. So that's a really interesting thought. Let me pose this to the audience too, to the listeners out there. If any of you have ever suffered from either of those two addictions, or an addiction to something else, and you trade now, how's that experience going? Do you feel like it was an actual benefit? Do you feel like it's almost a borderline superpower that you've gone through that before and now you're going through this now? I'd be really curious to hear from anybody who might actually fit this criteria. So if you're not listening to this on YouTube, I know the majority of you don't, go to YouTube and just know that every episode is on YouTube. Look this one up and let us know down below in the comments section. I would be fascinated to hear somebody's experience who has gone through something like this.
I am going to be glued to the comment section for the next month or two. So please share it, because I think this is a very, very interesting topic.
For sure. But I know we're getting a bit too off course here. So let's get back on and talk about, if you do find somebody, given what we've told you already, that you think would fit the criteria and you would love to share this opportunity with them, how should that process actually go? Because this is something I've never thought of. And maybe the reason why some of these people didn't really go through all the way with it was maybe it was on me. Maybe I didn't approach it the right way. I couldn't even really tell you what I said or did, and go back that far and think. But I'm not ruling it out. Maybe I could have handled this a different way. So Rob, if you had to start it all over with somebody, how would you actually go through the process? What do you think is the most optimal way?
I've had a lot of people come to me in my life, and I've got right now nieces and nephews who are now getting into their 30s and they're starting to get really into finance, and they come to me and look, I always have an open door, but this is how I approach it. If you want help, the door is open. And I tell them, don't say anything now. I said, I want you to go home and really think about it. And if this is something you want to do, I'm here. I'm here 100%. But I need you to really go home and think about it and really think about what it means. And I talk to them about this is what it's going to take. I tell them all, it's 3 to 7 years until you are good enough at this to make this a stable living, or at least a stable part of your cash flow. And this is what it's going to take. And you tell them, don't let them say yes right then, because everyone says, yes, that's what I want. Yes, of course, that's what I want. No, let them go home. Let them think about it for a month. And if they still have that passion and fire after a month or a week or whatever it is, and they reach back out to you, they're coming to you. I think that's the right way to do it. I think you just make offers and make them very general. Like, hey, you know what? If it's something, they come, hey, trading is great. I've started dabbling around, hey, can you help me out? Like, hey, look, door's open, but this is what it takes. If that's what you want to do, let me know and we'll get going. So I think you have to have them take the first step. Don't push it on anyone. Make them chase you down and make it difficult. Give them like little jobs. Hey, read this book first. Read this book first and we'll talk. Make sure that they are the ones that are chasing you down for the information, not you pushing on them.
So I feel better then, because that's pretty much what I did. And so I feel like I did that part the right way. But then, let's say you get that 1 out of 50 or whatever the case is that actually follows through and gets to that point. Now, that's really rare, like we spoke about before. So you feel like you might really have something here. But as we know, Rob, the failure rate in this game is extraordinary. It's off the charts. If you have somebody like that, maybe already in your life, who is going through this process, or at least trying, or at least has some enthusiasm behind it, what type of expectations should we have going forward with this person? Because I think it's easy to get overexcited, because for once you actually have somebody that you personally know who's going through the same thing you're going through and you can share ideas with and things like that. But I think it's a little too easy to get carried away. Like I said, I've never had somebody really in my life that I could do this with, but I feel like if I did, I would have to really restrain myself from going overboard here.
What you just said about expectations is really what this entire episode is about. Expectations. And I remember years ago, my brother and his spouse were having some marital issues, and they were on their way of getting divorced. And in one of their last sessions together, my brother told me that their counselor told this to him. And he said once he said this, he's like, I knew like where everything went wrong. And this is what the counselor said. Well, expectations are a bitch. And he explained that of all the couples that he's met with, it's more about the expectations that one person had of the other than it was about the actual behavior that they did. And so when my brother looked back and looked at his expectations, he realized that, yeah, he was partly to blame. When at first he was like, no, it's all her fault. It's not my fault. But the expectations are the things that disappoint us. The expectations of who that person is going to be. And this is not just in trading. This is in everything with life and relationships and jobs. Like, the more expectations that you put on it, the greater pain you're going to feel when it fails, or if it fails. Expectations are a bitch. Now, I have a philosophy in life. I look at every situation, and I never think best case scenario, because if I reach best case scenario, it was as expected. I do like, I'm not worst case scenario, but I'm more like in the middle. Hey, if it's better than average, I'm happy. If it's worse than average, okay, obviously it wasn't good. But those expectations, setting the right expectations in your life will greatly depend or determine the outcome of things. So if your expectations of this person that you are working with is that they are going to be a superstar millionaire trader, you are setting yourself up for failure, and you're also setting up that relationship for resentment and hurt feelings. The expectations going into this are the right thing. And your expectations should be, after you've gone through the process and understand it, the expectation is that they work hard. That they work hard. Nothing else is a guarantee, but that is something they can control.
I think that's really great. And I can almost, when you talk about relationships, I can almost tie this into dating as well. There's a couple reasons why. I'm in my 40s and I'm not married. But I think a big reason early on, and I'm actually a bit thankful for this looking back on it. I really like where I am in life right now. I don't have any regrets here. But a big change I made in the way I approach dating and women in general is I used to get so frustrated. And I think this happens with people like me, that they just weren't thinking logically enough, and so many things they do and say just don't make sense, and there's no consistency. And God damn it, why can't they just think like a man? Why can't they just think like I do? And it took me a long time to realize that they don't think that way because they're not men. And they can be just as intelligent, if not more, than you are, but they do things differently. They have been hardwired over the course of millenniums to survive, just like we do. But they do it in a very different way, and you can't fault them for that. That's how they do things. We do things this way, they do things that way. And that was a big shift for me because, you should always have expectations going into a relationship, of course. You have to have something. But my expectations, I think, have become a lot more general, if that makes any sense. And I have been able to enjoy and appreciate women, I think, a lot more than I have before. And my relationships now, even though they typically still don't last very long, have been very fruitful. And and a lot of them I still talk to later on in life. But there is that change you have to make. Expectations cannot be specific to you. I think that's the big takeaway there. And because I never really had a protege or anybody personally in my life like that, I can at least connect it to that. Because, man, I know so many people that just their entire lives, they have these really specific, rigid expectations that, for the opposite sex that only apply to their own sex. And it's crazy. And I'm so glad I broke out of that. And again, we keep going off on tangents here, Rob, but I think we can tie a lot of this back to what we're talking about here. But that was just one of the biggest revelations I had. And as somebody who actually got married early and found the one who's completely different, did your expectations change over time? I'm curious to know while we're on this subject, even though this was somebody you were committed to and married to.
Before I answer that very loaded question, I just want to touch on something you said. And I don't even know that you said it or you recognize that you said it, but this is so poignant. Expectations say more about you than it does about them. I love that. Your expectations are about you, not the other person. So when you have expectations on the other person, it's you with those expectations. So, yeah, beautiful. Let me get into your loaded question about marriage.
It was so loaded too. You nailed it.
My wife and I have had the easiest marriage I've ever seen. We are still best friends. We still just are deeply in love with each other. We're crazy about each other. But marriage is also the hardest thing I've done. And the reason I say that is that it takes constant effort. And just think about how much you change from age 23 up to age 40 where you are. And imagine you had someone who is going through just as much change, if not more than you, during those times. Your expectations of who she should be are landmines in all those decades of change. And, one thing we always wanted for each other is we wanted the other to be happy. That was the most important thing, more than anything else, is that she's always wanted me to be happy. So when I came home, when she was 7 months pregnant with our first kid, and told her, I want to be a trader for my life, a lot of people would be like, no, that's not what I expected my husband to have a job that paid a stable living. And he wants to go do this crazy thing. All she said was, go for it. And same thing, whenever she wanted to do something, it's like, I'm your biggest fan. So back to the expectations. If you just have expectations of love and acceptance, and again, you be totally honest with them about your process, and Patrick, that's something that people value so much with you, is that you tell them your negatives. You tell them your pains and your stumbles. Tell them that and let them know the whole thing. And then have no expectation of them, because that says something more about you. If they love it, if they're passionate about it, they'll put in the work. And we've talked about how trading is just an engineering problem. It's just going to take time and effort. But if you have these expectations, you're going to set this relationship up for failure. You should just want them to be happy. That's it.
So a few things on that. Yeah, I completely agree. Expectations go both ways. Remember that. They have expectations of you as well. And yeah, the good news is unlike a marriage, you're not going to have to, a lot of things you would do in a marriage, you can not have to do on a relationship like this with somebody who might be studying under you, or just somebody who you gave this information to and let them run with it. Either way. But one thing I do want to touch on before we close out here, Rob, is the very last point you have on these notes, because this one hits home. You have under expectations. They might blame you if they fail. Now, we know the fail rate in this industry. Chances are they are going to fail. What is their reaction going to be? I think I almost can't fault people for this sometimes, because I know how it would feel to put in this much time and effort and passion into something and feel like you haven't made it. But be ready for that. As a YouTuber that gets blamed for everything when people don't make it, this could happen to you too. And how would you personally deal with something like this, Rob, if it was somebody that you actually cared about?
Ooh, that's a tough situation, because at that time there is nothing to do. If it gets to that point, then they had expectations, and they tied you to those expectations. And it basically says that you weren't aware of those expectations, or you didn't do anything to reset those expectations. So this is why I said, in the beginning, be brutally honest about the business. Be brutally honest with how long it takes. That's what I do. And I do it to discourage people. I mean, honestly, when I talk to people and they're like, hey, I've been wanting to get into it, I'm like, hey, don't get into it unless you absolutely love it. People ask me all the time, like, is your son, my son's 22 now, is he going to get into trading? Is he going to be a trader? And I'm definitely not pushing him at the moment because he is not at the right place. And if I push him, it's going to be bad. And that's where the resentment comes from. When you let them come to you and you're just guiding them along this process and you're telling them, hey, it's going to take you a couple of years of study and back testing, and you got to build systems and test those systems. If you've built the expectations the correct way, they really shouldn't be able to come back on you in the end and say, this is your fault, if you set the expectations correctly.
Yeah, that's the point I was going to get to if you didn't get to it. Yeah, a little bit up front goes a long way. I feel like I did a decent job of this on my own channel, but I could have actually made a dedicated video just outlining expectations for people going forward. I just didn't know what the rest of my videos were going to look like at the time, so I didn't do it. I'm almost considering making a video in 2024 and putting it near the very start of my playlist saying, look, before you dive into this, here's what you have to know. Because as you and I both know, when we first enter this market, our expectations are completely different from reality. So I think that would be a good idea. So yeah, maybe I took a little bit out of this myself. But thank you, everybody, for listening to the Trading Psychology Podcast. I think this has been a really great episode, Rob. Let's do it again next week. We hope you join us. We'll see you then.
Goodbye, everybody.
This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, it is the gallant Rob Reinhold.
Well, hello, everybody. It is great to be here with you. Let's get inside that brain of yours and see what makes you tick.
Yeah, and we're going to go back to basics a little bit with this episode and talk about just simple trading mistakes. I don't think we've really spoken too much about it, or at least we haven't dedicated ourselves to it. But as we all know, mistakes happen as you get more experienced in this field. They should become less and less. And as I always say, you should be documenting these in your journal. That is the single most important part of your trading journal. And if you guys aren't doing this, then you're not doing things optimally. And the margin of error is so small in this business that if you're not doing things as optimal as you possibly can, you're really hurting yourself in the end. So I will assume that you are chronicling these mistakes. And Rob and I are going to talk about what to do about them from a technical perspective and from a psychological perspective. And Rob, go ahead and just take it from here.
This episode is very interesting because at first it seems like it's not that big of a deal because we have been talking about so many huge trading mistakes. What we're really talking about here is those little trading mistakes, like you hit the wrong button or you did something a little bit like that. The reason why we're covering that here in a psychology podcast is that we don't want those little mistakes that are bound to happen to get into your subconscious and then create a large psychological problem. So at first, it seems like a pretty simple thing, but when you really get into it, there's quite a bit of depth into handling these situations.
And so for further reference, hitting the wrong button. So I'm thinking, some good examples of this would be hitting limit instead of stop, or putting a decimal point in the wrong place in your stop or your take profit. This is kind of what you're alluding to, right?
Correct, yeah. Technical mistakes. So again, this episode is going to be about technical mistakes, not psychological mistakes. We've covered those in depth, and we're going to keep coming up with more and more episodes. But this is what happens when you fat finger it. What happens when you get a decimal point wrong? Let's make sure that that doesn't cause a psychological issue in the end.
Okay, good, perfect. And before I forget, if anybody who's listening to this on YouTube or wants to go to YouTube, if you have a funny story or just a battle story about how you did something like this, because I guarantee you, if you've been in this industry for 6 months minimum, you have absolutely done this at some point, no matter how meticulous and precise you are. I consider myself to be a very meticulous and precise person when it comes to things like this. We've all done it. We've all done it multiple times. So put your stories down below if you have one, and we'll go ahead and get started here.
I was trying to think of a good story of mine, but it's like one of those things, like you've made so many of these that they've all just blend together. And And really what the big deal is, and this is what this episode is going to be about, is that in the end, they didn't matter. They didn't really matter as long as you handle them correctly. So the first thing that we need to start out with is to totally understand we are human. We are going to make these little mistakes every now and then. Do not beat yourself up over them. Do not. They're guaranteed to happen. Some people are going to make them more than other people, but everyone, as Patrick said, is going to have this little issue. So first off, don't beat yourself up, because again, beating yourself up, then all of a sudden you get into that negative psychology to where then it's like it cascades into a much bigger problem. You really just have to take a look at it and say, okay, oops, it happened. What do we do next?
Yeah, and I'll even say it right now. This happened to me not even 3 weeks ago. It wasn't on trading. It was on investing on my Schwab terminal. And I made a mistake. I meant to buy this stock right around 40 cents. Not 40 at the time. It was more like 38 cents. I wanted to catch it if it went to 40. Put in some wrong information and completely missed it. I went back the next day, wondered why I didn't have any, and now it's sitting around 57 cents. Not even 3 weeks later. Lesson learned. And again, I've done this so many times, but you still feel like the biggest rank amateur doofus every time you do it. But just know, it's common, and even people who have done this for a very long time are doing it too.
And one thing I want to point out with your story is we talked a little bit about survivorship bias and how we remember the things that hurt us, but we don't remember the things that helped us. You could have easily put that in wrong. The stock could have gone the other way. You never got filled. And you'll forget that one. You'll forget that one every single time, but you'll remember the ones that got away or made you have some sort of loss. Understand that these are going to help you and hurt you at an equal amount over your trading career as long as you handle them both the exact same way. The good ones and the bad ones. So first thing is stay calm. When you discover that you have made a trading mistake, a technical trading mistake, stay calm. And again, this is where you then just go into your plan. We're going to go over a couple of different ways to handle this. It's really great if you can pre-plan what you're going to do when you find these mistakes. So for example, you put in a stop order and you thought it was good to go canceled. You check the next day, your stop order is no longer there. What is your rule for that? Now, obviously, that's a pretty simple one. You just put it back in. But there's going to be other little situations where you can predetermine what it is you're going to do. So when it does happen, you don't have to think about it. It's already predetermined. My advice is to take a little bit of time and think about some of the possible mistakes that you can make with your finger. That sounded really dirty. Let me say that again. Some possible mistakes you can make in your trading and the solutions you're going to have from those.
Okay, good. And if you could, just a little request from me, talk about maybe those mistakes you discover quickly and maybe those mistakes you don't discover for a long time. I know that's got to be pretty hard to do, right? But I've told this story several times. My very first year at Maverick, that dollar CAD short that I got in by mistake because I didn't. It's something to do with the stop loss or the take profit. It was the stop loss. I didn't. Back then, Interactive Brokers want you to confirm everything 500 times, and I confirmed 499 times, and my stop wasn't there. And I went from a winning trade to a very, very big losing trade in my very first year of being a prop trader, and it was a hole that it was going to take a really long time to dig out of, not to mention what I felt you guys were thinking on the other end. So things like that, compared to me just fat fingering something and figuring it out the next day, those are two really different avenues to travel in my mind. So I'm very curious to hear what you have to say about this.
I think you make a great point. There's that mistake you make where you are there, you click the button, oops, I hit sell instead of buy. Those are very easily corrected. The ones that aren't easily corrected is when you find them later. Now, this is the dangerous one. These are the dangerous ones. So let me just quickly cover what to do and how to handle it if you make a, let's call it a fat finger mistake, where you're there, you see the mistake. You want to minimize the damage. You just want to just minimize it. Even if it's going for you, going against you, you want to unwind that as fast as you can and with as little cost as you can. Depending on what you're trading, this is going to be a little bit more difficult. If you're trading Forex, Forex is awesome. Very, very tight spreads, very low commissions. Again, if you pay any, a Forex fat finger trade should be fixed immediately because the costs are so small. However, if you make a mistake on like a wide spread in options trading, you may not, the cost to fix that is actually going to be fairly substantial, and then you've got a little bit of a decision to make. But if it's a fat finger, go ahead and fix it. That is a very easy decision to make. When it gets a little bit more complex, and this is where we're getting to the psychology part, is where you discover you made a mistake and your P&L is either in the green or in the red. Now, let me tell you what I have seen hundreds of times in my life. I've had a great opportunity to overlook all the traders and see how people handle things, and it's amazing. This is what we do as human beings. If you make a mistake and it ends up in a green P&L, Patrick, how fast do you think that P&L was taken?
What do you mean, how fast was it taken?
Again, how fast did they exit that position when they found they made a mistake and it was a positive trade?
Oh, compared to if it was a negative trade, they probably sat on it. They took the gift and they're like, well, let's see where this goes, right? That's what a normal person would do, huh?
No, that's good. That is a good answer. It's just the opposite. What I've seen is when people make a mistake, it's been a day or so, they log into their account, they say, oh, I made a mistake, and they're up a couple $100. They get out of that trade immediately. And they think, oh my gosh, how great was that? I lucked out. Made a couple $100. They do that again, and now they're down a few $100. And they find and discover the mistake. They are much more likely to sit on this trade, which is the absolute worst decision you can make. So just think about this. Let's say that this is going to happen 20 times in your trading career. Half the time it's good, half the time it's bad. But if you're immediately selling the good ones and then holding the bad ones to see if they, quote, can recover, you will absolutely be a negative because of these trading mistakes. If you treat them both the same every single time, then it should be no effect. But what I've seen is when people discover they've made mistakes and they have a gain because of that mistake, they are so excited to get out of it. And then when they find out that their mistake created a loss, they want to hold on to it and see if they can get that money back. That's the psychological trap of these trading mistakes.
So let me see if I get this straight. You're saying we should handle them the same way. Here's how I would do it, and let me know if you agree with this methodology. So if I make a mistake and I come in and I am in the green, and pretty good in the green, what I'm going to want to do is, because I don't have any real rhyme or reason to why this current trade is on, so I don't have any structure behind it on top of that, so I'm just going to put my stop loss at break even and put a scale out take profit in a reasonable place and let that sucker run. Let's see what it can do, right? If it hits break even, well, I wasn't supposed to be in that trade anyway. So that's how I would handle that. On the other side, if I made a mistake and I was in the red, I'd be like, ooh, bad mistake, abort, and immediately close that trade down. But those are two different things. That's not the same thing. Is my ethos what you were describing, or were you describing something different?
Your answer was actually the correct question. One of my favorite sayings that I love to tell traders is the best way to know if you're in a good trade or not is if the trade is profitable. Now, we've all made a trade where we click the button And as soon as we clicked the button, we never saw green. We never saw a shred of profit ever. And those trades, they don't come back. They don't come back. They usually get stopped out on those. And the ones that go for you, those are the ones that are good. So what you did, Patrick, is exactly what you should do, is you looked at this and said, hey, the fact that it's in the green, I want to give this one more room to run. And this one that's in the red, I want to stop the bleeding immediately. That is the correct way to look at it. But what I'm telling you, I've seen so many traders do this. They do the opposite of that. They sell the winner immediately, and then they hold on to that loser to see what it can do. That's the real psychological trap here that I want to discuss.
Why do you think that is, though? Because it just doesn't make any sense to me. Usually, if the trade is going the wrong way, let's say I would have been right, but I picked the wrong direction. My ego is telling me, well, let's get out of there and maybe start over again, or maybe start, if that was a euro yen entry, maybe see what's going on over at euro pound, see if I can maybe get a similar entry, something like that. I would be like, I don't think the market's going to go this way much longer. So let's correct course here and get it going right again. I mean, that just seems logical. I don't think I've ever not thought that way. What do you think's going on with these people who are doing it the wrong way?
I remember reading a study someone did about found money. When people found money, they treated it much differently than the money they had in their pocket. And they were much more loose with it. And so this is kind of that found money thing where you made a mistake and you log into your account and you see you've got $80. The people are very quick to take that. But again, when they see that loss, they punish themselves like you made a mistake, you got to get it back, work on it, try something to get it back. It's just a very negative downward spiral. And one of the most common ones I've seen in options trading, and any of our options traders out there, I bet you have some horror stories about this. So with an option, when the option expires, if the option that expires is in the money, meaning it has value to it, your brokerage automatically exercises it over the weekend. Now, there's been times where I've been busy, and at 3:55 p.m. Eastern Time, I look at my option. Let's say I've got a $50 call, and let's say that the stock is trading at $49.60. And I say, oh, you know what? There's no way that's going to get exercised. Within the last 5 minutes, it has a big run, and I don't notice it until the market's already closed. I will have that stock put to me or called to me on Monday morning. I didn't want it, but I've got it. I have seen so many people get put stock to them on Monday, they don't get out of it, and it becomes the biggest loss they've ever taken. But what I've never seen is it gets put to them on Monday and it becomes the biggest gain they've ever seen. That's not what happens. You have to just look at this and say, I need to do it consistently. Whatever you do, you need to do it consistently on both ends. Patrick, I love your suggestion on winners. Hey, you know what? Winners, I'm going to put a stop in at break even and let's see if it can make us some extra money. On losers, I'm going to cut them right away. Those are great rules. And what you can then do is you can track these trades and see, did you have a positive expectancy over the few mistakes you made? And if that is so, you have the numbers to prove the way you're doing it is correct. If you don't have those or not willing to look and see if your rules are going to have a positive expectancy, which is going to be very tough because you're only going to make a few of these every year, my advice is do the same thing every single time. That way you at least basically get a zero. Now, some people are going to have good luck, some people are going to have bad luck, but out of the collective whole of traders, if everyone just automatically, like on Monday morning, automatically exit any stock that you were put over the weekend, you do it at 9:30 and 1 second, If everyone did that, the collective whole would be break even. But people don't do that.
Okay, well, good. Let's extrapolate that out a little more then. And we've gone over the reasons why people might make mistakes. Bottom line, the mistake has been made. Okay, it's been made. You've recognized it. Now let's lay out exactly what to do. So you have a blueprint already printed out here. Let's go ahead and go over it, starting with what to do if you make a mistake on the entry.
Let's talk about the things that are non-negotiable. So there are a lot of things you can do to make mistakes, and you can say, okay, well, I'm going to do this and this, but there's two things that are absolutely non-negotiable. Position sizing mistakes. You must correct a position sizing mistake immediately. Now look, if you made the trade too small, correct it. It's not going to be all that risky to you. If you made the trade too large, you need to correct that immediately. That is just, you cannot mess with that one. You have to be perfect on that. Position sizing must be perfect. Number 2, your stop must be active. It just has to be active. And if for some reason it's not active, you just have to make it active. So those are the two things that, to me, there's no wiggle room, there's no anything. Like if you screwed those up, pull the red lever and make sure you get that right. Other than that, if you made a trade and it was a mistake, you were long instead of short, or this or that, guess what? Now you've got your money there. If you can unwind it quickly with no penalty or just minimal penalty, take it off. But if you cannot, guess what? This is now a trade of yours. As long as you have your position sizing and your stops in the right place, this is now a trade. I have done this over my career to where I make a mistake. Oh, great. I'm short instead of long. I wanted to be long, but now I'm short. I make sure that I have all my stuff in place, and some of those have turned out to be fantastic trades. But again, position sizing must be perfect. Stops must be perfect. Does that make sense, Patrick?
No, it does. And I want to co-sign on that position sizing part you mentioned because, yeah, if let's say you're a half lot trader, for the most part on major pairs, and you accidentally wager 5 lots, abort. Forget everything I just said about if your trade is in the green. Just get out of there. You are in an incorrect trade that should not exist. Get out of that. But yeah, everything else you said makes perfect sense to me. So that's what you would discover on the entry or just after the entry. Now, what about the exit itself? There's a little different protocol here, is there not?
There is, but there really should be no problem with the exit because everyone should be automating their exit. So, like, even if let's say you screwed up, you put in a buy instead of a sell, your stop order isn't going to go in. It's not even going to go in correctly because that's such a screw up. If your exits are handled by stops or by some sort of automation, just let that happen. If you are doing discretionary stuff, if you're trying to do discretionary stuff, let me tell you, you need to automate.
And why would I need to automate? I've been doing discretionary for a long time. Why all of a sudden should I switch it here?
Discretionary exits?
Oh, you're talking about the exits. Okay.
Yeah, the exits, just automate that. Just make it to where it takes care of itself. For any of you that are following our Flat Earth Trading Society, I mean, this is just such a great exercise of not even thinking about selling. We never think about closing about position because we just have a 2x ATR trailing stop that we periodically tighten up. And every single trade has been just taken care of. It's just taken care of all the time because you've already done it the right way. Once it's automated and in there, you really can't screw it up. Now you can screw it up putting the order in, then of course you fix it. But once that order's in, once you put in your, and again, I'm going to use the Flat Earth Trading Society, 2x trailing ATR stop. Once you get that right, you can't screw it up after that. You literally can't screw it up.
Yeah, that's true. I think a lot more mistakes probably happen on the entry, but if for some reason they're happening on the exits, I mean, I've said it before in my exit indicator videos, exits are where all of the profit and losses happen. So if you're messing this part up more than, let's say, once a year due to some just technical issue, then yeah, it probably is your signal. The universe is telling you to automate this. Might not be something you want to do, might make you feel like you don't have as much control, but if you can find a way with your algorithm, and there are ways, you can go to my Discord forum and ask, they'll tell you how. This is something you probably need to go ahead and do.
Right, that is good advice. The biggest thing that I wanted everyone to take away from this episode is you are going to be tempted to hold on to the bad ones. When you make a trading mistake, you're going to be tempted to hold on to those bad ones. Don't do it. I have seen one trade wreck an entire year's worth of work. And it was a trade they didn't even want. I mean, that's the ridiculous thing. They didn't even want the trade, and they turned it into, their holy grail thing that they were going to hold till they died. Look, just do not hold the losers, please. That's all I've got, Patrick.
Yeah, I would just say if you find yourself making a mistake like this, regardless of how deep into your career you are, step one, don't panic, calm down. Step two, come to this episode, and we will tell you exactly what to do and lay it all out for you, just like we did. But thank you, everybody, for joining us once again on the Trading Psychology Podcast. Rob and I will both see you next time.
Goodbye, everybody.
This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, it is the undisputed Rob Reinhold.
Well, hello, everybody. Nice to be here and undisputed. Yes, no one with my exact name has ever beaten me up. You're right. So I am undefeated by other Rob Reinholds. Again, that's with two B's. I did meet a Robert Reinhold. We didn't fight. We got along great. But undisputed for sure.
So with this week's episode, we are continuing the VP Haters series, part 2 of 2. We won't be doing this any more than 2 times. But this is one of the people that I don't get too often, but when I do, they are very loud. They type a lot, and they are quite angry sometimes. But unlike last episode, where we're talking about the shortcut taker, somebody I don't have a whole lot of respect for. This person I somewhat empathize with, and that's going to be the academic. And if you don't know what I mean, you will soon. But kind of segueing into things here, Rob, you've talked about your sports exploits in the past. I'll assume you were mostly a jock growing up. But did you still have any type of nerd tendencies? I know some jocks who did. I know some jocks who didn't. Was that in you, and did it ever manifest when you were younger, or did it take a while?
I was absolutely a closet nerd growing up. I loved fantasy books. I loved sci-fi books. I loved playing Dungeons and Dragons. But back in the day, it wasn't that cool. Nowadays, I love how the world is. And for every single year, I took my kids to Comic-Con. I love Comic-Con. And one year, my son asked me, "Dad, why do you like Comic-Con so much?" And I said, when I was your age, I had to hide everything. I had to hide the books I was reading inside like a notebook, or I would tear the cover off so no one knew what I was reading, because I would get teased and teased. Now it's cool. Now you can do all these things, and it's celebrated, and you have a place where you can go and totally nerd out with other people. So absolutely huge closet nerd here.
And yeah, I was the same way. People don't understand back in the late 90s, I would say, there was very little crossover. You were either this or you were that. With me, it wasn't Dungeons and Dragons, but it was like things like Magic the Gathering. That was just starting to become a thing. And I saw people playing. I'm like, oh, what a cool looking strategy game. That would be really fun to play. But you couldn't just jump ship from your group over to that group. It wasn't a thing like it was today, unfortunately. But yeah, that was always in me. And then later I learned to love games like Elder Scrolls and things like that. And yeah, it's always been in me too. And remember, I've said this before on the show, Rob. I was the smart kid growing up. That was my identity. That was my only superlative. I wasn't the super athletic kid or the tall kid or the funny kid or the bad kid, whatever it was that people would center their identities around. I was the smart kid. So I always felt like the more I knew, the better off I was. And I carried this over to a lot of things. If I was really interested in it, I wanted to know as much as possible. And so I would do deep research and read books and do everything I could on a particular topic. Really, not because I was going to use that information for anything constructive, but I just wanted to sound like somebody who knew what they were talking about. And I wanted to get respect and adoration for that. But in the end, it didn't really amount to much. And so that's kind of where I want to segue here. Were you ever like that, Rob, in any way? Before we go on, I just want to get your take on this because I'm going to talk for a bit.
I have, and I want to publicly thank my mother for this because she really tried to instill into us a love of learning. And we would always be taken to the library. We went to an opera once and we all hated it and complained, so we finally left. But she tried to get us out there and experience things. And I just love learning things. And I remember in history class, I read ahead of the class because I wanted to know what happened in history. I wanted to know all the stuff that happened. So I would finish the book when they're still on, chapter 2 or 3 because I was just fascinated about learning.
Yeah, and I think fascination is better than, what I was doing, just trying to look and sound smart more than anything. But so I want to, before we get into the real meat and potatoes of the academic, I want to start with a sports betting analogy. People here know that I spent some time in the sports betting world, got to know those people. Almost all of those people are either troubled or just not very smart in general, or just have really bad, addictive personalities. It's not a great place to be. You don't want to hang out with that crowd for too long. But there are people that I had met along the way that know everything about not just the particular sport they bet on, but almost every sport out there. And I was this way too for a while, Rob. I love sports, especially football. And there was a time where I could probably name 90 to 95% of the starting lineups in the NFL for that year. I was that much into it. And these people are too. And they thought, or that they probably still think, that this level of knowledge helps them in the sports betting world, because why wouldn't it? The more you know about something, the better off you're probably going to be. Problem is, none of these guys won at any higher of a clip than just your average bettor did. They all lost, just like everybody else. So they spent all this time learning all these things and all these people and staying up to date on all these things, injuries, stuff like that, and it just didn't matter. And I thought that was strange. And I looked around and I found that the small handful of professional bettors, like actual pros, who did win, and they all had something in common. And I want your take on this, Rob, when I'm done. The people who actually won at sports betting, like all 5 of them, they all had something in common. They barely knew anything about sports, at least in terms of who was on what team and things like that. But they understood betting markets, and they just focused in on that. They would never stick around and watch the games. They would come in, do what they had to do, leave, and then you would see them the next day cashing their tickets. And I've come to find out that this was the case. This is still the case now. The people who are really good at this barely even focus on the particulars, which is weird because a lot of people who sell their betting picks, they know everything about everything because they want you, the customer, to think that they know this game inside and out. Therefore, they're going to win more than your average person, and almost none of them do. It's pretty fascinating. Can you figure out why this might be, Rob? Because this seems to be the case across the board.
Oh, I just got a grin on my face because you were hitting so many good points, and I've forgotten all the things I wanted to say. But absolutely, and what you said is the people that are good at winning the games of gambling. They're good at the gambling part. They're not good at the football part. So when you think about it, when you're trying to win, let's say you do a 3-game parlay, and it's NFL, and you're trying to decide, okay, what teams are going to win. You are looking at it at like the second level of the problem. You're looking at the second level of the problem, like, oh, I like the Steelers, but the Steelers have a running back that's out this week, so I'm going to go with the Dolphins. You're really not even looking at the actual bet. And other people, they're looking at the bet, and they don't care about the team. They don't care about the running back. They're looking at what is the best way for me to win this bet. And that's how they approach it. And when they approach it like that, they get rid of a lot of the junk. And you don't need to know all the stuff. And now you're just talking about statistics and probabilities. And I see this in trading all the time. All the time. And one of my favorite stories, and I've told this on your podcast a couple times, but I'm going to tell it again because I love this story so much. Me and Joe, who I've been trading with Joe for like 23 years now. And it was early on, and I was arguing with Joe, and I said, Joe, and I pounded my fist, and I said, I know I'm right. And he looked at me like I was crazy. And he says, I don't want to be right. I just want to make some money. And I just sat there and thought, he's right. I'm looking at the sports teams. I'm looking at the running backs. He's looking at the bet. And how can he win that bet? That's absolutely how you're going to win in the world of the stock market and Forex. You could know everything about the Bank of Japan. You could know the name of the central bankers. It doesn't matter. Do you know how to win the bet?
And that's the perfect segue into what we're talking about today. And this is going to come off as really good news to some people and very, very bad news to other people. But just like you said, Rob, more knowledge about something like sports betting or something like trading does not equal more money. We all think it does early on. I used to get the question a lot. Do you recommend any books on Forex trading? Because I want to go ahead and get started and read and learn as much as I can right now. And I almost didn't know how to answer it because I knew where these people were going. They were completionists. They thought that what we just talked about, if I know more about something, the better chance I have to do well in it, which for some things is the case. But for things where you're making bets or making a gamble of sorts, and I hate to call trading that, but there are parallels, it does not compute. You knowing, like you said, about all the chairs of the Fed or the ECB or the history behind the Japanese yen or all the tech behind Ethereum, it does absolutely nothing for your trading. And I'll even go so far as to argue that it probably takes away from it. Would you say that's true or false long term?
100%. 100% true. And this is where I had to go through this process because, I loved learning, so I learned everything I could. I would listen to the earnings reports. The earnings calls that the companies would have after, and you'd learn about the CEO. Hey, that CFO sounded like a better guy than the CEO. And then I would go out and let that determine some part of my trading aspect because their CFO, who I think was a cool guy, said this. It's not even about the game anymore. Again, you got to bet on the actual game itself. Let me keep going here because I want to go into a DraftKings thing that once they made sports betting legal, people came in and wrote algorithms, and you can't even win like fantasy football anymore because the people that are going in there, they're not even looking at players. A couple of years ago, I was reading an article about DraftKings. So in the United States, they made sports betting legal for the first time across the country. And so you could go onto DraftKings and bet on fantasy football, and you could put together a fantasy football team. Very quickly, once there was a financial reward, people went in there and started playing the game, not because they love football, but because they wanted the financial reward. They were looking at this as, how do I win the bet? How do I win this pool in the fantasy football league at DraftKings? Not, how do I put together the best team, not what running back is best. So they would look over here and be like, okay, we need to pick a tight end that's playing against the Packers this week. So they would go out and pick a tight end that's playing against the Packers that no one liked, that no one knew about, but they knew that the Packers can't guard the tight end. Anyway, they started looking at the data, and they started making teams based on algorithms and data. And now they pretty much rule DraftKings. That's how you play it. Because again, they're focused on winning the game, not in all the things around the game.
So you mean to tell me that simply by coming in and creating a dumb algorithm that doesn't even really think, it just takes the data in front of it and uses it to its advantage, that was way better than anybody doing anything else, literally?
Well, even more specifically, they built the algorithm, but the algorithm was built to win. And so when you read about what they're doing, they'll join like 20 leagues, fully knowing that they're going to win 3 out of the 20 leagues. So it's not even about like the data putting together. It's this master plan of, hey, we're going to put out $5,000 this week, and we have a high probability of getting back $7,000 this week. And then just one more story, and then we got to go on. I actually watched a guy on TikTok where he made a bet on the underdog in every single game in the NCAA March Madness tournament. So it's a basketball tournament every March. And he made the underdog bet. And by the end of the tournament, he had won a substantial amount of money. Now, of course, every year that's going to be different. Years where there's more upsets, you're going to have more of an upside. But do you see how he didn't even care about the basketball? He didn't even care about anything. He said, hey, let me see if I can get an edge over here. He found out he could get an edge. And then that's what he ran with. It's about winning. It's not about anything else.
So that's perfect. Now take this into the trading market. Just like I segued this, you're providing a, kind of a deeper level of information than I did. When we take this into trading, where does this same methodology come into play?
One of my favorite things to tell traders, and I love when every trader gets to this point. Every trader comes in through that front door. They read a bunch of books, gather a bunch of information. They go out and try it. And, they make a little bit of money first, and then they lose it, and then they got to figure out what to do. And at some point, it no longer is about the money. And now it's this intellectual pursuit of how do I win this game? We have a market that is random. I say it's a huge wild animal. We have no control over it. No one has any control over it. It's going to do weird things. It's going to do whatever it wants. How do we, this little tiny speck, how do we go in and win this game? And that's where everything you talk about, Patrick, building a system, back testing it, testing it out, going through it, and making sure it is rigorous, and then going to put it into play, make adjustments to it. As you can see, that's about winning the game. And this is where all the way back, and I can't remember what episode it was, but at one of the beginnings, you asked me the question, how long do I think people should demo trade? And my answer was never. 0. Because the only way to learn it is to get in the game. Get in the game, get some bumps and bruises, figure out how to not get bumps and bruises anymore, and go on. And that's the problem with the academic, is they don't want to get in the game and get bumps and bruises.
Yeah, and I don't remember what episode that was, but spoiler alert, I disagreed with Rob on the amount of time you should be demo trading if you didn't already know. But that's a different story for a different time, but you're exactly right though, Rob. The academic would rather just learn a bunch about it and read books and go to seminars and watch these high-profile financial people speak, because at the end of the day, like you said, you have to go in and do it. And something tells me that the academic doesn't do a lot of doing. They do a lot of learning and a lot of talking and a lot of pontificating, which is what I did back in the day, because I thought for some reason that would end up getting me somewhere. And I had to learn over time that it got me absolutely nowhere. I had to do 2 things. Three really. One, get rid of all that excess knowledge that wasn't only not getting me anywhere, but it was really getting in my way and promoting analysis paralysis in a lot of my trades. Two, I had to simplify everything and distill it down into simply trading the market. This took me way too long to figure out, and that is why I am sitting here on a dedicated episode saying this to everybody else, because I have a feeling that a lot of you are like me or like Rob. And then three, what the hell was three? I just had to simply apply it. You just have to get up and do the work and test over and over. But none of these things are going to happen unless you eliminate that useless information first. So yeah, to where this comes full circle when it comes to the people who comment on my channel. And it's funny, like they'll come in and I'll generally ignore them and then they'll just go away. But what they will say is, how can you tell people this, VP, and not tell them all of this? In order to really become a successful trader, you need to know about the mathematics behind this indicator. The indicator people are the worst. You need to understand the full works of Larry Williams. I went and saw Larry Williams talk in Sydney and in Hong Kong and in Boston. So therefore, what you need to do, VP, is you need to run your channel the way I would run your channel, which I think we're kind of cutting to the meat of the problem right there. I think because these problems have such a hard time executing, and I actually executed, that they wish it would have been them getting the attention and getting the respect for knowing something about something. But they don't, because one, they went the wrong direction. They went the deep academic knowledge direction and not the executing direction. And this isn't me beating my chest. This is saying, hey, if this might hit some of you in a certain spot, understand there's two directions you can go here. One of them gets you absolutely nowhere. We all thought it was going to get us somewhere, but it doesn't. It's actually eliminating most of that and simply going the more dumb route and just simply pulling the trigger. And these people, first of all, academics, like who hires academics? They're not very useful for anything. Two, it upsets them so much that I don't run my channel the way they would have run my channel, that they think I'm doing the world a disservice by not taking them down this path, which leads absolutely nowhere.
My first couple years of trading were in the late 90s. And the late 90s, 97, 98 was pretty good. And then 99, somewhere about midway through the middle of 99, things went bonkers. Things went absolutely bubblicious. I mean, crazy. Kind of like what we saw after COVID. Even worse, though. It was even worse. That's where you had, .com stocks going from $20 up to $400 in just a couple of months. And at the time, I was reading, I was learning all this stuff, and I looked at the lemmings, literally called them lemmings, looked at the idiots, called them idiots, that were bullish in 1999. And I thought to myself, I am not a lemming. I am not an idiot. I am smart. I am well read. I know things. I read a book about bubbles, and this is exactly what they look like. And with smugness, I sat there while everyone else made a ton of money. And I sat there not participating in it, but the whole time thinking, yeah, but I'm going to look back on this and say I wasn't a dummy, so I'm okay with it. And then the bubble did pop, and when the bubble popped, oh my gosh, that smugness was tenfold. I was so smug. And then I went short the market, and I made a lot of money, and oh my gosh, I was so smug about how much I knew. And then the market bottomed out in 2002, and for the next 3 to 4 years, I was a perma bear. I only liked the bearish side. I could only look at things as a pessimist. And the market ran and ran and ran. And Everyone else was making money, but I was fighting it. I was constantly either shorting it or staying out of it or saying I'm not chasing it, it's too crazy. That hurt me for those couple of years, and those years were pretty lean years as a trader. And it was all because of me setting myself up as, quote, not an idiot, quote, not a lemming, not going to jump off the cliff with everyone else. And it took me a lot of time to really look inside myself and be like, hey, what are you concerned about? Being right and being smug or making money? And I finally realized this was something I had to get over. And it was making me angry when I looked at all the other people that were just going long and making a bunch of money. And here's me being very disciplined. I looked down on them with disdain. And this brings up to mind one of my favorite Saturday Night Live videos. And this video is almost impossible to find online. Something must have happened where it got banned somewhere or something. But I found a link, Patrick. I will send it to you so you can link it to this video on YouTube. But it's a March Madness thing again, going back to March Madness. They had two people with the highest scores. And one was this sports writer who knew all this stuff, knew every single player, knew their ankle hurt, knew everything. And then on the other side was like a college freshman girl who made the bets based on the mascots and about her ex-boyfriends. And she was beating Peyton Manning. And he was so upset about it. And that just reminded me of, oh my gosh, that's how I was. I was looking at all these, quote, college freshmen who didn't know anything and were making all this money in the market. And I was so upset about it. And I realized that's only hurting me. And so I worked really hard on unbecoming a perma-bear. And I told myself, the next bubble that forms, I'm going to get filthy rich off it. And now I love bubbles. Oh my gosh, bubbles are the best. There's nothing better than being in a bubble. You just have to understand that at some point it's going to end. As long as you understand that, jump in the bubble. It's so much fun.
Yeah, the early part of what you were talking about pretty much describes me on my investing podcast. But caveat emptor, I will say that we do understand the market is going to turn upward. You certainly want to be part of a bull market because they are long and they run a lot. So yeah, we're relishing the day where we can switch our bearish focus. But I know what you're saying. Yeah, you think you're one thing and you think that one thing makes you really smart when at the end of the day, it's just doing you absolutely no service.
Not only a service, it is absolutely harming you to have that attitude.
Yeah, exactly. Because not only is it taking you away from wins, it's probably causing losses as well. It's hitting you from both ends. So before we get to the solution here, Rob, because you're the one who always kind of pays attention to what's going on in people's brains and why these things might happen. You're much better at this than I am. What do you think is causing these academics to not only be the way they are even later into life after they already kind of know it's not really working out, and why don't they want to make the change, and why are they still so steel heavy into this mentality?
I think it's because they don't really understand the game. They were told that if you know about charting, if you know about the Williams oscillator, if you know about all this stuff, you're going to win. And if you don't know it, you're going to lose. And it's just like telling someone, hey, if you want to win at fantasy football, you got to know about running backs, you got to know about wide receivers. Look, when I got into it, I didn't really look at it as an engineering problem. I looked at it as an intellectual problem. And so I think that's the problem, is that people are looking at all these ancillary things that they think are going to cause them to win and ignoring what actually causes you to win. Being on the side where there's more buyers than sellers during your trade. If you're long, that's how you win a long trade. Now look, you can look at things to try to tell you, hey, what is the buying and selling pressure on this currency or on the stock or whatever. But in the end, the only reason you make money if you go long is because during your trade, there was more buyers than sellers in a net amount. And if you go short, the only reason you made money was that there was more people selling than buying during your time frame. That's it. That's the real game you're trying to play. The problem is we're not looking at that game. We're looking at all the ancillary things because that's what we've been told, and they're easier to look at sometimes and learn. But when it comes right down to it, that's how you win this game. And if you focus on how do I win this game? How do I win the game where I'm in long trades when there's more buyers and sellers, and I'm in short trades when there's more sellers or buyers? Do you see how a lot of the things that you think about don't even matter? Like, does the Bank of Japan and who is the head of the Bank of Japan even matter when you're trying to win that game? It doesn't. Focus on what you're really trying to accomplish. And that's being on the right side of trades during supply and demand imbalances.
And that's a perfect segue into the first point of the overall solution. It's just understand trading is actually very simple. If you choose to complicate it in any way, it's not only not going to benefit you, it is probably going to work against you. But it's weird because we have been conditioned to not think this way. Like we said at the top of the show, we always felt like the more you know about something, the better you're going to be. If I go to these financial conventions, I can probably get a bunch of takeaways that I can apply in my trading. Truth is, Robin, we've both been to these conventions. Unless you're glad handing or trying to network, or you just want some time away from your boring life, or a spouse you hate, or whatever the case is, these financial conventions really don't serve any purpose at all, do they?
No, and you're exactly right. I go to them periodically. I haven't been to one since before COVID, but I always just saw it as a write-off vacation. That's why I went. Hey, let me go on vacation and write it off for business.
Yeah, so you have all these things going on around you that you think smart people go to because they're smart and they're good at what they do, and this is how they accumulate more knowledge. Completely the opposite of what you need to be focusing on. So I guess the point is, don't allow all these things to misdirect you, because that is what they're going to do at the end of the day. More knowledge does not equal better trading. Now, Rob, you have such a great sample size in front of you, and you've gotten to know a lot of your traders. Apart from me, who's a god-level super genius, do you have anybody in your pack of traders who is just one of these people that is super analytical and knows all this about the trading markets, or have you pretty much conditioned that out of just about everybody who works for you because you simply have no other choice but to do that?
We have really smart people at Maverick Trading, and I'm not going to downplay that. But let me just tell you that I've instructed our recruiters to pass on people who are, quote, know-it-alls, just to pass on them, and to take people that are going to be good at following rules. If I can train someone to put in rules and follow them to a T, they'll always beat the intellectual that knows every little single thing about options theory every time. Give me someone that knows how to be disciplined and can stay consistent and put in the work year over year after year. That's who we want. And I instruct my recruiters, pass on the know-it-alls. Let's get humble people that are hungry to work and can be disciplined.
Now, I do want to extend an olive branch here and say there's one distinction I do want to make. So don't be an academic in any way, shape, or form. But I feel like, Rob, it's okay to be an enthusiast. If, and a big if here, if you were able to separate the enthusiasm from the trading, you might like everything that's going on in the financial world. You know, this might be something that stimulates you. This might be something that, you really want to know more about. And not for pontification reasons, but just simply because it drives you and it fascinates you. And there's far be it from me to ever tell somebody that they should avoid something that they really, really enjoy. But you have to draw the line somewhere. And I don't want to pick on him, but we have a really good, consistent YouTube commenter who writes a lot. And it's full of substance. It's not full of fluff. He writes a lot of really, really good, intelligent, well thought out things. I do find myself every once in a while come in and say, hey, just so you know, Don't get too deep in the weeds here. It is not benefiting you the way you probably think. I was just like you, and that's why I empathize with these people, Rob, because I was there myself, and I had to learn the hard way because I had absolutely nobody telling me otherwise, that you really do have to either draw a line or just get rid of all that fluff in the first place.
Patrick, I know that you are well acquainted with our saying at Maverick, but you love to use it. It's cocktail talk. Like, I love to learn about stuff. I do know all the central bank governors. I do know all the things about their children's stuff. I love it. And we'll talk about that a lot at Maverick. We'll talk about that in videos. We'll talk about that in live sessions. We'll talk about it, just face to face. But we have a saying that's cocktail talk, meaning that's best done when you have a drink in your hand, drinking with your buddies, and you're talking about this kind of stuff. It's cocktail talk. It's fun. It's great. But there's nothing in cocktail talk that should make you change or determine a trading decision. That should always be based on your system that you've backtested, period. Cocktail talk is fun. I love it. Patrick, look, how many, we shoot these, it ends up being 2 hours because we have cocktail talk about the markets for about an hour of it. Because we love to do it. It's fun. Allow yourself to do it. Just don't allow it to get into your trading.
And I will say, my experience might differ from yours, but at the end of the day, the handful of traders I've gotten to know fairly well who do pretty well at this market, they are not gigabrained people. They're actually kind of derpy at the end of the day. But, it's almost like that midwit bell curve that you see. You see the really dumb, guy eating paste on the left side, and then you see, the 200 IQ guy on the right side, and they're both thinking the same thing. And that one thing is very, very raw and very simple, to where the midwit, the guy at the top of the bell curve, is just overthinking everything. If you need a visual to go along with this episode, let it be that. Rob, do you have anything to say before we sign off here?
No, I just want to circle back to cocktail talk. Again, we've been using this term for so many years at Maverick. It's fun. Go out and learn all you want. Just understand it's for cocktails. It's not for trading. Trading is about engineering and making a system that works. Cocktail talk is shooting the shit with your friends and having some fun and, talking about stuff that's interesting to you, like the Bank of Japan. Like, I love when I can talk to someone about the Bank of Japan. Does that influence my yen trades? Absolutely not. Keep them separate.
Yeah, and so next time I see you, Rob, we will have some cocktail talk, and we'll raise a glass to Shinzo Abe for making yen pairs great again for a very, very long time, up until his unfortunate death. And on that note, traders, thank you for joining us here on the Trading Psychology Podcast. Rob and I will both see you next week.
Goodbye, everybody.
This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, it is that shining beacon on a hill. It is Rob Reinhold.
Well, thank you very much, Patrick. It is good to be here, and I hope everyone knows how much I truly enjoy this. I have spent so much of my life learning about this stuff, and not really for anyone else, but for me. And then I realized how much other people love this stuff and needed to learn it. And so I'm very happy to have spent the time, spent the effort to be able to share that with everybody.
And so on that note, I'd like to welcome everybody to this episode about not particularly loving what you do. Sometimes we get bored with it. Now, we've touched on this in one respect in the past, but a couple things to that. One, not everybody listens to every episode here. We understand that. And two, we're going to expand. We're going to go a lot of different directions here. And so, Rob, you have the first note here. I don't have any notes on this particular subject myself, but why don't you go ahead and get us started off, and then we'll just kind of slowly transition into things.
Well, thank you, Patrick. This comes directly from my personal life, my first couple years. When I first started trading, and we're talking about, this was back in 1996, 97. It was like the Stone Ages. Not just the Stone Ages of trading, but the Stone Ages of the internet. And I remember Charles Schwab was the very first company that offered online trading. They were the very first ones. And if you drove all the way downtown to Charles Schwab's office, in the lobby they had a computer where you could log into your account and make trades there. You couldn't do it at your house. You couldn't do it off of your phone. Like the cell phones we had back then were the brick phones. They didn't do anything other than take calls. That's how I started, and that's where I started. I found out about Maverick Trading, and I walked into Maverick Trading, which was a trading firm, but it was downtown, and I didn't live downtown. So for me, every single morning, it was about a 25 to 30 minute drive. Again, you could not trade from your house. There was literally no internet in anyone's house anywhere. It didn't exist yet. So for me, I had to wake up early in the morning, drive downtown. The market opened up at 7:30 where I live, so I'd want to get there about 30 minutes at least before the bell. So, I was waking up at 5:45, 6 o'clock, and I would drive all the way down there. And then I would start trading. I cut my teeth day trading equities, and by a lot of the times, I had made my goal by 7:45 a.m. So just think about this. I woke up, got ready, got in the shower, got in my car, drove downtown. I'd already hit my limit, my profit. At 7:45 a.m., I'm done for the day. Do you think I got in my car and drove back home? No. What do you think I did, Patrick?
You've already made your money, and you made it so early. Let's make more.
There we go. Let's make more. And what do you think inevitably happened for a lot of days?
You ended up losing what you made.
Yeah, I gave back a lot of it. And when I recognized this pattern, when I finally oh wait, this is the pattern that I'm in, I realized, well, I can't sit here and trade all day. But I just made this trek downtown. I couldn't just get back in my car and then go back home. I could, but I'd already put so much effort into getting down there. But I knew that if I stayed in that chair, I knew that I would keep trading. So I just made sure that I wasn't in that chair for a lot of the day. Now, thankfully, back then, if I was out of my desk chair, I literally couldn't get a quote. I couldn't make a trade. I couldn't do anything. Remember, you didn't have a cell phone back then. So I scheduled time at the gym. I've talked about all these things that I did, set up lunch appointments with people to where I kept my day busy. But I made so many trades as a young trader out of boredom. Now let's fast forward a couple years, somewhere around 2000, 1999, 2000, you could start to get internet at your house. So some days I didn't feel like making the drive all the way downtown, so I just stayed at home. And those days I wouldn't really get in the shower. Why get in the shower? I just go downstairs to my office, and I would be in, my sweatpants and, take my food down there, and I would be down there pretty much all day long. And on the days where I was disciplined and patient, I didn't make any trades. And then when I finally came up at the end of the day, my wife asked me how to go. I said, I didn't make any trades at all today. Now, just think about this. You've got a mom upstairs dealing with two little babies, running her ragged. I'm downstairs in sweatpants, hanging out with some bag of chips and whatever. And again, I'm working, but I'm not clicking any buttons. How do you think that went in this relationship, Patrick?
Well, if you were doing nothing but printing money while you were down there, I think she would understand. But as we all know, that's not really what trading is. So I'd imagine it didn't go over well.
Well, look, and my wife is so awesome. She never gave me any grief, but it was internal pressure on me. Like, I had to justify the time I was spending down there. And by not clicking a button, I easily could have been upstairs helping with the kids. So for me to stay down there, I had to click a button. And I did it out of boredom. I did it out of boredom because, hey, you know what? I need to be doing something. One of the things, and I've told this story, and I think I need to tell it every single time I get a chance. When I have traders at Maverick who let me know that, hey, Rob, I'm quitting my full-time job to focus on trading full-time because I've done so well. I always call them up and we always have a very frank conversation. And I tell them that's a mistake to quit your job. Now look, if you hate your job, that's not a mistake. It's not a mistake at all. But I explain that you're used to working 40 hours a week. And your work is, you do this, you have this, whole list of things you do every single day. You don't do that in trading. When you quit an intense job and trade, it is going to be so boring. So absolutely boring. You need to have other things. And we're going to talk about the solutions here in a little bit. But I always have that conversation with traders, and they always think it's going to be easier when I don't have my full-time job or my part-time job taking up all my time and I can dedicate all my time to trading. They think that's a good thing. And I got to slap them upside the face and say, listen, that's a bad thing unless you are ready to manage it. Because boredom is going to get you. You'll overtrade, you'll make all the mistakes we talk about in the podcast, and it's just because you're sitting there all day.
Yeah, I can co-sign on all of that. I just don't have, I guess, too much to add to that. Because we touched on that a little bit before, but I appreciate the expansion on that, Rob. I want to transition, though, into something that even if you're an intraday trader or a daily chart trader, like we are at No Nonsense Forex, this is something that's going to hit you too. And this is also something I have talked about and I've done an entire video on, Rob, but I want your opinion on this too. So talking about short-term boredom, and this is mostly for daily chart traders, but as we all know, there are times in the market, often, where there's not a lot going on. Now, you still have to be there just in case something does happen, but you can go, weeks, even over a month in some extreme cases without a real trade entry. Your volume indicator might just keep telling you no matter what's going on. And that's going to wear on you because depending on when you started or if you just came off a nice run where there was a lot of action, that's what you're used to. And now there's nothing. And now you're not generating any income. And all those numbers you thought you were going to hit at the end of the year, you're getting slowly further and further away from those goals. That's tough. That is going to eat at you. Now, Rob, I did a whole video saying during dead markets, here are some things you can do. One of those things was, and I couldn't believe I said it at the time, is drop down to a lower time frame because there probably are entries there. You have a system in place which works on every time frame. If you want to use it now, go ahead. Now, apart from that, we have solutions for all of these things. I just gave one, but without giving away any solutions just yet, do you have anything to add to this problem of short-term boredom when the market is slow?
I definitely have ideas. I didn't say good ideas, but I definitely have ideas. I do want to just comment real quickly on system jumping. System jumping is where you have a system, you're okay, I've done it, I've tested it, everything's great, and you run it, and it runs fine for a while, and then for a long period of time, it underperforms or doesn't perform. And you look at this and you say, oh, the system's broken. The system's broken, I need to change the system. And what you need to understand is the system's not broken. You are just in a period where the underlying market conditions are not conducive to your system. Here's the way the markets work, and the markets are phenomenal at this. Once everyone thinks a strategy is dead, it starts working again. Once everyone thinks a strategy is going to work forever, it blows everyone up. It is amazing how good the market is at this. One of the things that just pops in my mind is people, like right now, zero DTE options are all the rage. Just sell 0 days to expiration. So you wake up in the morning, you sell an option that's far away from the market, and you just collect your 40 cents a share, and you're just printing money day after day after day. That is very popular right now. And do you know what that tells me? That this strategy is likely coming to an end. And what's happening is you're seeing this in the VIX. Implied volatility and historical volatility are dropping and dropping and dropping. And where you used to be able to get 40 cents, you can now get 20 cents. And then that's going to drop to 10 cents. So do you know what people do? They say, well, I want that 40 cents, so I'm going to do a closer to the money one to get me that 40 cents. And then what happens is the market has a 2% drop and everyone gets completely wiped out. I really don't like system jumping. I really don't like it because I think that when most people finally get to the point where they want to jump systems, it's probably that moment because you can't take anymore. It's just like when you have a losing trade. And so let's say you didn't have a stop on it. When you finally just can't take it anymore, those are the bottoms. So I just wanted to jump in on system jumping and, maybe we should do a whole episode on that one. What do you think, Patrick?
I agree, we should. That's why I don't want to add too much to this. But I will say it's really weird, especially when people start out and they put these systems together. They're always like confused when systems don't work all the time. Like they thought it was going to work all the time regardless of the market conditions, and that's just not how it works. And I think they're so disappointed by this that a lot of people quit. A lot of people thought, oh, this is great. I found something that can just work all the time. Yeah, when you have something that works, I'm doing air quotes, all the time, this is over, like the course of a year or 2 or 3. Now, that's systems. There's no system out there that just simply works every single time in every market condition. And these dead markets can last a while. And that really, really messes with people. So the only other thing I wanted to mention on the short term boredom was sometimes markets can absolutely run and rage. And I want to get your thoughts on this too, Rob. To where it's the opposite of dead, but they run so much that you're not able to enter it. If you're a reversal trader or a trend trader, when markets are running and they're running for a long time, sometimes there's just no entries, but all the while, Rob, I'm staring at this market that's going bananas, and I'm not taking part in it the way I want to. And that is messing with me because I see people killing it. I've already closed out, most of my trades. I might have a few that are still running, and that's nice, but, I want to take advantage of this more. And I don't know if that's really falls under boredom, but I thought I would mention this. Have you encountered this yourself or with your traders? And let's not talk about the solutions just yet, but have you had to talk them through this a little bit?
Absolutely. I mean, this is a very, very common problem. It's a little bit of FOMO. You see everyone else making money. But, when you're super disciplined and you're waiting for that pullback, sometimes you don't get it. And to be on the sidelines when you, quote, knew it was going to run like this can be very, very frustrating. And, that this is part of boredom of, hey, you see everyone else at a party. You're looking in the window and it looks like they're having a great time, but you didn't get invited to that party. That can definitely be a recipe for disaster to say, well, I'm bored, I'm going to go join the party. Again, probably by the time you finally decide to join that party, the market is at its peak. Those are what peaks of the market are. It's when you feel like doing something that's different than what you should do. One of our traders at Maverick, great guy, Corey, he always has this saying, whatever you want to do on a trade, the right decision is probably the opposite. If you want to sell it, you probably want to hold on to it. If you want to hold on to it, you should probably sell it. Now look, obviously you follow rules as a trader and none of this matters, but he's basically pointing out that the market is going to get you to push you at those moments, and it's really good. And so if you feel like, oh my gosh, I'm in a runner, I need to get out, you probably want to stay in. If you're in a market and you're saying, oh, this market's gone up too much, you may want to reconsider. But like I said, you trade the charts. We're dealing with psychology here. You just have to understand that sometimes you're going to be a spectator on the runs. And so one of the big things is take a big step back. And I love to talk to our traders about this. Take a big step back. You look at any year, and I guarantee you that there's going to be 1 to 2 months that are strong downtrends. Somewhere in that month or for the whole month, strong downtrends. You're going to have about 4 months that are slight uptrends you're going to have 2 to 3 months with big runs, and the rest is going to be sideways. So let's say like that is what we all understand. That, and of course, every year is a little different, but for the most part, that's what you're going to get. If you go into the year understanding that, now I go into every year with the expectation that I'm going to have 1 to 2 negative months in my profits. Now, Patrick, did you ever think that as a young trader, that you were going to have negative months in that year?
When I was really young, no, because I thought I had found the Holy Grail, and like we just spoke about before, the Holy Grail just works all the time, no matter what's going on. So, yeah, I made that mistake too. And I'm telling you, I really want to know how many people enter this market and get all excited and then watch a channel and put a system together. And as soon as they realize it doesn't work all the time, they're like, well, screw this, because they're just not mentally and emotionally prepared to handle it, for one. Or two, they just set their expectations way too high and they're just out of touch with reality. When the right move the whole time was just to stay with it and improve. I don't want to get too far ahead of ourselves here, but that's obvious, right? But yeah, I absolutely felt that. And the reason why we say the things we say on here, Rob, and we keep repeating them, is because especially beginning traders, I don't know when you started listening to this podcast, but these are things you really need to hear, because I can't imagine how many potentially great traders were just completely waylaid when they came to that realization that things don't work all the time.
You said it perfect. The expectations. If you go into every single year with the expectations that you are highly likely to have 1 to 2 negative months, when you get to April and all of a sudden April's not working out and you got a down whatever percent you're down month. If you prepared for that mentally, you're like, oh, that's one of the months this year. That's one of the months. I might have another one. And in a really bad year, you might have 3. But okay, that's what happened. If you don't have that expectation, at the end of that month, you're going to be trying to grind out something. You're going to be doing all the mistakes in the world. So look, 2 months of the year, just expect them to be negative returns. 4 months of the year, I have a term for this, and I would love for you to take this term. I call it the slog. Now, I don't even know if that's an actual, I guess it is an actual term, but a slog is like you're walking through mud and you can't go that fast and everything's grabbing at your boots in the mud and you just can't get anywhere. I call it the slog. And when that comes, I tell myself, oh, here's the slog. We're in the slog. Right now, we're in the slog. I fully understand where we are. I fully understand that my job during the slog is to try to break even. If I can break even during the slog, then that's going to do really nicely. Or, we've talked about this before, some traders will have a measure of what the slog is and they will cut their position sizes in half. So during the slog, they're only trading half position sizes and theoretically losing a little bit less than they would have with full position size. I know, Patrick, your methodology, and I agree 100%, just be consistent. Be consistent. But as you get a little bit more advanced, we talk about dynamic position sizing. That's something you could take a look at. There's going to be slog for a lot of the year. But there's going to be 3 good months, 3 or 4 good months where you're like, oh, okay, I hit my target. And then there's going to be 2 months where you are the rock star, where you are God. And those months can mess you up too, because then you get the overconfidence, all the things we've talked about. As a young trader, you just have no ability to understand that that's what the year is going to be like, because every day the market's moving. Every day there's opportunity. So why can't I get it? Why can't this day I get it and this day I can't get it? Look, you've got your system. In any given period, it's going to work better than others. In some periods, it's going to be a loss. In some periods, it's going to be the slog. When you're in the slog, that's the most important time to stay disciplined. Because what most people do is they give up all their gains in the slog. And when the market finally moves out of the slog, they're either gun shy or they're capital poor, to where now their position sizes are so small they can't make back their losses. So look, have the expectations that 2 months out of the year, you're going to take a loss. Look, you may not. I've had years where I didn't, but who knows? But have that expectation. Have the next expectation, there's going to be 4 months out of the year where the best you can do is break even. That's the best. And then you're going to live for the other half of the year where everything works. And then 1 or 2 months out of the year, everything is going to work so good that you get delusions of grandeur. Go into every single year with those expectations, and then you don't have to deal with the boredom in the slog. You don't have to fight it. Just accept it. So what you said, Patrick, was so good and so wise. Your expectations are going to be everything in this game.
Yeah, and if there's one real drawback to trading the way we do on my channel with the daily chart, is that it's probably going to be a slog more often than it's going to be exciting. And so you're going to have to really be prepared for that, because when you were back testing and running those tests, your system and you both did not understand, what this life is really like. This is an actual job. So it's a really good transition into the next portion here. And this is more of a long-term type of boredom. Now, this is where I'm currently at now, and I'm dealing with it just fine. But there will come a point to where you've just done this so long that it becomes a chore more than it does something that's actually exciting. Like we just talked about a couple minutes ago, this might already be happening on a day-to-day basis. But imagine when you've already gotten your system down and it works and there's really no reason to do much else except for show up every day and decide what you're going to do. That's a place that, I don't know if this is I think it's a good place emotionally for me to be, but it's very unexciting. And that's just a shame, because Forex was the most exciting thing in the world for me for so long. And it's just not anymore. Yet, I still, because I'm disciplined and because I understand that as long as I'm plus money doing this, there's no reason to stop. I still show up every day. But it is something that wears on me. And at some point in your career, traders, if you stick with this, it's going to happen to you. So I want to address that here. And then I want to go ahead and bring both of these points up, because I wish I did that before. But what I think happens sometimes too is, especially after you've done this a couple years and you look back and you see how much you've made or how much you haven't made, and then over time you find something that is more lucrative, like, I don't know, crypto, or starting some type of business or something, to where your time is being, in your mind at least, is being rewarded more than trading is. This can be a problem too, because this is a very, very fast way to fall out of love with something that can continuously pay you year after year after year. And that's a problem, but it's a real thing, Rob.
Look, when you were talking, I was just, my thoughts in my mind. And I thought you were going to go where I was going to go, but right at the end, it divided off a little bit. I was going to say, look, if trading gets really boring for you and you have a better opportunity doing something else, quit trading. Who cares? Who gives a shit? And then guess what? Come back. Come back when you think it's exciting again. Like, I know that's not a great message for our podcast.
Terrible.
But honestly, it's not a big deal. Like, hey, if you've got something else that brings you passion, and in it you've got all this energy for that, and Forex, look, the way you guys trade, everyone can stick with it. Everyone can stick with it. But if you're trading a method that is a little bit different, that does take a lot of time and effort, you might find you have more passion elsewhere. Don't handicap yourself. Just go do what you love and come back if you find it interesting again. I just don't see a big deal about this.
Yeah, you saved yourself at the end there, Rob, as we transition into the solutions portion of this episode, that the way we trade, at least on the daily chart, it allows you plenty of time to do whatever you are passionate about, whether it's family, job, new opportunities, whatever. So you really shouldn't stop. And that's my first solution on our list here, is you're going to want to walk away and just take some time off. I don't think that's the move. And I say this for a couple reasons, Rob. I say it because trading is a job, and you have to show up to a job no matter what, even if you're bored with it. Or else, you know what? You don't deserve that job. Plain and simple. This whole thing is a muscle in a lot of ways that has to continuously be stimulated, or else you're going to fall apart. You know, if you just trade when you feel like it and then walk away when you don't and then come back when you feel like it again, that's not sustainable. This is how you miss out on really big runs. You know, you get really big runs reward the patient and the disciplined and the trader who shows up all the time. I just don't think this part's negotiable at all.
All right. You got me on board here, because now I'm thinking about all of the time and effort that it takes to get good at this versus the actual work it takes down the road. You're right. There's no other job. This would be like you working as an insurance agent for years and years and years to try to build your book, and then at 10 years you walk away from your residual income that you've built because you're bored. Like, no, just keep your sign on the window. Don't get any new business, but keep getting your renewals. Like, okay, I'm 100% with you. You've put in way too much time and effort, and the effort it takes in the end, there's no other profession that has this kind of payoff. So I'm with you now. You cannot walk away. Just have a system that fits within your life.
Right. This might not be the most popular solution for a lot of people. Like, oh, I just got to sit there and deal with it and just be bored all the time. Well, no, that's where the rest of these solutions come in. Now, unfortunately, we don't have, even in the United States, we don't have this charmed life to where we can just do exciting shit all the time and just keep that part of our brain stimulated. There's going to be mundane things mixed in between. And if trading ever gets there, and as we said, it's going to get there short-term and long-term, whether you like it or not, there are ways to where you can fold in more exciting things. And one of those is something I tell people all the time. People are like, I'm just going to trade Forex because I just want to get really good at Forex before I do anything else. I'm like, guy, these markets move very similar. You should be trading other markets too for a host of reasons. One, if you're good at one, you're probably going to be good at another one. Two, over time, you're going to learn which markets you're the best at, and maybe you should have more heavily focus on those. Three, I think you have said this, Rob. This might actually be a Rob Reinhold quote. There is always a bull market somewhere. And that's very true. Money has to go somewhere. If it's moving out of stocks and gold and things like this, it's probably going into cash, and then that's when that market gets going, and then vice versa. So a really great way to avoid boredom is to trade multiple markets, because chances are you're not going to be bored with every single one of them.
Yeah, if you want to focus your free time and effort in the world of trading, this is an essential thing that you have to do. You have to trade multiple markets, and you have to trade multiple investments. Like, I know, Patrick, you run an investment podcast. Like, you should be investing. You should be doing long-term trading. You should be doing, some option stuff in sideways stagnant markets. You should be doing everything. So if you want to spend more time in the trading world, then trading multiple markets, to me, is just, that's how you do it. Now, if you don't want to spend more time in trading, then I'm going to go back to some of our previous episodes that, I think episode 10 was multiple streams of income. Trading should be part of what you do. It should not be the sole thing you do. So you've got lots of opportunity outside of this business.
Yeah, I mean, I think we can both co-sign on that. Rob and I both have a lot of different things going on. I'm about to have, I don't know how soon it's going to be, a really big video on all the opportunities, and there are well over a dozen, that you can use if you are a good trader. Different avenues, lucrative avenues that you can utilize if you are. And that's something I recommend everybody. Get good to a point and make money trading, but also make money doing other things, whether it's inside the arena of trading or outside of the arena of trading. And then once you're doing that and you're stimulated that way, well, then taking 10, 15 minutes to go to the side and check your charts and do what you need to do doesn't seem so bad. It's almost like a welcome respite from everything you're doing on a day-to-day basis. Yeah, if I was just trading, which, honestly, I think for a lot of people when they first start out was the goal. They're like, I just want to trade full time. But if I was trading this way and doing nothing else, it would be brutal. I would have 15, 20 minutes of activity a day in a market that might not be moving, and that was it. I couldn't imagine that. So yes, keep yourself occupied, and if you can occupy yourself with things that actually make you money or could potentially make you money, then you're doing it right.
I think that is just great advice, and I just want to talk to our two groups of people out here. The key to extroverts is to stay busy. Just stay busy. Whether it's in the world of trading, whether it's in the world of real estate, or whatever it is, stay busy. Stay busy. I came up with a saying, and I love this saying. The saying, a tired dog is a good dog. A tired extrovert is a good extrovert. Extroverts that don't get their energy out, they blow up down the road. They act out. They do things that are wild because that's what we crave. So look, if you're an extrovert like me, keeping busy is going to be the most important thing in your life. And look, I just turned 50 and I'm exhausted living this kind of life. I'm totally exhausted. But the second I slow down, I'm unhappy. So it looks like I will just go at this pace for the rest of my life, die of a heart attack with a smile on my face. So extroverts, keep busy. Introverts, you, on the other hand, probably are more, intellectual. You need to just keep stimulating your curiosity. Like I don't see you need to be active and busy like us extroverts with all this energy bouncing out. But I think your pursuit of just the intellectual curiosities of trading and life itself is going to be the thing that keeps you out of boredom. So again, never stop learning.
And caveat emptor on that too. We just put out an episode a couple weeks ago talking about how less is more, and too much data and going too deep into something like trading is only going to hamper you over time. Trading at the end of the day is quite simple. So that being said, how do I keep myself stimulated as an introvert, as I am? Well, one of the ways is if you're a no-nonsense Forex trader, there are over 10,000 indicators out there for you to test and play with and improve your system. That is a perfect way. I did this for a very long time. I still do it, not as much as I did before, but this does keep me stimulated because this whole thing is like one big puzzle, a puzzle you're never going to fully solve, but a puzzle that does make the end result better, and that is incredibly stimulating to me. And now with all the automated tools that you have to backtest and things like that, it should be even less tedious than it was for me back when I was doing everything by hand, and admittedly still do sometimes. So yeah, I co-sign on those things too. And Rob, you had a couple other things that don't really fall into any of the categories we spoke of so far. And I think if I'm looking at the notes right, you have mentioned this a little bit before in the past, but go ahead and bring it up again.
I started trading in 1997, and after about a year and a half, and I had good enough results to be like, oh, hey, this is a thing. I grabbed my brother, I grabbed my friends, and I'm like, hey, you're going to come do this. And they're like, no, I'm not. I'm like, yeah, you are. And I formed this little trading group, and it surprised me. It gave me 20 times more joy to see them make a profit than to watch my account grow. And it was right at that moment. I actually came home and I told my wife, before anything was even created, I said, I know what my purpose in this life is. My purpose is to help other people make money. And as closely as I've aligned myself to that path, I've been very happy doing it. Now look, you may have a different goal than me, you may not have the same personality as me, but for me, it has been the most rewarding thing I've done in my life, and I hope to continue to do it. If you have put in the time and effort, grab the people you know. And look, they might not ever trade, quote, full time. They might not ever, but you know what? If they show any interest in it, you're going to help them out. And I tell people all the time, look, I've taught people that ended up not being real great traders, but they got a great job at a help desk at, E-Trade or Fidelity because they knew the lingo. And they were very, very fulfilled at that job. Like, passing it on and helping others, if that is part of your soul, who you are, absolutely take it. And it gives you this purpose that is greater than, did I make my goal this month? Who cares? Did I help other people make their goal this month? Holy shit. That's how you smile on your face.
Yeah, I couldn't agree more. If anything, Rob, you and I are walking embodiments of this. We both decided to help others, and not only was it good for our wallets, but I think more importantly for me, it was good for two things. And I think we've talked about this on the show too. One was validation. I was screaming into the sky about this system I had that worked better than what was already out there, and nobody would listen until I actually put it out there, and then the right people came. And then on top of that, I think I've said this before too, like, I don't want to die tomorrow, but if I did die tomorrow, I would die happy because I have, like, one, had that validation, which is more important to me than anything, and two, I have helped a lot of people, and almost nobody can say that. Not that I'm competing with anybody else in that regard, but that it's just so satisfying to know that you've done something like that. You can't put a price on it, even if I made no money from it. Just the fact that I have that under my belt is, I don't want to sound like I'm bragging or anything like that, but you cannot put a price on that. And simply doing something like that is remarkably stimulating because it's remarkably rewarding at the same time. So there are so many different ways to fill the void here, because there's going to be voids. We know that, short term and very long term. But the important part is that you find a way to fill those voids with something productive, and you can often do that with what you've already learned in trading. So that being said, Rob, that was kind of my way to wrap it up. Do you have a way to wrap this up too?
Well, look, I will just, as a testament to you, we have many no-nonsense forex traders at our desks at Maverick Trading, and I see what you've done, and I talk to our traders, and our traders could not be more happy because they searched in the wilderness for years, and once they came across you, it all started working for them. So we are direct beneficiaries of the work you put in, and yeah, it is. There's nothing better. Like I said, you'll jump up and down. Look, I'm trading with my son now. He's 22. When we make money together, it's so much better, and it's such a small amount compared to what I'm making, but it's so much more rewarding because you're passing something on to him, and that's just a great thing to live for, something bigger than yourself. So that's really all I've got.
And let me just wrap this up by saying something I probably should have said at the beginning of the show. Every episode is sponsored by Maverick Trading. No-nonsense Forex traders tend to do really well in an environment like that. It seems to be a very hand-in-glove fit. And Maverick Trading was not affected by the recent MetaQuotes bugaboo that's going on right now. So you have that protection as well. I know that affected a lot of people. So check the links down below for that.
And Patrick, we don't really talk about this, but we should. We do have two divisions. So Maverick Trading is our stock and options division. Your traders are mostly trading in our Maverick Currencies division. So if you look up Maverick Trading and you fill out an application, you're going to get questions about stocks and options. And you're going to be like, wait, I'm a little confused. MaverickCurrencies.com is where you want to go fill out an application to be a currencies trader.
I appreciate that. Yeah, it's been so long since I've done that, I've forgotten all about that little part. But yeah, there are two divisions, and the currencies division also includes crypto, for what it's worth. But thank you, everybody, for joining us here on the Trading Psychology Podcast. Rob and I will both see you next time.
Goodbye, everybody.
This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, he is the judge, the jury, the executioner. He is all three things. He's Rob Reinhold.
Wow, that is a lot. And it made me feel more powerful when you said that. But hopefully it doesn't go to my head, and I think this is a dictatorship. Good to be here. Let's talk about position sizing today.
Yeah. So this was really interesting when you brought it up. I'm like, is this even a problem? Because in order to talk about something, it has to be a problem first, or else, why fix it? But you, with an actual sample size, because you have so many people working under you, and I don't, you were like, yeah, no, this is absolutely a problem, even with professional prop traders. Now, our audience ranges from people who haven't even traded yet all the way up to people who've put 20, 25 years in the game. So it's interesting to see that you were saying, and correct me if I'm wrong, that even people at the prop firm level and people who have been in the prop firm ecosystem for years still risk too much in terms of position size. Am I correct to say that?
Yes, you are correct to say that. And I really wanted this episode to be basically the red flags, the things you're going to tell yourself to deviate. And look, if you still want to deviate position size and you still want to wing it, you're still in the phase where you haven't truly become a professional, hardened trader yet. You just haven't. You haven't gotten there. Position size is non-negotiable. It's just period non-negotiable. It is, you just have to do it every single time. If you still are playing around with it and deviating, then you have not made it yet to the point where you can say, hey, you know what? I am on the level of a professional trader. Now look, just because you get there, things pop up and things change. And this is what this episode is going to be about. It's going to be about, okay, you understand the importance of it. You're there. What are the little things that are going to pop into your brain that's going to be like, the devil on your shoulder tapping you? Be like, hey, what about this time? This time you can bend the rules because of this. That's what I want this episode to be all about.
Okay, and for those of you who don't know what we were referring to before, if you're new to the show, this episode and every episode is sponsored by Rob's prop firm, and the prop firm I belong to as well, Maverick Trading. Yes, is on the pricier side to join, but it is one of those firms that wants to keep you there. And we'll talk a little bit later in the show about firms that maybe don't want to keep you there. So choosing the right prop firm and putting forth the money up front, assuming it's right for you, it's not right for everybody, but it is right for a lot of you, is a very important decision. So take a look at all the links down below from Maverick Currencies. They have a stock and options division, and then they have a Forex and currencies division as well. So moving on, let's talk about, we'll start off with, I think, what would typically not happen to a professional prop trader. This one is going to happen to somebody who's really starting out for the first time because they're so excited to jump right into the pool that they've seen all these charts when they were learning. They saw these tools that seem to work really well. They've actually maybe put them onto a demo account chart, and they're chomping at the bit to make all of this money in Forex, for example. And they're so excited that they have absolutely no structure when it comes to position sizing. You would think this would be a requirement to start trading, but oftentimes you're saying, and if I think about it, I probably agree with you, this is a skill that actually comes later, right?
Sadly, the answer to that is yes. Today, things are much better today as far as the amount of education that's out there, the amount of, things that are out there to walk you through getting started in trading. And position size has become part of those basics of, hey, you need to learn this basic part of trading because it is required to trade correctly. I got into trading in 1997. There was no books on position sizing. There were no hints or there were no sayings of, hey, just do this. It just didn't exist. So when I started trading and I had my account, how much to put into each trade was completely arbitrary. And sometimes I did a big one, sometimes I did a small one, sometimes I did a little. And again, there was no consistency in this. And so what happened was I had uneven results, meaning that the positions that I put a lot of capital in that worked for me made me look really good. But if I had a loss on a position that I had a big position size in, it actually would wipe out 3 of the winners. So imagine I go ahead and put, a little bit of capital on 3 winners, and then I start to feel confident, so I put a big chunk on the 4th trade in that loses. I have a 75% win ratio, but I've lost money in my account. Position sizing is so important because remember, when you actually enter a trade, you have no control of what's going to happen. You think every single one of those trades is going to work out when you make them, or you would never have made them. But in the end, you're going to get your win-loss percentage, you're going to get your profit factor. You have no idea to know which ones are the good ones and which ones are the bad ones. So you have to treat them all the exact same.
Yeah, I was laughing a little bit when you first said, back in 1997, there really was no such thing as position sizing. I mean, there was, but you're right. There was no reference out there. Like, I'm sure there are people out there who wanted some type of structure to follow, but if there's nothing available, then there's nothing available, which is a crime against humanity, because there is no way you are going to have any type of long-term sustained success without some sort of risk structure and just position sizing in general. And so I got news for you. Flash forward to 2024, there still isn't a lot out there with all of the resources we had. So for those of you who might not know, on No Nonsense Forex, if you still don't have anything to go by, go to my risk video. And when I put that out and actually showed people not only how to position size, but how to adjust it to the volatility of the currency pair you were trading, I got such tremendous feedback from people that said, I've been looking for something like this my entire trading career, and it never existed until now. And I'm sitting there like, really? How is this even possible? What were they teaching you if they weren't teaching you this? This is literally a prerequisite for anybody to become successful at this long term. I was just so blown away by a video that I thought was compulsory almost for anybody, but it turned out to be revolutionary. I couldn't believe it.
Position sizing is the most important part of trading. And I hope you can hear the gravity in my voice, because it is everything. I am in charge of when people go through Maverick and they do their demo trading, they do their trading plan, and they turn in all of their statements and their trading plan just to say, hey, you know what, I'm ready to go, check out what I've done. I am the one that goes through those trading plans and those trading statements. The very, very first thing I do, because these trading plans can be sometimes 15, 20 pages long, the very first thing I do is I go find their position sizing and risk management. And if that fails, I don't read another line. I reject it and send it back to them and say, go fix this first. I'll look at the rest later. That's how important it is to us at Maverick. As I said, if I read that and I don't like it, I don't care what indicators you use. I don't care about anything. It's getting rejected, sent back until you fix that position size.
Yeah, and I'm sure you probably got some pushback on that too. Like, well, when I demo traded, it worked really well. It's just a matter of time, Rob. You gotta give me some time for this system to work. Did you ever get any blowback from this, or is it pretty obvious to people? Okay, maybe I should have some type of structure.
I can't remember if I got any blowback, but this is something I think everyone who's savvy enough, who's been around long enough, knows how important it is. It's like when you were very first as a trader. Imagine your very first time you ever sat down to read anything about trading and someone talked about risk management. It didn't really ring a bell to you. Risk management seemed like some dumb job that someone had in an office somewhere. Once you get into the markets and trade, enough times that risk management is really, really important. And so I think, by the time people get to a certain level where they're building systems, it's not really that hard of a conversation to have, especially when you can point out some of the issues that are going to happen. And when you point out those issues and they say, yeah, you know what, that happened to me 2 years ago. And what happened? Well, I halved my account. Exactly. So it's not that hard of a conversation with traders who have been in the game for a little bit.
Well, that's good to know. Yeah, because risk management, like you said, it's pretty much everything. I even tell people, I manage risk for a living, which I do in trading and investing, in business, everything, really. That's kind of what every adult pretty much does to some degree. I think we just tend to do it more because we really don't have a choice but to have it absolutely, to not have everything just completely optimized when it comes to your risk management. Because you know how this industry is. There's just hardly any room for error, especially errors that you are repeating over and over again. That's going to sink you right away. But let's go ahead and keep moving forward here, Rob, if we can. We're really talking about the reasons why somebody might end up making the wrong position size, whether it's going to be too much, too small. I think the most common one is probably too much. So ignorance is certainly one of them, but that's almost not your fault. That's just a matter of not knowing what to do. These next few we're about to talk about, if this is happening to you, it is absolutely your fault, and the very first thing we need to do is recognize it and address it. So Rob, go ahead and start us off with the next one.
The first reason I want to talk about that people deviate from position size is they look at their account size. They look at their account size, and if it's not very big, they're going to look at, okay, I'm going to be putting in all this work and effort into trading, and if I do it right, I'm going to get X% a month, a year, whatever it is. And then they do the math, and they see, oh, that's only $100. That's a lot of work for $100. They look at their account, they look at their trading results, and then they see that it's not going to produce much money. We at Maverick say, do not focus on money, always think in terms of percentages. Everything is percentages, because if you make the percentages, the money comes. If you don't make the percentages, it doesn't happen. A lot of people will look at their, let's say someone puts a small Forex account of $500 and they're like, hey, I'm going to make some money. Their goal is not to learn how to trade and get good trading numbers. Their goal is to make money. Well, I hate to break it to you, but there is zero chance for you to make any significant money off of $500. And if you were to really trade that account responsibly with good position sizing, you might double it every 18 months. Just think about that. Double it every 18 months. Do you know how long it's going to take you to get to a point where you have a big enough account that is actually going to matter? So what happens is people tell themselves, well, I've got to go bigger because it's not worth my time to go slow and steady because it's not going to produce the money I want. So what they do is they overposition size, they take big losses, and it's so sad because they never got to the point where it paid off. That's the saddest thing, is that they just couldn't wait for it to grow.
Yeah, and I hate to pick on this part of the world, but this is what you see a lot in places like Africa. And I mention Africa because Africa is Forex crazy. South Africa, Nigeria, Kenya, Ghana, big trading areas. And unfortunately, I think why it's so big is because of what they were likely promised. So if you are starting out with $500, that's a few months' salary in a lot of places, for example, right? And to say people live paycheck to paycheck in certain parts of the world is an understatement, right? So this can be a lot of money to somebody, but you obviously don't want to move that $500 up incrementally. You want more. Now, with leverage, Forex allows you to do this. And therein lies the problem. We've spoken about this on the show before, Rob, how most of us, no matter where you come from or how much money you have, were allured by the crazy upside potential you could be earning because of leverage in the Forex market. Remember, this is all before crypto. So what happened is that people were sold this false bill of goods and their mind just stayed there. And then when I come in, and I had an episode, a podcast episode, my very first podcast, and it was about 35 episodes in, called How Much Does It Actually Take, or What You're Actually Going to Need. And I told everybody, guys, if you have under $1,000, for example, or even if you have $5,000, $10,000, you're never going to make the money you want. It's just not possible. So stop doing it, because that money you do have, no matter how much it is probably quite important to you, and you should use it for other things like savings, like investing, like whatever, because you're going to lose it, because you're going to risk too much, and at some point it's going to go away. Now, I also came with a solution later on and said, hey, this is where prop firms come into play. Prop firms are not going to give you a lot of money up front. Why would they? That's absurd. But if you show that you know what you're doing and you can grow that initial amount at a reasonable, mature rate, they will give you more. And then you just repeat the process, no matter how much they give you, and you're going to be just fine. That's really the key, because most people can't just drop 6 figures into a trading account, but you have to do this right. But man, you're so right about this, Rob. Having an account that's too small and thinking, man, why do I want to work so hard to make $20 and be proud of it? That's not worth my time. I want to make a lot more. And that's exactly why every single one of us crashes and burns when we first start out.
And if you think about it, the saddest thing is that, becoming a good trader just takes time. Look, I wish you could just be born a great trader. It's not how trading works. It takes years to become a good trader. And it's just really sad that, that the need and the desire to make a lot of money off of your smaller account size is going to cause you to fail. And by fail means you never get to the point where you were a good enough trader to generate a good return, where capital then starts to matter. Because capital doesn't matter. I don't care if you start out with $100,000 or 1,000. If you don't know how to trade, it's going to zero. It's going to go to zero. So if you have the right perspective, then yes, that's how you need to look at it. You're not trying to make money. You're trying to make percentages. You're trying to prove that you can make percentages. You're proving your win-loss, your profit factor, all your trading numbers. Then it's all just a matter of capital. And the prop firm route is a route you could take, but another route you could take, and we've talked about this, Patrick, is to feed your account. Feed your account an extra $100 every single month. Save up money, cut back somewhere, feed it an extra $100 a month. That's going to really help that account grow much faster, to where you may be able to double an account, again, a small account. So let's say you start off with $500. If you just put in $100 a month and break even, that account will double in 5 months. If you're able to add on some return, it's going to double even faster. Now you're doubling an account every 3 to 4 months in the beginning. Now look, as this gets bigger, your $100 is going to help grow it less and less. But again, there's ways to make it faster, but it's not over position sizing. You have to do this the right way and be willing to use the compounding interest over decades in order to get the results that you want.
Yeah, and just know that even if you do things the way Rob just said, temper your expectations. You're still not going to get rich fast that way. You will get rich faster, but we're still talking about a pretty long time. Like, it does take money to make money no matter what you're doing. And so I have always recommended using somebody else's money, and I would strongly prefer, just for my own sanity, choosing a company's money over a stranger. So your two choices, in my opinion, not to go too far off on a tangent here, are to do it yourself with a small amount, or to actually have a real chance at real upside and go the prop firm route. And thankfully, there's a lot of them out there. We're going to kind of segue into that, maybe not right away, but into this next section, Rob, to where one of the other reasons why you might be intentionally making the wrong position size is because of what happened in your last few trades. Very interesting. Go ahead and speak to this a little bit, and I'll jump in where I can.
This is going to be the one that is probably the most important to anyone who's been trading from 1 to 5 years. So speaking to those of you in that range, this is the one that's going to be really dangerous to you, where you've done it enough, you've got it down, but now you've got this, I call it baggage, the baggage from the past trades that is going to come into your next trade. Now, typically, the way I see it the most is when people take losses. People take losses. Let's say you took 3, 4, 5 losses in a row. Now, statistically, that's pretty much guaranteed to happen to everyone at least once or twice a year. That's just a guaranteed statistic. You can go one of two ways, and it's crazy because they're both wrong. I have people that get gun shy, and what they do is they cut their position size down. Now, just think about this mathematically. If you are trading, you trade 5 trades and you take a 1x loss. Okay, so each one of those trades you took your, whatever you decided your position size is going to be, loss. And then on the 6th one, you chicken out and you say, I'm only going to do a half a position size. Do you realize that you need to have 10 winners in order to even get back to where you were? All of a sudden, you've put yourself in a really bad situation mathematically, where it's now going to be even harder for you to get out of a drawdown. And guess what? You're very unlikely to make 10 winners in a row, and you're even more unlikely to have 15 winners in a row, which is what you would need in order to actually go above where you started. It's just mathematically, it's such a bad decision, but yet psychologically, we feel it. Psychologically, we're like, oh, I don't have the confidence anymore. I'm going to cut my position sizing down. On the other side, we have people that take 5 losses in a row and say, you know what? How about I make my 6th trade larger? Now, they make it larger because they say stuff to themselves like, well, statistically speaking, I should have a winner here pretty soon. Guess what? Your 6th trade has the same odds as your 1st, 2nd, 3rd, 4th, and 5th trade. It's all the same. They make it bigger so they can recover those losses. Like, okay, I got to recover my losses. If I just go a larger position size here on trade number 6, all of a sudden now I've recovered 2.5 of my losses. So they're not even looking at the trade. They're looking at the past results, and they're looking to make it too large. So those are the two ones I really see. And losses tend to mess with people more than wins. We're going to talk about a series of wins after this, but these losses, they really seem to be the one. Patrick, have you ever had anything like this in your life or heard about it from someone else?
Yeah, early on, oddly enough, I never really chased losses. Now, I don't think we need to tell you not to chase losses on this podcast, or maybe we do. But we're going to talk in just a moment about why there might be an increased chance that in normal situations you would not do this, but in certain situations you're going to be compelled to. But yeah, I was always more kind of the chicken out person, where if I was taking losses, I didn't want to take any more losses, but the trade was still there. So what do? Well, I'll just bet half, what I normally risk on this trade. And, of course, Murphy's Law, that's the one that did really, really well. And I should have put a regular position size in there because I would have made back all of my losses. But no, I deviated from my system. Position management is part of your system too. So no matter how you deviate, it all ends up, hurting you long term. But yeah, I want to transition into wins too here, Rob, because when you have dread with losses, you have euphoria with wins. And we've talked about this on the show too. But what are some reasons that after a really great string of wins, and now I think I'm the smartest trader in the world, now I think I just ate the star in Super Mario Brothers and I am invincible and I'm untouchable, what might I do how might I deviate from my position sizing now? What are the most common errors you've seen from your traders on this one?
Let me use a personal example of this, because I don't know if I've told this story before on your podcast, but the last major trading mistake I made was in 2008. And this is that story. I was, 2008, the economies were crashing around the world, and I was very bearish at the time, and I was trading Aussie yen. Now, I do what's called a pyramid strategy. What that is that I take a position, and then if it goes my way, I take more of a position. If it goes my way, I take more of a position. And the whole time, I'm just adjusting my stop to never have more risk in it than I did on the first trade. So So theoretically, if you have a trend that keeps going, you theoretically are entering in multiple times. And again, each time there's a setup that presents itself, I'll grab more, adjust the stop. It was during September of 2008, and things were absolutely collapsing. And I had built up 44 lots of Aussie yen on the short side. And when I finally exited the position, the entire position averaged out was a 400 pip gain. That ended up being about a $180,000 gain. And it was a huge gain for me. And it was one of those days, pumping fist, like, oh my gosh, I can't believe this happened to me. And I told myself, Rob, just chill out. Like you just hit a home run. Just chill out for a while. Don't make any trades. Because I knew that this is my pattern where once I had a big win, I went even bigger the next time. Well, I didn't do it. And my next trade, I started out with 100 lots. I started with 100 lots. Now, when I clicked that button, just from the bid-ask spread alone, I was down $3,000. The second I clicked the button, my P&L said negative 3,000. And right there I said, uh-oh. And I knew it, but I'm like, nope, I'm going to let this trade go. Huge position size, ended up losing 100,000 of that. And I was so livid and upset with myself, that I knew better than that, but yet this one got me. So look, I like to tell these stories. They're not great to tell because they make me feel a little embarrassed. But I think it's really, really helpful to share those kind of stories just as a warning that this is really dangerous. My personality is all about wins. When I get hot, when I get on a streak, I used to feel invincible, and that's when I would make my mistakes. I didn't have the problem on the other side. When I took losses, it was not a big deal to me. I was able to shrug it off. When I got a series of wins, oh my gosh, I started planning out all these things I was going to buy, planning out my family's future. Look, we've talked about this. When you get the delusions of grandeur, that's when you should really be scared. So I wanted to share that personal story just with people to let people know it happens. I've been trading for, 10, 11 years at the time. Now, I'm happy to say that's the last major mistake I've made. It's been, 16 years? But I'm still worried about it.
I think you've told that story on the podcast. I have heard it. I don't know if you've told me in confidence or on the show itself. But yeah, that is a wild one. Just lots that are so far beyond my own comprehension that it's just, I'm living vicariously through you because I don't think I'll ever get there in my entire career. But just the fact that you were there and you experienced it and had that kind of rush is really, really awesome. It makes for an awesome story. The result wasn't awesome, but I even said, I think when you said it, I don't know if I said this on the show or to you, but it's like in Vegas when there's a hot roller at the craps table. Some drunk will always say, "We got a hot roller over here," and Vegas will not stop you from doing that. They love the fact that you're inviting all these other people to come play at the craps table, thinking that there's this hot roller, not understanding that the probabilities are exactly the same as it was back when there was a cold roller. The probabilities are the same. It makes no difference. That whole hot hand thing is propaganda on the highest level. But I really, really want to get to this next point because it's the one I've been talking about this entire episode. The reason why some of you, especially those of you who have gone the prop firm route or you're selling a product, whatever, are compelled to put up the wrong position size, and usually in this case it's going to be too much, is because your prop firm or your goal that you set for yourself was a certain percentage, and you are currently too far away from it. Now, I have some things to say about this, but Rob, I want you to go first, and then I will add my piece, because I have no idea what you're about to say here.
It actually swings both ways, where we will have someone who is underneath the high watermark. So our high watermark is you get paid out of anything above your high watermark. And we close the books in our Forex division at the end of every month, so on the 30th or the 31st. Or on our options division, we close the books on monthly options expiration, the third Friday of every month. I'm always very, very cautious about those periods because I'm watching who were the people that deadline is affecting. Because look, if you're just trading and you trade for the whole year, you don't have any deadline. You're just trading. But all of a sudden, when you start to make up these arbitrary deadlines, the third Friday of the month, all of a sudden, that's meaningful to somebody. And they're looking at their account and they're saying, ooh, I need to be profitable this month because if I'm profitable this month, I get a level advancement and I'm too far away. If I make a bigger trade and get it right, it's going to push me over the edge. That happens. I shouldn't say all the time, but look, it's something that I definitely watch for. But you also get the other one. You get the other one where the person is above their high water mark, but not by a lot. And again, they're going to get a level advancement as long as they close above their high water mark. They get chicken. They get scared. They cut back position sizes or just don't trade at all. So these periods, like in a prop firm, they are meaningful. And if you took them away, you would never deviate from your position size on the third Wednesday of the month. Like, who cares? That's just a nothing. But all of a sudden, you put this arbitrary deadline in that has some sort of significance and meaning, and it's going to cause you to change your position sizing to get the desired result you want for that time period. Now look, this is in the prop firm area and it's definitely a big thing. You know, you've got your end of the month metrics you got to meet. You've got all these things you have to meet and it's going to cause issues. That being said, it happens in regular traders' lives too that aren't with a prop firm because they're going to set arbitrary numbers for themselves.
Yeah, and if I can jump in and say two things. One, if you're not trading with a prop firm and you do set these levels, don't do it. I've said before, I like to try and beat Warren Buffett's 20% every year, but if I don't, I don't. As long as I'm consistent with my system, then some years it's just not going to happen. You know, sometimes the volume's there, sometimes it's not. There's nothing you can really do about that. You can't force things to happen because as soon as you start doing that, it's all going to go downhill. You and I were talking a bit before the show, Rob, how there's some people that have these arbitrary goals every month. And this is ridiculous on so many levels because especially month by month, some years just aren't going to give it to you to where you're going to hit, you're going to have the success you hoped for. But some months are just trash, and it's not going to give anybody, especially if you're a trend trader, anything. And so if you're still trying to eke out 2 or 3% when the market is giving you nothing, well, then this is an absolute recipe for disaster. Now, I do want to say one thing on the prop firm side, and I've said this before, there are prop firms out there that, and this is how you know a prop firm is predatory, and they're really not interested in your long-term success. If they require you to make a certain percentage every month or even every quarter, I would go as far to say, or else you're kicked out, that is a very scammy, predatory business model to where they're just trying, at the end of the day, they just want your upfront fees. And they know at some point you're going to conk out, but that's fine. It's just lather, rinse, repeat. So I've never been a fan of things like that. Now with Rob's high watermark, that's a totally different ball of wax. That's not a requirement to stay in, but that is a requirement to advance. Totally different thing. I get that. But if you are a part of anything that mandates that you hit a certain level every month or even every quarter, or else you're not with them anymore, do not join from the start. I just had to get that last part in, Rob, before I take it back over to you.
No, I will give the exact same advice for sure. One other thing I do want to talk about is it's a pet peeve of mine. So look, I'm just going to air my grievances. This is a pet peeve of mine. But I told you, like when I get a trading plan in, if position size isn't there, I reject it and send it back. The other thing, if I see it in a trading plan, I don't reject it, but I always have this conversation because I'll see things like, my goal is to make 3% per month. I hate that so badly. I hate it. It drives me crazy, and I cannot let it go because I always have to have the discussion of, okay, look, you can't use those words. You can use words like, I want to average 3% a month over the year, because look, there's going to be some months where you get a 0. There's going to be some months that are negative 3%. So that means you have to have some months that are 6% and 9%. Like, that's how trading works. It works like a chart. You go up and down, and by saying things like 3% every month, you are absolutely putting all of this psychological pressure in your brain that is worthless. It's completely worthless to you. So I always hate when I hear people say, I want to make 3% a month in trading. I want to make whatever in trading. That's not how it works. You have to use different languages because it will absolutely set you up for doing all the stuff we're talking about here, about changing your position size so you can meet those arbitrary goals that you set for yourself that really are stupid.
I would go as far as to say, don't even say that I want to average over time 3% a month, because that's 36% a year. And if 36% a year is your goal in Forex trading, you are going to have a bad time. But let's go ahead and take care of this last one, Rob, because this has been a dedicated episode on our show. But I think it affects so many people that I have absolutely no problem hitting the repeat button on this one because it needs to be repeated. Plus, I never know how many people who are listening to us right now have listened to every single episode, have only listened to a few, how many cherry pick, or how many are joining us for the first time. So let us bring this one up again. And I would even say, Rob, 20 episodes from now, we need to bring it up even again, because desperation is going to kill any trader. Maybe not at first. God forbid you get lucky on the first one. You're really setting yourself up for demise later. But if you have external factors that are requiring that you have X amount of money, and you are not able to get that through your normal means, do not try to get this in the Forex market. The chances of you succeeding here are so low. And again, even if you do succeed, long term, you're setting yourself up for even more grief.
It reminds me of my favorite saying in poker. All in works every single time, but once. If you do this, and as you said, Patrick, you might get the first one. You might get the second one. You'll lose. This is the most guaranteed way to lose your account, is to treat this account as, I need to get money out of it within this time period, and I need this much money, or else something bad happens to me. That is the absolute most stressful, worst situation you could put yourself into. And I don't think any human being has a capability of rationally thinking in that point. So just avoid it. Absolutely avoid that thinking. And again, this episode is about giving you those red flags. So when these thoughts pop into your brain, that you've got Patrick on your left shoulder, you got me on your right shoulder, and we're kicking the devil off, and we're saying, no, don't screw this up. Do this the right way, figure something else out. Don't look to your trading account to make your rent. That's just really bad. So I just want to put these things into your brain so that if and when you think them, you understand that they are red flags and to avoid that behavior.
And the very last one you put on here, Rob, was a very interesting one, because this is not something I've ever really thought about. But it's having bills to pay or having rent to pay is a very short-term stress. If you, for some reason, are older, or you're getting older, and you are concerned that, just due to inflation or due to the fact that you just don't have enough saved, that you may not have enough money to retire. I heard on a podcast this morning that a lot of people on the podcast were in their late 40s, early 50s, and they said, by the time Social Security comes around in the U.S., I expect to maybe get 70 cents on the dollar if I'm lucky, if it's even there in the first place. So there's a lot of stresses there because the boomer generation mostly got to retire. But I don't think generations after that are going to be nearly as fortunate. And that's a very scary thing in a lot of ways. And so what do you have to say to the people that might be pushing the envelope a little bit here because they're really concerned that they're not going to be able to quit the job that they hate and they're tired of but are sticking with because they're older and they're just simply not good at anything else?
This is a very difficult question and a discussion to have because this is a math question. This is simply math. And when you do the math, when you sit down and you say, okay, I'm 48 years old right now, I have this much money, I need to have this much money by the time I'm 65, that's just a math problem. And it's pretty clear that the math isn't in your favor. And so when you look at, okay, well, how do I change this? There's a couple different ways to change it. You can save up more, but sometimes that isn't possible. Sometimes that's very difficult to do. Or the other one is, hey, I get a higher rate of return. If I can simply raise my rate of return, then the math works out. So they really focus on raising that rate of return, and the way they do that is by taking larger risks, more concentrated risks on more volatile investments. And look, it might work out, but for some people it's not going to work out. This is where I hate binary results. I hate thinking in binary, where like there's someone that's 48, let's say they have, 50,000 saved up, which 50,000 is a lot of money, but it's behind at 48 for retirement. And you got this binary thought of, oh my gosh, I'm either going to be destitute on the streets or I'm going to be a multimillionaire sipping champagne. Like, that's what we've all set up this retirement to be like. There are a whole bunch of areas in the middle, to where if you're behind, instead of going all or nothing, why don't you just recognize that, hey, you're going to have to work part-time for 10 of your years of retirement, or you're going to have to pick up another job now. There's other ways to fix it than going after let's go big or go home on the rate of return. So I don't like binary thinking and things like that. Just understand that that's a risk you're going to take. You can fix this problem with other ways other than just putting it all on black and crossing your fingers. That's a really dumb thing to do with your future.
And let me give you two alternatives while we're talking about it. One, I think there is an enormous opportunity with everybody working from home now, and that momentum probably, that pendulum not swinging the other way probably too much as we go forward. It's probably going to a little bit, but it's just going to be the new way things are. And with what I just talked about before, how the amount of people who can actually retire at a certain age is going to go down, they're still going to need to work. I think there's going to be a huge industry out there for people of retirement age to work online, especially because Gen X and below, we know how to work online. There's no learning curve, really. You can just plug us in and let us go. So I think there's going to be opportunities there, even if it means, like you said, working part-time. There's going to be opportunities to make money for people of retirement age that don't involve, physical labor or sitting at a desk all day or something like that. Two, and I've said this many, many times on my own channel, trading is a lifetime skill. If you know what you're doing and you're earning consistent money year over year, that's not going to change when you're 65. And as long as you're cognizant and you know what you're doing, and with something like this, you've probably built up the muscle memory, you can do it in your sleep, you can continue trading well up until the point to where your brain just doesn't allow you to trade anymore, whenever that day is going to be. So your opportunities to make money in many ways, whether it's from actually working, but an easier job, to trading, to taking those profits and putting it into something that pays you, are probably more than you realize. So don't feel that stress of having to have X amount of money by a certain time in your life. I think that fear is very nonsensical for most people, especially if you know how to trade.
And I think you put that perfectly. Trading is a lifelong profession. And even if like right now, so let's say you are, 30 and you've been into this trading game for 4 or 5 years. Guess what? It takes people a decade or 2 decades to reach real proficiency in their profession. You might be looking at what you're making today and being like, ugh, I'm only break even, or I'm still losing a little bit. Look, life is long. So if you were that 48-year-old person that only has 50 grand and you say, oh, what am I going to do? Do you know how good of a trader you're going to be in 12 years when you turn 60? Then you can actually take that money that you have and actually create a decent return off of it, which might fix the math. So the thing I just hate, especially in this episode, is that somebody is going to make a mistake early on in their career and have to quit because of it, because of position sizing, and they never get to the point where they have this lifelong skill. If you get into trading with the thought that, hey, I'm just building a lifelong skill, the money will come when it comes. That's the right way to do it.
So on that note, everybody, don't feel unnecessary stress to hit certain points in your trading career. If you just put your head down and do things right and constantly improve, it's going to get better, and you have a very long time to do that. So for Rob and myself, thank you for joining us here at the Trading Psychology Podcast. We will both see you next time.
Good.
This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, it is the great one. It's Rob Reinhold.
Your introductions are getting more and more grandiose, and I literally can't live up to them. The great one? Oof, that's tough. So let's go a little lower. I've always had the attitude in life to underpromise and overdeliver. If people think you're going to be terrible and then you turn out to be average, it's a pleasant surprise. When you build me up as the great one and then I turn out to be average, it's a disappointment. So let's have this be our top one now, and let's just go down from here.
Fair enough, but in today's episode, we are talking about what it is to be great. This is obviously not going to be a very zoomed in episode. It's going to go over a lot of things we talk about on this podcast. But this is more of a kind of a broad scale, holistic episode that Rob put together. And when he and I were talking about it before the show, we're like, you know what, let's not really even talk about this one. Rob put the whole thing together. Rob, I'm just going to have you run, and I'll jump in wherever you would like me to, because I want to see how you put this together, why you put this together the way you did, and what kind of overall point are you arriving to at the end, because I don't know that. We never, like I said, we never really discussed it at length. So fire it up and let's go.
It's that time of year where you get the high school commencement speeches, the college commencement speeches. Basically, at any sort of graduation here in the United States, you have a speaker that gets up and talks to all the people that are graduating and basically talks about, hey, you're at the infancy of your career. As you graduate high school, hey, you're just starting out, going out in life. And these are the things that you need to know in life. And I came across a talk that Roger Federer gave. For those of you that don't know, Roger Federer is one of the best tennis players of all time. And he gave this talk, and it spoke to me. And I said, you know what? That's what I want to talk about in this episode, because this speech is absolutely fantastic. Now, Patrick, I'm going to give you the link, and I would love for you to put it on your YouTube channel. And it's just the part that we're going to talk about. It's only 2 minutes long. If you want to see the whole talk, I highly recommend it, but I just really want to focus in on these 2 minutes. So if you want to, pause the video and go to YouTube, watch this clip, and then come back on. And I really want to talk about exactly what he talked about.
Yeah, so I did watch the clip when you gave it to me. It really was interesting. He goes over a lot of the stuff that we talk about here, but in a slightly different way. And I think that's good to hear, especially from somebody like, I watched plenty of Roger Federer growing up, and he was, to me, like the ultimate final boss. Like he was just so good at everything and so technically near perfect that if you beat him, you were almost like just on your best day. The back and forth between him and Rafa Nadal were just some of the best matches of all time because they were just so two completely conflicting styles on top of that. But to hear him say what he said, and to an American audience, no less, to where I think it made a lot more sense. We can talk about that too if you want, Rob. But yeah, great clip. 2 minutes of your life. You can just pause and click it right now if you want, so you can kind of understand what we're about to talk about here. But definitely, highly, highly recommended taking 2 minutes out of your day to do that.
The first thing Roger Federer talks about is his kind of long-term success. He talks about over his entire career, he won over 80% of his matches. Now, a match is where you play a game against another tennis player, and it's consisted of a whole bunch of little points that you have to get. For those of you that don't know tennis, don't worry about it. But a match is basically you beat an opponent. And he talks about, the championships he's won, and then he starts to break it down into smaller things. And so he says, I won about 80% of my matches. That is just phenomenal. That's a phenomenal number. And you look at that number and you say, oh my gosh, how could someone be that good? But then he started to break it down. And he said, a game of tennis is all about points. So if you do an analogy of like American football, it's about a play. Basically you run a play or you do some small thing. He said, in my career, I won 54% of the points I played. Think about that. Here's this great tennis player who has had all the success, but when he played against other opponents, he only won 54% of the time. Now, Patrick, I don't know if you are connecting the dots here, but I'm sure you are, but I want everyone else to connect the dots here. We talk a lot about trading. We talk a lot about these big, grandiose things of success in trading. But when you break it down, 54% win-loss ratio. Is that an acceptable ratio in the world of trading?
It's absolutely essential. There's some times where I would like to be hitting at 54% myself. But it's always interesting to hear somebody who wins 80% of his matches, and it is so technically perfect and had such a high first serve percentage on top of that, to still only win 4% over a coin flip every other point. So it really, I think, speaks to what we're talking about today.
After Roger Federer talked about his 54%, he then starts to break it down into some real smaller numbers. And he talks about it's not about perfection. It's about consistency. And he talks about how every single point should be treated as it is the most important point of your entire life. So basically, he says, I didn't take any points off. Every single point was the most important point of his entire life, whether it was in the first round of Wimbledon or it was in the finals of Wimbledon. Basically, giving full effort to the moment. Then the next thing he said is, the last point that happened means nothing. So just think about that. All of that effort, all of that struggle to win 54% of his points, and yet he says, none of that matters. Because guess what? The next point is the only thing that matters to you.
Yeah, so if you haven't figured it out, we're correlating all of this to trading. And I want to see what you think about this, Rob. I'm going to agree and disagree. I mean, yeah, having a short memory is paramount. We talk on the show about that. One of my earliest trades with Maverick and how I made a mistake and lost a whole bunch. And I was really salty over it because I blamed the platform and all that. And I don't think about it today, but it hung on my mind for a long time. And it really did me no favors. And I've had losses in the past where I might have made a mistake. And those are always the worst because it should have been a win, but you did something stupid, and now you've turned an easy win into a hole you have to dig yourself out of now. And that's no good. So I think he's 100% right on that. You and I have talked about having a short memory as well. The one pushback I will give is in the context of what he's saying. Yes, you want to, in every point, you should put your all into it. I mean, I can see how you would do that in life and in work and things like that, but not in trading. I don't think you should be putting your all into a trade. I think you should be dead inside. You should follow a system, and you should leave your all off to the side, because your all includes your heart, your effort, everything like that. And leaving it all on the table like that in the trading world, there's nothing romantic about that. It's stupid. It's going to affect you. So I guess that's the only pushback I would have there.
I don't think that's pushback at all. This is literally almost every single episode we have done in this podcast is about this struggle right here of each trade having its own life and its own thing and its own, it goes up and down. And for you to be, in that moment, and then you're supposed to go to the next trade and completely flush away every single thing that happened in that last trade, and you're supposed to attack the next one. And again, when we say about your all, we're basically saying you do it perfect. And to do it perfectly, you do it without emotion. You just follow rules, follow what you've decided and what you've backtested. So I don't think it's pushback at all. I think it is the realization of the reality of we get in these situations where we get these trades. And these trades can sometimes bring so much stress and emotion. And yet, how are you supposed to not take that into the next part of your life? And that's literally what most of our podcast is all about. So I think you're spot on there. And I think that is the struggle that we're talking about in this podcast, is how do you actually do that? In Roger Federer's talks, he talked about how the last point doesn't matter. And this is what he says, okay, the last point, I just got beat by a great lob shot. You know what he says? It was just a point. Or that last one, I did a double fault. You know what? It's just a point. And then he says he makes some amazing play. He has his overhead smash, and it's on ESPN on the #1 greatest play of that week. Do you know what he says about that? It's just a point. So we need to be able to adopt this into our trading, to where we understand that we're going to make some great trades in our life. And guess what? It's just a trade. And in fact, I want you to start to take that saying into your own personal life. It was just a trade. It was just a trade. That's it. And guess what? Sometimes it's going to make the highlights. Sometimes it's going to make the lowlights. But your career is not going to be determined by those points. Just think about that. And again, an analogy in tennis. Okay, so he had this wonderful, amazing shot in Wimbledon one year. Guess what? That doesn't make a career. What really makes a career is what you do with those points, what you do to prepare for those points, and then how consistent you can be going forward. And so he goes through all of this about how he's had great shots, he's had terrible shots, and he's won 54% of his points. And then in this where he really gets into, he says, the best in the world are the ones that can flush away what just happened and be dedicated and focused and consistent. And he says, look, you're going to have some down times. You're going to have doubts. Your opponents are going to have doubts as well. The best in the world are the ones that can get rid of those negative doubts and move on and go ahead. The best in the world go forward, even when faced with adversity.
Yeah, and I think this speaks to what I was saying before about him speaking to an American audience. And this is one of the things you and I did talk about before, Rob. And this isn't me playing home team bias, and I get accused of that on my other podcast a lot But in the United States, the reason why there's so much innovation that comes out of here and so much enterprise that comes out of the United States even still is because we have a mentality to where it's okay to fail. Not only that, there's people out there who celebrate it, even fetishize failure. Because, I've even said it on my own videos. That's one mistake you're probably never going to make again, which is great. So every time that happens, you just become stronger and stronger and stronger and harder to take down. Other cultures don't always see it that way. So I'm not sure, where you are in the world listening to this right now or what your upbringing was. But some cultures are afraid to even start because the price of failure would be too great. It would wipe them out. And so they just don't have that in them. There are other cultures to where failure is not accepted at all. It is shunned. And this probably affects people too. So wherever you are in the world, just know I feel for you if you didn't have the same culture as I did in regarding failure as far as your upbringing goes, but it doesn't matter. I wrote this in my book. Forex does not care. It does not know you, it does not care about you, and it will not make different rules for you just because of your situation. It's a blank slate. So you better adapt this mindset on failure real quick if you haven't already.
And I would guess the fact that people are here and listening to this and have made it to your platform, they're already there. They're already there. You are not your parents. You are not the negative aspects they passed on to you. You're not the negative aspects of your neighborhood or your city or your culture. Look, you have the choice, but another recurring theme in this podcast is you must be self-aware enough to recognize that. So, look, I agree with you, Patrick. Every personality is different, and all the things that we get growing up can sometimes be some roadblocks that we need to get over. But being self-aware is the first step to getting over those. And I'm sure that the fact that people are here listening to you, that they have already made a lot of those roadblocks go away.
Yeah, I would hope so. I don't know where in the stage of trading they are. When you've arrived at a channel that is this structured and you understand the importance of that, I think that already says a lot about you, because most traders are still, to this day, well over half the traders out there are rogue traders that have no structure, no consistency. They just come in, and if something looks good, they take it. So that's a lot of your competition out there. So you've already sprung ahead of them. Now it's just a matter of kind of fine-tuning things, and that's where things like this podcast come in.
And that leads perfectly into the first step of what it means to be great. Work. It's work. Now, we've talked about this in the podcast. We all kind of got into this because we looked at all the other sorts of work that you could do, and Patrick, you worked at restaurants. Other people have worked construction or other jobs that they didn't love. And we looked at trading, we said, oh my gosh, that doesn't look like a ton of work. And then you get into it and surprise, guess what? It's simply a lot of work, and you're going to have to work. To become great, yes, there are some people that are born with genetic advantages. There's no question about it. Like, let's just take someone like a Michael Phelps. He's a gold medal swimmer. He is 6'5" and lean and has longer arms than the regular person, and he has larger hands than the regular person. So when he swims, he can literally push more water than pretty much anyone else in the world. Okay, so he had a genetic gift. Guess what? That guy worked and worked and worked harder than, I can't say harder than the rest, because maybe there's someone who worked a little harder than him and just wasn't genetically gifted. But guess what? He worked and worked and worked. You cannot avoid that. I'm sorry. If you got into trading because you wanted a way to make money easy, guess what? Everything's work. There is no easy path in life. Everything is work. So you better get used to working. And again, working and trading is backtesting, developing systems, learning new things, all the things that Roger Federer talked about that it takes to be the best is to, again, work smarter. He's always talking about working smarter. It's never done. I mean, Patrick, you've been in this game for, 13, 14 years? Are you still learning things?
All the time. Yeah, and I learned a lot of things from my subscribers in the comments section. Sometimes they'll mention something, and I was like, you know what? It's a really good point, and I have never thought of that. And that makes sense. I'm one person, and these are a bunch of people, with different inputs and things like that. I can't, my brain's not big enough to do the work of 1,000 people. So, yes, I've even made adjustments to my own trading based on what they've said. I have looked at certain indicators in a different light based on what they've said. I've had brand new ideas come into my trading based on what they've said. So yeah, for sure. It's been a really big advantage, I think. Kind of a unique advantage. I don't think a lot of traders have the knowledge pool that I can draw from at any time.
And I would agree. I have learned so much from watching our own traders trade. I'm every single day watching over a couple hundred traders and going through their monthly reports, their weekly reports. It is amazing what you can learn from other people, but you have to be open to learning. And this is where, most of the successful people you meet are going to be very humble. Now, yes, you get a couple people that aren't humble, but they understand that to get to the top, you've got to be a sponge. And when you get to the top, people are trying to knock you off. So you constantly have to be innovating. You constantly have to be growing and learning. You are never there. If you think that one day you're going to get your trading system down and then you can kick back and put your feet up and never have to work again, you are going to be very disappointed because the market changes, technology changes, everything changes. This is what Roger Federer talked about, is that can you be fully present in the moment, but can you completely forget the last trade you make? Can you show up and run your system over and over again, and then can you stop, run analysis, look at all of the actual data, make adjustments that you need to make, and then come back and do the same thing? It's really about, again, this long-term process of, yes, fighting for every single point, but fully understanding that that's not going to make your career. Whatever happened last month on that one trade is so incredibly meaningless. It's very easy for me to say that now. I've been doing this for 27 years. I remember in my very first year, every trade was just such a roller coaster, and it truly did matter. And it allowed me, or it caused me to take baggage into the next trades. And it's just something you have to learn. So look, the first part, and we've talked about this, the first 6 to 12 months is you're learning how to play tennis. You're learning the right hits, the right everything else. After that, you're learning how to be consistent and shake things off.
Yeah, it's funny. I don't know why I ever thought this, but I really thought you do have to just put your all into every trade and just live or die by the results. No, the absolute opposite is true. So, we're kind of going back to the same point over and over here, but we're finally to this part of his talk. And again, that's the only one part I would disagree with, but only in the framework of trading.
Yep. Actually, putting your all in is a negative. And I've talked about this. There is such a thing as too much research. Once you do too much research, you start to get emotionally invested in the trade. And when people research who the CEO is and they know about the CEO and his kids and all that stuff, it's all of a sudden it's like, oh boy, you've gone way too far. This is just a point. It's just a point. Can you be consistent over your life? That is going to dictate whether you're going to be great or not. I don't care how smart you are. I have traders that are genius level that struggle. I have some traders that I would say are average intelligence. They thrive. Why? What's the difference? One of them can follow their rules better than the other. That's what makes a difference in the end. So take this Roger Federer talk and really look at your life and look at what are you placing your emphasis on. Are you putting your emphasis on the next point or the next tournament? Who cares? Who cares? Are you going to show up to every tournament, every point? Are you going to be consistent? Are you going to practice? Are you going to learn? Are you going to grow? And can you keep this pace for 40 years? Now, I've been doing this for 27 years. I have worked so many hours at this, but yet clicking a button is the smallest part of the work I've put into this. I intend to keep going and keep learning and growing and just becoming a better human being. And I know, like, we're talking about trading, but there's so many parallels to other aspects in your life. You know, can you show up every day and be a good parent? Can you show up every day and be a good spouse? Can you show up every day and be a good son or daughter? That's what this is all about, is can you keep up the pace for 40 years? And if you can, I'm telling you, you're going to be very happy with where you are in 40 years.
It's interesting, too. Like, you talked about how geniuses don't always make good traders. And this is something else we've talked about on the show, how sometimes they end up being your biggest failures. Now, you guys at home might be listening right now and say, wow, Rob and VP, those are really a couple of geniuses. You know, listen to the way they talk and the way they break things down. First of all, I don't think that's true. I tested out as a genius as a kid, but I have not taken that test since. I don't think I would score the same way as I did 30 some odd years ago. But you're going to notice too, since we're talking about sports, if you ever hear a lot of these athletes talk, as great as they are and as smart as you have to be at what you do to be great, you listen to them talk, they're the most average sounding, almost sometimes dumb sounding people you're ever going to listen to. I mean, listen to a hockey player, for Christ's sakes. They all talk the same way. There are very few hockey players out there with any personality, any ability to come at you with something like just at a completely profound angle. Like, it just doesn't exist. Yet they are so good at what they do, and there are so many moving parts of that game that you have to be aware of and sharp about and have experience in all this type stuff. And then you hear them talking, they're just like, it's the same stuff over and over again. And I've noticed this too kind of in trading. You'll see these interviews, because these channels have gotten a lot more popular now. We interview this millionaire trader, or this guy that won this contest or did all this. These guys are the most average-looking, almost doofus-looking dudes you'll ever see. There are no nerds. There are nobody, with all these profound angles on anything. So I think that's very telling. Now maybe you are not one of those people. Maybe you have a little more to offer on the personality side or the charisma side or the intelligence side. But it just goes to show, when you sit down in front of that computer, you got to be that hockey player that says the same 10 words in every interview.
Patrick, I don't think we've ever done this, but I would like to ask you one personal question, and then I'd like you to ask it to me, because I really think this is a great way to wrap up this episode. You've done a lot of things in your life. Some have gone for you, some haven't. But you've gotten to a place where you are very comfortable and, what some people would call successful. If you could just pick one thing, what's the one thing that you think you've done right in order to get to where you are?
I kept going. I've had lots and lots of failure because I wanted so bad to get out of the industry I was in, because I always thought I could do better. And so especially early on, there was a desperation angle there. So I took a lot of risks, but they were just kind of wild risks. And I was depending more on other people than I was myself. And so I had to kind of learn to just kind of take the bull by the horns myself. And if I didn't know how to do something, I had to go learn how to do it. And then even when I did that, I still failed a lot. And then I started trading, and I failed a lot. So I guess, oddly enough, it kind of goes into what we're talking about here. I just kind of kept going because I didn't know, and I had really felt like I had no other choice. It's either this or wait tables well into my 60s. And when you have those two choices, walking through the fire and just being okay with failing all the time kind of magically becomes easier, believe it or not, because the alternative's worse.
There's a word for that, and that's perseverance. Absolutely agree. All right, you ask me now.
Same question or different question?
Same question.
Rob Reinhold, looking back on your illustrious trading career and your business success, if you had to point to one thing, it can only be one, that got you to where you are now. I know it's a host of things, it always is, but if you had to pick one thing, what would you say that one thing would be?
Consistency. I was actually just talking to my kids. My kids are 25 and 22. And I was telling them it is so easy as you get older to keep routines. Like, I'm so good at routines now. Like, as far as working out, as far as diet, as far as everything is so easy as you get older because you start to really get comfortable in making these routines. And I remember when I was 21, it was tough to make routines. Routines were tough, and you just didn't have, the life experience. But the earlier you can get consistency, you are going to win. So I tell my kids all the time, you need to figure out what you're going to do in your life as early as possible. The earlier, the better. Just think about the kid who said, hey, I'm going to be a soccer player. And they said that at 13, and they literally put every ounce that they had into being a soccer player at 13. They're going to be an amazing soccer player. Now, look, they're going to be limited by DNA, of course, at some point, but they're going to be really good. I started to play soccer at age 40, and you know what? I really wanted to be good at soccer. Patrick, how do you think that went?
About as good as it would if I tried at age 40 to start being good at soccer.
I ended up being pretty good, and it was actually pretty exciting because all the players on my team were getting worse with age, and I was getting better, but they were still better than me. After my 7-8 years of playing, when I finally retired, I still wasn't as good as them, even though I tried. Consistency. So figure out what you want to do as soon as you can in life, and then work at that, not expecting to make any money for 5 to 10 years. And this is what I'm telling my kids. Look, you'll get paid, but you're not going to make any real money doing this. But once you put in those years and you pay that price, whatever it is you chose, my son's into cars. If he decided he wanted to be a mechanic, can you imagine spending 10 years super dedicated to being a mechanic and then getting into performance engines? And all of a sudden, 10, 15 years down the road, he's on a race car crew or doing something that looks to be amazing from the outside, but he just went through it. So going back to Roger Federer's talk, I asked Patrick what his was, not quitting. He asked me what mine was, is showing up, consistency for years and years and years. That's exactly what Roger Federer was talking about, and that is exactly what it takes to be great, not just at trading, but at everything.
It's funny how you said routine came later in life. It did for me too. And oddly enough, I think once I got my diet in order, because there's so many times where I would just have no energy, or I have a really bad stomach, or my stomach would be inflamed and just killing me. And all I would want to do instead of doing what I needed to do was go take a nap or lay down or just do nothing, because everybody says you have two brains, one in your head, one in your stomach. And it was just killing me. So I kind of wonder if I would have been more of a creature of routine early on in my life. But I'll tell you what, I certainly wasn't. Yeah, and that's a problem. And I think what you said too, with that younger kid applying himself to soccer, some kids just want it. Some kids need to have that structure in their life to where they're pushed to it. Because even if you have one of those, quote, overbearing sports parents, there is a benefit there. A lot of those kids end up being pretty good. They might develop other problems later in life, but their parents made sure that if the kid was not going to provide that consistency like you talked about, that they were going to provide that consistency. Because like you said, it's the only way to get there. I know professional traders. I don't know one of them that just kind of goes in and out whenever they want to and doesn't have any kind of hard, dedicated structure. They're all pretty calm, chill individuals, and they've all pretty much got their systems down. And that's really all it is. I've said it before on the show. I wish I came up with this line before. I could have shared it in some of my earlier videos. But it's a data entry job to me. I go in, I find out what needs to be traded, what needs to be maintained, what needs to be closed. And then I do that, and then I move on. That's all trading is to me anymore. And my trading has never been more consistent. Funny how that works.
And that, again, I want to just keep going back to this Roger Federer talk. That was his point. That was his point that, yes, points matter. Yes, tournaments matter. But in the long haul, they don't. If you show up every day for the next 40, 50, 60, 100 years, whatever it is, you work hard, you're disciplined, you get that mental game under control. Do not let negative energy get you down. We all have it. I've been very vocal that trading has made me cry twice. On 2 different occasions, it's brought me to tears. Yeah, that happens. That happens, especially in the beginning. Shake it off. Feel sorry for yourself for a little bit. Get back up and go all out. You do that, everything's going to be fantastic. And you know what? It translates over into other parts in your life. I tell everyone, learning how to become a good trader made me better at everything because I finally understood how to be consistent.
And I've heard a lot of my own subscribers tell me the exact same thing. I mean, gosh, it's got to be in the hundreds probably at this point as far as people who have told me via email or on YouTube or on Discord, wherever the case has been. Yeah, so this really does transcend into everything. And however you get started, whether it's through trading, whether it's through sports, through academics, whatever you can do, just make sure you carry that forward because it's not the most romantic way to live. I get that. But man, it really does set you up to live any type of lifestyle you want to live going forward. So on that note, traders, thank you for joining us here on the Trading Psychology Podcast. Rob and I will both see you next week.
Bye, everybody.
This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every episode, he is not a robot. He is Rob Reinhold.
Well, thank you, Patrick. I have been told I have no emotion, but I think that's actually a good thing when it comes to the world of trading in my profession. So I am not a robot, but I would like to be. It really bothers me when I cannot be a robot. So this episode is actually going to be very helpful for me.
Yes, welcome to the Dead Inside Club. Yeah, population you and I for now. Now, a quick note for everybody. Zoom just had an update, and I have not optimized my audio settings on Zoom for years, so I have no idea how we're coming across right now. If it comes off a little weird, just know it's temporary, and we will have optimized settings hopefully by the next time you hear us. But moving on, this has been a question that I didn't really know how to address. I knew how to address it. I just didn't know where to address it. And so I think on a trading psychology podcast, Rob, it's actually a really good idea because there is an amount of dread going on amongst some people that AI, because AI is all the rage right now. It's all anybody's talking about. It's all anybody wants to invest in on the big board market. And it's obviously coming. It's growing at a really fast rate. And people are wondering, should I even bother learning how to trade if AI is just going to end up taking over? So we need to break this down into a few different sections. And the first section is, let's kind of break down why people might think this way. So we have this broken down into 3 different sections. And the first one, Rob, is why do you think people think this way? Some people are worried, some people are not, but let's focus on the people who are, because even if this isn't at the top of your mind, this might be in the back of your mind somewhere. Is it a logical fear? We'll talk about that in a moment. But let's just kind of unearth why people might have any inclination whatsoever that, our jobs as traders or future traders may be in jeopardy.
I think that's a great place to start, Patrick. And we really have to start with kind of different personalities. So let's talk about all these possible different people who are in the stock market, in the Forex market as traders, where they are in their evolution is going to be a huge factor of how they feel about AI. Imagine if you were a first-year trader. AI is probably something that you are really looking forward to and you're really excited about, and you're saying, oh my gosh, this is going to really help me in my profession or my chase to be a trader. Imagine you've got someone who's been in the market for 27 years like myself, where I've built many systems, I've back-tested so many systems, and all of a sudden, things might change. And things changing are not good for me because I'm a little tired of putting together systems. I'm a little tired of testing systems. And this is going to change things, and I don't want them to change. So I think what it really comes down to is that the people that are looking at this in a negative way, they probably think they're going to be losing something for when AI comes into this marketplace. What do you think about that, Patrick?
Yeah, I think that's probably it. I think, like I say a lot of times too, people fear the unknown. And the best way to get rid of that fear is to make the unknown more known. And I think that's probably a more appropriate place to for towards the end of the show. But that was my concern as a content creator at first. And we just didn't know what was going on. There was all this new stuff coming out. And it was all Generation 1 type stuff. So you also have to ask the question, too, is this stuff going to be what sticks around? Or is the really great stuff not even invented yet? And then what does that look like? So it's just a lot to take in. And then there's this narrative all over Twitter that, you better do something because AI is going to be taking a lot of jobs in the future, which you can certainly make the case for. So how would you correlate this to the trading world? Because I think people all over the place are concerned, but we're here to talk about the traders.
Well, this is really interesting because all we need to do is look back in history. Every single generation has an existential crisis. I remember about 10 years ago, my daughter, she was about 15, 16, and she was becoming very concerned about the environment. And she was really worried about it. Really worried about what was going to happen, and was she going to have a world that existed when she got to be 40 and 50 years old. And she was really worried about it, and I sat her down and I said, look, every generation has this fear. In my generation, we had something called the ozone layer. Have you even heard of that? And she kind of looked at me, she's like, no. I said, look, in the 80s, the ozone layer was going to kill the world because the ozone layer, this protective surface of the atmosphere, was basically getting holes burned into it from some of our waste that we had, mostly styrofoams and carbofluorins, or I don't even know what it was. I said that wrong, but look, it was eating a hole in the ozone layer to where the direct sunlight was coming into the earth, making it too hot and, having all sorts of skin cancer. It was an existential crisis. And our generation worried about it a lot. The generation before, it was nuclear war. Nuclear war was going to wipe everyone off the face of the earth. I still remember doing nuclear bomb drills in elementary school where we got in the bomb shelter. Patrick, I know you're a little bit younger than me, but do you have that memory at all?
Yeah, I'm not too much younger than you, but no. I don't remember that at all. The closest we did is where I grew up in the Midwest. We're close to the New Madrid fault line. And some quack seismologist said we're going to have an earthquake. It's going to be terrible. It's going to be worse than the one in the 1800s that made the Mississippi River run backwards. And it's going to happen on December 3rd, 1992. So we had earthquake drills where we would get under our tiny desks as if that was going to do anything. And that was our big scare. But nuclear drills, no. That makes me think like Cuban Missile Crisis, and that's way before your time.
No, it was right at the end. I was born in 74, so, they were still doing those drills in the early 80s. It was pretty nuts. Anyway, this is not about trading whatsoever, but I want everyone to understand that every generation has this crisis, and every generation of traders have the same crisis. I mean, let's just go back to the 1970s. The way the stock market worked is telephones. You called your broker called their head office called down to the traders, and if you looked at the New York Stock Exchange, there were thousands and thousands of phones, and they set them up on these circular posts to where there was about 10 phones, and you went to one of these phones and you just picked it up, you called your head office and they gave you an order. And you had to walk over to the place where that stock was trading, so let's say it's IBM, and you had to like flash some signals up at the people on top of the IBM post. Like, I'm buying 500 shares. Then you walked back to a telephone booth, you called back to your home office called the stockbroker, and then the stockbroker called you and said, we got the shares at whatever. That's how it worked. Can you imagine if that was your job as a trader and this electronic trading started to happen? You would freak out. You would freak out and you say, whoa, I'm going to lose my job. This technology is taking over. Now, let's talk about it. Did some people lose their job? The answer is yes. I mean, what do you think, Patrick? What do you think about those people that had just gotten so used to doing it one way and then new technology came along?
Well, I'm trying to figure out who those people are because, like, for example, you don't see actual floor traders hardly at all anymore. Like the CME's down to nobody. There used to be tales of that lifestyle and that debauchery and just how crazy and aggressive those people were. And now they're gone, like completely. They just don't exist anymore. I think there's a few floor traders left at the New York Stock Exchange that you see in the background when you're watching CNBC, but I think that's mostly cosmetic these days. Like, that entire industry got wiped out. So I'm just thinking of those people in particular. Were they right to have that crisis and to be concerned at the end of the day?
The answer to that is yes, they were right to be concerned. My very first time going to one of the trading floors was in 1998. 1998, maybe it's 99, somewhere around there. And I went to both the CME, the Chicago Mercantile Exchange, and the CBOE, the Chicago Board of Options Exchange. And I went down there, went to the pits, met some of the floor traders, and I was talking to one of the floor traders, and I was saying how busy it was. He's like, this is nothing. It used to be so much busier than it is now. So I started talking to him about this electronic trading and what he thought about it. And he said, I love it. I love it because I can actually not even come into the trading floor. I can just go to my firm's office. And we have a direct connection to the exchange to where I don't even have to come down to the floor if I don't want to. And it gave them a lot of flexibility in their life and how they wanted to do it. Now, he loved it. Now, obviously, there's going to be some people that did not love it. Some people that just weren't able to adjust. And that's what this is really going to be about, is the ability for you to adjust as a trader. When I started trading in the late 90s, we did what is called bottom-up trading. If you think about it, all that means is bottom-up trading is you start with trying to find a story, trying to find a stock. Back in the 90s, there were mutual funds around, but they weren't super popular. If you were going to buy and sell a stock, you had to buy and sell the stock directly. So every single little stock was its own little island. And people were literally looking to buy and sell this particular stock. And the only way that anyone bought this stock was they had to put in an order to buy that specific stock. And the stock moved up and down based on the supply and demand of what people thought of that one stock. Not what they thought about the whole market, not what they thought about the sector or anything. That's how I started. The world has completely changed with ETFs, with indexes. Now, a single stock, the smallest component of what happens to that stock is what individual traders and investors think about that stock. Because that stock is likely part of an index, part of a sector. It's probably in about 10 different ETFs, maybe 50 different ETFs. And so the waves of money that come into this ETF is going to push this stock up and down. So now you better know what the sector is doing, what the industry group is doing, what the rest of the market is doing, because that accounts for about 80%. They've done studies on this, Patrick. About 80% of any stock's movement today is based on the market, the sector, and the industry group, ETFs. 80%. 20% is the smallest part of it, and that's individual buying and selling of the stock. Does that surprise you?
No, it doesn't, because I was around for that change too. I've been able to see the genesis of it and how it's evolved. And another one I want to add is the addition of not really algorithmic trading, because that's been around for a very long time, but the systems out there that do it at a very high speed, high frequency trading, your quant trading. That was a really big thing. It's still a thing now, but it's a really big thing years ago. And everybody kept saying how, these people are making trades by the nanosecond, and how this is really going to disrupt the market. And so that has been something in our time that we've been able to see, right in front of us. Almost no matter how young you are, unless you're in your teens or your early 20s listening to this right now, you probably remember trading before this was really a thing, and before a lot of offices started employing people that did this. So just know, we have seen these things before, and I guess the question really is, at the end of the day, was there reason to be concerned?
I want to jump in here, Patrick, and tell about my favorite guy on TV. For any of you who watch CNBC, there's a gentleman named Art Cashin. Art Cash, he's not on CNBC all that often. They bring him in just for special occasions. But Art Cashin is one of my favorite people. I remember back in 2008, I'd been trading for about 10 years, 11 years, when the absolute worst stock market crash we've seen in about 100 years, well, about 80 years at that point, happened in 2008. And banks were going out of business overnight. Bear Stearns on the brink, Lehman Brothers collapsing, capitalism collapsing. At some point, we were concerned, is capitalism even going to survive this? Is there going to be any banks left? And I remember I had never seen anything like this before. And I love they had Art Cashin on. And Art Cashin is this old guy. He's been down on the stock exchange floor since like 1940. He's got to be like 100 years old now. And he's like, oh, they are. So they're like, Art, what do you think? This is crashing. This is crazy. What do you think? He's like, you know what? We saw this in 57. We saw it again in 62. I lived through it in 77 and again in 87. You know what? This is what's going to happen, and it's going to be fine. And I remember thinking, how can he be so calm? Like, capitalism is collapsing on itself. And you know what? He was right. He was absolutely 100% right. So I just want to share that story with you to kind of let you know, if you're fairly new to trading, this may be your first existential crisis where you believe that you may not be able to make it as a trader. Once you've gone through a bunch of these crises, you're going to be just like Art Cashin and be like, you know what? It's just another change.
I'm not so sure about that, just because I don't know if that's quite an apples to apples comparison. That's something that happens cyclically, to where with AI, we're talking about an actual sea change here. Similar to the way we were talking about before, how all that manual trading was the way, and then it became not the way. Everybody was trading long term, and now you have this high frequency trading, and now that's a part of trading, and it's not going anywhere. And so I would wager to say that with AI, it's probably going to be here to stay in some capacity. What that capacity is, we really don't know. So let's drill down a little further, Rob, and jump into our next section. What do we kind of understand why we might fear things like this, because we've feared things like this in the past, whether they came to fruition or not. But drilling down even further on a trading level, what exactly do you think is going through a lot of people's heads when they hear about AI as it pertains to trading itself? Especially technical analysis too, because that's the way a lot of us trade primarily.
Patrick, I actually want to send this first one back to you, because this is something you've done your entire career, or at least most of your career, is run very systematic algorithmic trading strategies. And I think the biggest fear is that people are worried that the thing they developed, the strategy they developed, is no longer going to work when AI comes along.
Yes, and so the question at that point really comes down to, how do these AI decisions, well, first of all, we have to know how much it's going to permeate the market, all right? It's just like with quant trading, how much of the entire market is going to be that? If it's small, then it's going to have a small effect. If it's going to have a large, it's going to have a large effect. So let's just take the worst case scenario and say that institutions over time will see how AI improves their bottom line, and so that's what they're going to turn to. The first thing you have to ask is, how long is this transition going to take? But let's just go total worst case scenario and say it takes over very soon. And it just becomes the way. How will this affect the price action that we are used to seeing? Because if it does, then yes, a lot of the backtesting I did is not going to be relevant for the future. And that's to me especially, Mr. Do most of it by hand over here, that's a lot of sunk cost. And that is a lot of optimizing I have done to get to where I am right now. And to think that I might have to go back to square one with the rest of everybody else is terrifying.
And that's very understandable. I mean, it's a long, hard fight to get to the point where you're solidly profitable as a trader. And anything that threatens that is absolutely going to be scary. So, look, the change is coming. And I think the biggest thing that this whole episode is about is that change is inevitable. And just like back when we went from paper trading on the exchange floor to electronic trading, there was a change there. And the people that adapted were fine, and the people that didn't were not fine. And I think one of the biggest worries that people have about AI right now is that we all know that we are not as smart as AI. We all know that we are not as fast at making decisions as AI. We know that when we look at AI, we as people cannot compete head to head. And I think that's another thing that people are really worried about, is they're looking at the reality of AI is way smarter than us. Now, I want to share another analogy with you, one that I heard probably 2 or 3 years ago when AI was just starting up. And this really hit home. It really sunk in because, it's a concern, it's a worry. And when someone said this, I said, I get that, and I really am excited about this. They said that AI is going to be like the navigation that you put on your phone. So let's say you're driving and you're driving downtown. And the navigation system is simply going to show you the most efficient way to get downtown. You may say, you know what, I want to avoid tolls, I only want to do this, I only want to take right turns, whatever. But AI is going to show you the most effective way to do it. And then let's say that there was some unforeseen traffic that happened. AI is going to show you a different way. Now look, you don't have to do what the AI says. We still have free choice. So let's say AI said to go straight on that street. You can take a left. You have full autonomy to take a left. And the AI is not going to get mad at you. It's not going to, put you in jail. It's then going to say, oh, they took a left. Well, now this is the most effective way to get there. So this is not us versus AI. This is not you versus AI, because yes, you're right. You will lose that every single time. I want everyone to reframe this. You with AI. That's going to be the way that this is really going to help out.
Okay, so that is a good example, and I would even argue that Google Maps kind of already does that. I think AI will probably do it at a much more efficient rate. And like you said, yeah, you can choose to use it or choose not to use it. But I think, back to the fears real quick, if it helps your bottom line, people are going to use it, individuals and especially institutions with all that money. So not only somebody like me who is 14 years in, having to relearn or redo everything I've done, that's a terrible fear to have, or somebody who is just learning right now, and it's like, wow, I have all this stuff to learn, but why bother if somebody with no talent or some institution that just has a ton of money just flips on the AI switch and just has AI do it for them? Why am I even relevant? What is my place in this world? What is the point of me even learning this when I'm just going to get replaced? And this is not just Forex trading. This is indices. This is metals. This is crypto. This is everything. So as an aspiring trader, I don't feel like I have anywhere to really turn. if AI is just going to come in and reduce the need or eliminate the need for me to even exist. I think that is a logical fear. So that being said, let's go ahead and switch this over to the actual reality. So I want to talk about first, Rob, kind of the reality of the situation, and you illustrated that really well with the navigation. But I think there's a lot more personalized examples we can give as far as the trading world goes. And then I want to provide some solutions at the very end too, because I think all these fears are legit, but I don't think personally they are probable. How do you feel about what I just said? Are you kind of on the same wavelength with me? Do you think people have a legitimate right to fear this, or do you think it's just going to be the ozone layer all over again?
I really need to quantify what fear of that means. Does fear of it mean that, it kicks someone in the butt to, learn how to change and adapt? Or is it fear that just stops someone from even trying because they give up? So I think it's absolutely a legitimate fear, and I think you are hitting all the right points and just spot on. The big question is, does that cause you to quit, give up, throw your hands in the air, say, I can never compete? Or does that motivate you and say, oh, damn, I better get on my horse and start learning some new things? So, yes, you're right on. It's scary. It's fearful. Things are going to change. But it's all on how you deal with it.
It is. And I'll go as far to say that I think the fear itself is overblown in the trading realm. So in other sectors, you might have a legitimate fear with this. And I think really the emotions we're talking about here, Rob, are not just fear, but dread and demotivation, maybe, I think are really the emotions we're targeting here alongside with fear. And really the point here for me at least is to tell everybody that personally, if I had to put odds on it, I think it's going to be a factor. But we have to understand what trading is at the end of the day. And what trading is at the end of the day, I don't even think AI can come in and mess with too much. Because at the end of the day, it's still supply and demand. Less so in Forex. We'll get to that in a moment. But it's all algorithmic too. And what I think is going to happen is you're going to see with AI, it's kind of the same thing you see with EAs right now and with quant trading. It just looks for patterns, which is the exact same thing we're doing. So I remember going back to what we were talking about at the beginning of the show, Rob, how, when all of this new innovation came into the trading world, from a price action standpoint, which is mostly what I deal with as a technical trader, I can't really say I noticed it. Maybe it happened, but it happened over such a period of time that I can't sit there and say, I can sit there and say the volume was more in 2013 in the Forex market than it is now, because of course it was. But apart from that, as far as actual price action, the things I see on a day-to-day basis and the things I notice, it's still kind of the same, even with this new technology. And I don't see AI making a big difference here. What do you think?
I am totally unconcerned about AI. Totally. Because let me tell you why. There's all of these books and all of these websites. There's all of everything to help you with the world of trading. But let's just get down to the core of what trading is. What makes an asset go up and down in price? There's only one thing. There's one thing. Supply and demand. AI is not going to change that game. It's not going to change that core game of how many buyers are on the left, how many sellers are on the right, and how many people are behind them. Now again, we say people, maybe it's not people, maybe it's AI, maybe it's AI systems, maybe it's, there's 10,000 AI systems out there all running different time frames, different strategies. I don't care if it's people or AI systems. I just don't care, because in the end, one of the sides is going to have more orders than the other. Or let's not even say orders, more money. So money in versus money out causes assets to go up and down in value, period. So if you just focus on that and you really think about, okay, how is AI going to affect that? Okay, maybe AI can make things move a little faster. Guess what? Electronic trading made things move a lot faster. Guess what? People adapted. It's fine. I am so not worried about this. I'm just only excited about this because I'm really hoping that I can help myself and my traders pick up more efficiency. So I just want everyone to understand. This is the one point I wanted everyone to understand in this episode, is the core of trading is that there are buyers and sellers. And at some point, they're even. Prices don't move. Sometimes there's more sellers than buyers. Prices go down. Sometimes there's more buyers and sellers. Prices go up. That is the core of trading. And AI is only going to assist the people that are doing that anyway. I don't see anything to be scared of.
Now, before I go too far, some of my old school listeners are going to jump in and say, wait a minute, VP, you don't believe in supply and demand in the Forex market. And you're right, I don't. But Rob alluded to it. It has to do with where those orders are and how much money is in those orders and how many orders are there. And that's what the banks look for. But step back a little bit. The reason why those orders are there are all due to sentiment, which is due to behavioral patterns, which is what technical analysis is looking for anyway at the end of the day. So whether it's supply and demand or whether it's order books, whatever it is, it's still behavioral patterns. It was 50 years ago. It is today. It's going to be the same 50 years from now. So I don't even really know how AI would even help me become a better trader. I'm interested to find out. But, Rob, this is something that you said we were talking before the show, and I've heard this too. And I was really more thinking from a content creation standpoint. My fear was like, man, you mean to tell me that somebody with no talent, no charisma, no original ideas is going to come in and have the same chance to rank on YouTube as I will, or to compete in the podcast space like I did? That was a fear of mine when I first heard about it. But now I'm thinking, I'm like, it's just going to be an enhancement. You said it's not AI that's going to take your job. It's somebody using AI that's going to take your job. And you know what? That's a lot more comforting, because guess what? I can learn how to use AI too. And now what? Now what are you going to do? Now I just took your advantage away from you. So even though I don't really know how that's going to make me a better or worse trader or a better or worse content creator, I'm willing to learn. I'm willing to use it. And just like you were saying before too, with all those floor traders, the conversation you and I were having, I think all those floor traders lost their job as a floor trader, but they just went into electronic trading, or they just went to a brick and mortar, or they just started a hedge fund. Like, they're doing something different, but they're doing the same thing with trading. And that's probably what we're going to have to do too, in some way. But it's not going to be some crazy transition. We're starting at the same level as a 16-year-old kid right now in terms of what we can learn through AI. So there's no advantage there or disadvantage. And again, if there is some kind of big sea change in the way people trade, we can adjust with it just like anybody else can. And if we're doing it in a different way, then we're all doing it in a different way. And at the end of the day, if you're trading charts like we do here, it's all pattern recognition, regardless of who or what is looking for it.
You nailed it. It's just the willingness to change, the willingness to stay on top of things. And this is why we did a episode on programmatic trading, and I came out and I said I loved it, 100% in support of it, but I hated black boxes that people bought and they thought they could run forever. Remember that? Patrick, do you remember that episode where I was really negative about people that bought this thing off a shelf and then thought that for the next 40 years it was going to run and be profitable?
So when you say black box, do you mean that thing that would tell you the news, the numbers like 15 seconds ahead of everybody else?
No, a black box is basically just is an algorithm that never changes. It just never changes and always is just firing off. It's just a computer program with no manual entry, no oversight, no anything. You just set it and forget it, they would tell you. The thought that that would run for 40 years and be able to keep up with the adjustments to market conditions is laughable. And so I'm really at the same point here with AI, is that, the strategy that you're trading right here, right now, I promise you in 10, 15, 20 years, even without AI, the market will change to where you are forced to change with it. That's just being a trader. Being a trader is always looking at the market, always trying to figure out where your edge is, how do you get it more efficient, and that's where I really think AI is going to come into play, and then how to improve it. That's the world of trading. I don't see any difference with AI here at all, and in fact, I only see opportunity.
Yeah, I do too, and I think the only people, really, and I'll kind of wrap it up with this, the only people who should be concerned are the people who just, in general, if this is just your personality type, you just refuse to evolve. I think even a lot of you are going to be fine, but, we can all adjust together. We can all use the same tools. And so for example, everybody here knows I'm big into MT4. It has all the indicators. It's easy to use, but it is prehistoric, let's be honest, when it comes down to charting. And if it gets phased out over time, and it's slowly getting phased out in certain places, I'll be fine. I'm not going to like it. It's going to be a bit of work. I may have to pay somebody to reprogram my algorithm into a different language, but that's fine. Then I'll be at the next level, a place where I can stay for the next 10, 15 years of my trading life. That's just...
Hey, Patrick, maybe AI could help you with that recoding.
Possibly. Would I trust it to? I don't know. But yeah, if it saves me hundreds of dollars, I might give it a try and see what that looks like on a new platform. So yeah, it's like I more embrace it. And this is somebody who's a Gen Xer who's, not afraid of technology, but not just, it's not the only world I know. So yeah, I just don't see, unless you're just so old and set in your ways that you just don't want to do anything any other way. I think people like you were doomed from the start anyway. It just depends on how. I think the rest of us were going to be just fine. I think price action is always going to be price action. And if there's tools out there that can make me better at anything else or make anything else more efficient, I'm down. And I'll tell you right now, Rob, I barely use Google search anymore. I go straight to Gemini and just ask it what I want to ask it because it's going to give me a more specific answer. So I'm already liking version 1.0 of what I see, and I'm excited for the future.
I'm very excited as well, and we are actively working to bring this into Maverick trading and Maverick currencies because, like you said, if you don't evolve, you die. So we always evolve at Maverick, and we're always going to be evolving as much as possible.
Yeah, trading, as far as you go, traders, is probably not going to go away. There's actually a pretty good chance it's going to get even better. So on that note, thank you everybody for listening to the Trading Psychology Podcast. Rob and I will see you next time.
Goodbye, everybody.
This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, it's the man with a plan. It's Rob Reinhold.
Hello, everybody. Nice to see you this week. Excited to talk about this episode.
Yeah, this is one you put together, and I'm really surprised we have not talked about this more because I think this is going to pertain to a lot of people. You guys saw the title. We're talking about jumping systems. Now, I think more than most episodes, we need to define what we mean here because I don't think when a lot of you read this title, you're thinking the same thing we're thinking. So, Rob, go ahead and kind of define terms here and just make things clear for everybody before we even get started because I just want to make sure everybody's looking in the right direction here.
I think that is a great place to start, Patrick, because we have to define this very clearly just so everyone knows exactly when they're jumping systems and when they're just doing their job as a trader. So let's talk about, again, systematic trading, where you have built a system, you've back-tested it, you've demo traded it, and you have this system going to where you are methodical and you simply do the same thing over time. So let's talk about jumping systems. Let's kind of talk about what is jumping systems and what isn't. Now, I've talked about how I don't like what's called black box trading, where you buy these EAs, you buy them off of wherever you buy them, and you plug them in, and supposedly you let them run by themselves forever, and you never have to do anything. And I've been very negative about those because I talk about how things change in the market. The markets change, volatility changes, trend changes, and if you're not driving that system, you have no control. You've just ceded all your control over, and it's going to probably not work. All traders at all times should be monitoring and updating and optimizing their systems. So Patrick, I know you started this process a very, very long time ago. And I'm sure that your system today is wildly different than the system you started out with. Can you share a little bit of that with us?
Well, yeah, how far back you want to go, really. It's like, before I just really kind of put the pieces of the algorithm in place, I was really just trying to figure out what worked. But I still wanted to trade, so I wasn't really testing right. I was just kind of eyeballing it. I was like, ooh, this looks really good. Oh, this looks really good. Let's see if we can, curve fit it to, work well together. And now let's go ahead and trade it. Now, that's kind of what my journey looked like early on when I was really discovering, other indicators that weren't really widely known. But, over time, I was like, okay, I need a bit more structure here. So I added on pieces, tried not to add too many pieces, and that's what I have today. So structurally, it wasn't even really in place up until maybe, late 2012, 2013. But yeah, if I were to take a snapshot of what I had back then to what I have now, only one indicator would remain the same, and that was the ATR. And that's not even an indicator that determines price direction. So yeah, it's been through many iterations. I've never really jumped systems. I've just kept improving on the ones I've had, but that does include changing a lot of parts, for sure.
Let's break this down into two terms. Let's talk about system building and then system optimization. So the system building is what you talked about in the beginning, where you tried new things on. You said, hey, let me do some A/B testing here, see what's best. But once you had made your system where you pretty much said, hey, this is it, and you ran it and you were consistent and you did the same thing over time, that's when system building ends and system optimization begins, where you're saying, hey, this is my core system. I'm going to see if I can get this a little bit better, or I can see if I can make some changes here, or hey, you know what, maybe in this kind of environment, if I add this on, it's going to perform a little better. So hopefully everyone sees here, you have system building, which is a lot of trial and error, which is a lot of, I think this is going to work. You test it out, it doesn't work, you got to scrap it, and you got to go back and figure out what's going to work. System building is its own separate thing, and you're always interchanging parts. System optimization. So when you have your core strategy down and you're simply trying to fine tune it. So we're really talking about system optimization when we come to jumping systems. So we're no longer testing things, we're not only back testing things, we have a real capital on the line, and we've been trading this for a while. At some point, that system will be tested, I guarantee you. And not just the system, but it's you that's going to be tested. And Patrick, I love it when you say that, when you back tested, you weren't there every day to agonize over all of the ins and outs and all the little blips here and there, because it was just, you looked back 3 years and you said, oh, these are the expected values. But when you're in real time and you have to sit through all the agony of little things up and down, that's when your system gets you. And that's really what we're talking about here. So I just love, Patrick, how you talk about how when you were back testing, it didn't care about anything. It didn't care about the drawdowns. It didn't care about the flat, month that you had. It just didn't care.
Yeah, the system, when it was back testing, never sat there and said, you know what, maybe it was working before, but it's not working now. Maybe we should quit. No, it just kept going. And so that's why you got the results you got, whatever those results are. Chances are, if they were good, that's what you're using right now, or some variation of it. So yeah, just always something to remember. But real quick though, Rob, before we move forward here, so we kind of know what it's not, right? Can you tell us just like a quick, definition of exactly what jumping systems is for the context of this episode?
Absolutely. Jumping systems is when you abandon or change parts of a system in times of distress. I think that is the most clear way for me to say what jumping system is you do it under duress.
Okay, good. And you and I were talking before the show as well. You said you are going through this right now with some of your best traders, correct? And kind of give a little background on that, because I think this is really interesting, because I will bet the story you are about to tell is something that a handful of our listeners are going through right now.
Well, it's something that every trader is going to go through at some point in their trading career. There's no question about it. So I have a handful of SPX traders that are delta neutral. So it's a lot of terms here. If you're not familiar with options, it's basically that you are profiting from time value, from the option expiring in value. And what you do is you keep your portfolio not long, not short, but you keep it to where it's right in the middle. So you have zero delta. And so if the market goes up, then you sell a little bit more delta. The market goes down, you buy a little bit more delta. So you're always keeping your price exposure down. So you're keeping your price exposure down, but you're selling a lot of options to where you're bringing in premium while this thing sits there. Now, the risk of this, if there's a big move, it just means that sometimes that delta exposure or that loss will become greater than the decay in the underlying options, and that's when it can lose. But that's not what's happening here. So these traders have been trading these strategies for years, and I've been sending distribution month after month after month, and they've been some of my best. This year, they are flat to down. And I've been talking with them, reaching out to them and saying, okay, look, let's talk about where we are. Let's talk about where you are. Let's talk about your strategies, because I'm starting to see a little bit of different behavior. And that's always a red flag for me that says, okay, here's someone with a strategy that's worked for years and years. It's not working right now. Let's make sure that they don't make any really big mistakes. So I'm absolutely dealing with this right now at Maverick, and it's with a handful of traders that have done really well. So you don't want to change systems under distress. And that's really what this episode's about.
All right. So moving on to the reasons why this may be happening. Now, you have a few written down here, and I have one written down, but I want to start with mine because I think in a lot of cases, it's the backdrop for the other three. System build, it's almost kind of like the journey is better than the destination. System building can be very exciting, especially when you're doing it for the first time, because you're discovering new things, you're discovering the synergies between that and the things you have, and you're seeing it work really well, or you're back testing it, and you keep seeing better and better results than what you had before. That's really exciting. I mean, that's it. Just the mind races when you see things like that, just because of like what could be with a system like this. And then you put it into play, and lo and behold, it's working. And it might be working, like you said, Rob, for a year, maybe two, before you really see any type of adversity. And so with your traders, we're over halfway through the year now, and the system that they've tested, took their time putting together, and really performed well with for 2 years, is now not. So I think that the logical move in their minds is, well, it must be the system, and we need to change over. So before we talk about the solutions side of things, go over what you think probably are the reasons that this desire to completely go to something different in the very first year it's not working is happening to some of these people.
It's going to be a whole bunch of things, and one of the first ones is going to be FOMO, where you are used to making money, and then you see all the people out there trading NVIDIA, Supermicro, all this stuff that's running, and yet your system is underperforming. And you're seeing other people are making a lot of money doing other things Once you sit there long enough, twiddling your thumbs and working your butt off, again, and these are very complex systems, that these people are very, very intelligent. They're seeing that their neighbor, their friend are talking about how much money that they're making in the market, and yet they're the sophisticated ones. The FOMO is one of the things that's going to want to get you to jump systems. So I want to go through the reasons why, because I want this to like stick in your brain for when you start to have these thoughts, that there are dangerous thoughts. So FOMO, watching other people make money while your system is underperforming, can actually be very frustrating.
Okay, so that's an interesting one that I hadn't always really considered. You know, it's not about what you're making or not making, it's what you see other people making. And some of these people might be a bunch of crypto degens on Twitter, or a bunch of people on YouTube who you don't really respect, or even people close to you that you know that you're better than as far as being a trader, as far as being disciplined, all these things. And they're the ones that get to have their time in the sun. And it's not just a fleeting time in the sun, that they're still doing really well while you're sitting there treading water. I can understand how that would be a drain on somebody. So, okay, there's one. And another one of the reasons you have here is kind of what we alluded to a minute ago, but I think it needs to be said because everybody goes through this. And I think the biggest reason is that your system is just not doing well in the moment. And it's not giving you the same euphoria you had in the past. And maybe it just keeps losing, or maybe it just keeps breaking even. And so now you think, well, this is probably just the market. This is probably just how it is now. As if the entire trading market was one way, and starting January 1st of this year, for example, it became completely different, and this is just how it's going to be for the rest of eternity, which is absurd.
Totally agree. And you know, another thing I want to talk about is when people build systems and they backtest it, and they backtest it over 5 years. Did you understand that with the systems we have now, you can backtest something over 5 years in about 1 minute? Do you know how long 5 years really is? So you get this really fast payoff when you build a system, you backtest it, you get this very quick payoff of getting numbers. But then as you go implement this, it seems painfully slow. Painfully slow, so slow that you're thinking to yourself, I'm never going to get where I want to be. I think that's another thing that sets people up for jumping systems is they build their system, they backtest, everything's great, and then when it comes to how long it really takes to crank out 15, 20, 30, 40% gains, when that's really in your face, not just a backtest, but it's a year and a half, 18 months, people say, this is too slow for me, I'm going to jump to something else.
Yeah, all that makes total sense. It's just, especially, there's such a disconnect, I want to say it again, between the backtesting phase and the real trading phase. Like, let's say you did run a system check, 5 years back, and it gave you good results. There could have been a 20% drawdown year, like in year 2 or year 3 or something like that, and you would have never known. There's no way to know that unless you really run a heavy diagnostic check, which most people don't do, or just don't even know how to do. So these are things you don't see. So you get to experience all these things in real time. And when you backtest it, it didn't. So, once that reality finally hits people, they just don't always deal with it the right way. So let's talk about the right way, Rob, because I think there might be some people out there expecting us to just say, well, just don't feel that way and just understand that if you see it through, it's all going to be fine. But that's not necessarily the solutions we're about to give. So go ahead and get us started here.
The first thing that you really need to think about when you are discussing or entertaining the thought of changing up the way you trade, the first thing I want you to do is I want you to really try to get all of your preconceived notions out of your head. And here's the question. Are you making this decision when you're under distress? That should be a major, major red flag. If the answer is yes, if you're making this decision after a 25% drawdown, there is no way that this is actually a good time to make this decision. So I want you to be very, very conscious of when you do make this decision of, do I want to jump systems? Make sure that it isn't at a low point. Make sure it's not at a low, because at that low, it's going to be almost impossible to not do this for emotional reasons. So that's the first thing I want you to do, is really check your emotional state. If you're at a low, I highly recommend take a month off, come back a month later, then make the decision. You're much more likely to make a better decision if you're not under distress. The second thing you need to ask yourself, is this cyclical or secular? Now, I want to put these words into your vocabulary. If you don't know what they are, I'm going to explain them. But something that is cyclical, it runs in cycles. And we know a whole bunch of things that run in cycles. We know in the Forex market, sometimes we have really good trends, really high volatility, and then sometimes we have poor trends and poor volatility. And during these poor trends and poor volatility times, if you are a trend trader, I can already tell you your system is not going to do as good in those moments as it did in the good trends, high volatility moments. The question you need to ask yourself is this cyclical? Is this simply that it's just we're part of the cycle where we don't have a good trading environment? So we have things like economic cycles. We have, booms, we have busts, we have bubbles, we have popping bubbles, we have stagnation, we have inflation. We have all of these cycles that we know are not going to last forever. Patrick, do you have anything that people can use to really think about this term of cyclical?
Like an actual tool, no. But I think I'll just add that, from 2018 to 2021 probably, and if you're around then, there were a lot of times in the market where the Forex market just wasn't moving. Most of the money was flooding into the overall stock market and into crypto. And when it's going away from Forex, we lose volatility. And as a trend trader, it's really hard to trade. So there was a lot of doubt going on then, because as soon as we would get out of the woods, it would go right back and we'd take losses and we'd be right back to Dullsville again. And that's really hard to put up with, especially when you're back testing your system from 2015 to 2017 and it is doing a lot better. So it's a hard pill to swallow, and I think we lost a lot of potentially really good traders during that time. But things are cyclical. The market is better now, and that's a very long-term cycle we're talking about. But within those cycles are smaller cycles, and your system is not equipped to profit during all of them. It's designed to sit out during a lot of it. At least if you're a no-nonsense Forex trader, I can speak to this. And there's going to be some times where the market just doesn't play very well with us. And the good thing is a good system is designed to not get too beat up by times like that, but it's still going to happen. And sometimes it's going to happen consecutively, and that's going to really chew up your bottom line. So all of these things can happen just within the course of 6 months. So if you haven't experienced it before, and it's here now, just know it's supposed to happen, and it won't be the last. So you better hope you're built for this.
These cycles are guaranteed. They've always been around. They'll always be around. They might change a little bit in nature, but the boom and bust cycle of markets, of economies, that's been going on forever. So when you are analyzing your system, where it is right now, you aren't getting the results you want, because that's the only time you want to jump a system. You really have to focus on, is this simply cyclical? And if it is cyclical, then we need to already be thoughtful about what are we going to do in these times.